this public participation for Finance Bill 2025. And we'll start with a parliamentary prayer by Honorable Paul Biego.
May we bow down for a word of prayer. Almighty God, who in your wisdom and goodness have appointed the offices of leaders and parliaments for the welfare of society and the just government of the people, we beseech you to behold with your abundant favor us, your servants, whom you have been pleased to call to the performance of important trusts in this republic. Let your blessings descend upon us here assembled, and grant that we treat and consider all matters that shall come under our deliberation in so just and faithful a manner as to promote your honor and glory, and to advance the peace, prosperity, and welfare of our country and of those whose interests you have committed to our charge. Amen.
We have 6 participants. We have KEPSA. KEPSA, you're in? We have CAM, Kenya Association of Manufacturers. We have 4th Generation Capital. Yeah. We have SKM Africa. They are in. We have women in real estate. There is no man. You are just alone. You must be very tough. Then we have Uber. You are alone. Bot was here yesterday or the day before yesterday. Yes. Yeah, I thought you could have done same presentation. But anyway, maybe next time. Although you are competitors, but you can sit down and agree on joint presentation, the way Airtel and Safaricom did yesterday, right? We'll start with KEPSA. But I want to encourage you, if an issue has been tackled, and actually that's why we have brought all of you here. If a clause or issue has been tackled, you don't need to labor on it so much, because it's something which has been talked about. 2, I know we have been with you for so many years. My sister here, I think we started like when I came to Parliament. By then we were young, now we are grown a bit old. Now, we don't need to give a prolonged background of KEPSA or Uber. We know Uber, by the way. All of us, we will use Uber, right? And you even use it today. But women in real estate, you know, this is the first time I'm hearing women in real estate. Those ones, they can tell us a bit what they do. And yeah, so 4th generation capital, I don't know why they are 4th generation capital. Why is the 1st generation capital? So they can give us some insights what they do, right? So over to you, Steve. You introduce your staff. Oh, before then,
introduced.
Yeah, let's introduce the members of Parliament.
Thank you, Session Chair. My name is Paul Kibichi Biego, Member of Parliament, Chesumei constituency, that's in Nandi County, and I'm a member of this Finance and National Planning Committee. Thank you.
Good morning, everyone. Dr. Rico John Omoet, Member of Parliament for Turkana South, Turkana County, Member of Finance and National Planning Committee.
Forgive Honorable Mboni, I'm sure his sisters confused him, seeing him again, after last year. Okay, I'm Honorable Julius Ruto, Member of Parliament, KEPSA constituency, and a member of this committee.
Secretariat, Council to represent the Secretariat.
Good morning, I'm Jenny Fandetto, Deputy Director, Legal Services in the National Assembly.
I'm David Mboni, Member of Parliament, Kitui Rural, sitting in for the chair, who is going to join us shortly. KEPSA, Steve, you can introduce your colleagues, and then you start the presentation. I understand you want how many minutes?
Only 1 hour.
1 hour is too much. If you want 1 hour, what about KEPSA?
Oh,
What about CAM? CAM will take like 2 days.
Chair, maybe if you may find it in your wisdom, like our good friend doing presentation, he has also appeared here on another capacity. Probably if there are issues you had already prosecuted and they are similar, you might do favor to all of us if you stick to new areas you feel like they are yet to be represented, though they are touching, because you had already prosecuted on the same capacity.
So what he's trying to say is that I know you are a consultant, but remember we have been here. This is our 10th day on the same issues. So don't labor so much on the same thing, because we are even understand. By the way, you can even do the report, but we have to give you the chance also to present, so that you don't say you do not participate. So I'll give you 30 minutes. Yeah.
You know me, I'm always very judicious with time. Or I'm always very judicious with time. I don't belabor the points, just strike it. We'll try as much as possible to do it in as short a time as possible. And the cleanups, there's a lot of cleanups that we've proposed, or it's basically just cleanups to the legislation, which we will not dive deep into it, and we just focus on the key points. But our memorandum has covered the areas of cleanup that we also want, so those ones we'll not pay attention to, but they are equally very important, yeah, because it can cause interpretation issues. So I think we can start, or Jilna will start the introduction, then I introduce myself, then other members of KEPSA.
Good morning, Honorable Chair, members of Parliament. My name is Jilna Shah, Vice Chair of the Public Finance Sector Board at KEPSA.
I'm Steve Okoth. I'm a member of the Public Finance Sector Board of KEPSA.
Good morning, Honorable Chair, members of Parliament. My name is John Jogu. I am the Vice Chair of the KEPSA Energy Board. Thank you.
Good morning. My name is Emmanuel Otieno. I'm with the KEPSA Management.
Good morning. My name is Johnston Mulari. I belong to this Finance Committee at KEPSA.
Good morning, Chair and the Honorable Members of Parliament. I'm John Moturi from KEPSA PPD.
Before you start presentation, you have been joined by our Vice Chair. He can introduce himself and take over the proceedings here.
Thank you, Honorable Mboni, for chairing this session. I am Benjamin Langat, MB for Inamoi, member and Vice Chair. I think the Chair will join us shortly. We'll proceed. Karibuni sana. So I'm told this is KEPSA. So who is leading the presentation?
I'm beginning the presentation.
Okay, so proceed.
Okay. So thanks a lot for this opportunity to appear before this committee. I'll start with the first issue, and this issue is really at the heart of business. And because we've addressed it in the past, I'll just go to the additional points that are being brought and that have been brought by our membership, because we've collected views from everyone, almost the most important businesses in this country. We've collected views from them and condensed it into this document. The point that has come on tax losses, we are recommending that tax losses be allowed to be exhausted. Tax losses are actually business expenses that have not been utilized against income. If there was sufficient income in that particular year of income, they would have been utilized. This is normal business expenses. You've spent $1 million shillings in a particular year, but your income is 500,000. You built a factory, you bought stock, you bought goods, you paid staff, you paid everyone, you paid your landlord, but the income that you've generated in that year is not sufficient to offset the expenses that you've incurred. In accounting principle, this kind of expense should be utilized in the subsequent year against the income that is coming in that year. So we need to look at it as business expenses that have not yet been utilized. So it's not someone taking advantage of any system or someone being in business in perpetuity. This is one point that has come from our accounting body, that we need to recognize this from the accounting standpoint. The document that we presented to you has cited the accounting principles, and of course, it's going to be on record. We need to look at it from that perspective. The other point that has come, and we've made recommendations that if this is not allowed, there are other mechanisms to ease this, and it's already in the document. The other point that we'd like to bring to the attention of the House is that what are we doing? Are we moving to say that businesses should not offset losses, or loss-making businesses are not contributing to the economy? They are. They pay pay-as-you-earn, which is a tax. They pay VAT, they pay withholding tax. They pay customs duties, which is tax paid to the government. They pay county levies and other fees that are paid to the government. So these businesses are contributing immensely to the national kitty of resources. If you stop them, or if you say this country does not allow this kind of businesses, the amount of loss in terms of taxes and jobs and productivity and skills development will be massive. So we need to tolerate this kind of businesses because they are providing immense value to the economy. That is the first point that we'd like to bring. The second issue, I've indicated that we'll not go to the cleanups that we've recommended. The second critical issue is on affordable housing. And this is in point 4 of our document. Affordable housing, there's a proposal to remove the 15% preferential corporation tax rate for affordable housing. And our view is that this is contradicting the national economic policy. The situation where the right is not speaking to the left. Tax policy is not following the economic policy of the country, and government projects that are being undertaken in partnership with private sector players. Chair, I'd like to shed light to this, that these affordable housing projects, most of them are PPPs. They are JVs between government and a private developer. And they are partners in the business. Government provides lands and other services, and the government also, in the projections, the government indicates that we are also providing you with VAT exemption. We are also providing you with corporation tax rate, which is reduced. We are also waiving miscellaneous fees and levies. This is part of the deal, of the contract that is signed between the government and the developer. And based on that, they go to the market and they get financing from banks, mostly from banks, and that forms the structure of the project. Now, if we begin perturbing that structure by saying we are going back to 30%, it means we have to then reprice and renegotiate all the contracts. We cannot therefore now sell these housing units in the market at 3 million, 4 million. We have to sell them at a much higher price because what the government promised in the contract is now not available. So I'm proposing to members that we retain everything, or the preferential 15% corporate tax rate for affordable housing. And there is also the part for VAT, which I'd like to discuss in this particular point. In our document, we propose that let's zero rate supplies of goods to the affordable housing sector so that we avoid administrative difficulties in implementing these projects. Now, the zero rating here is not a blanket zero rating. It has to be, the units have to be reviewed by the Department for Housing, and it has to be recommended by the Cabinet Secretary responsible for housing, and then the Cabinet Secretary for the National Treasury approves it, and then KRA implements the zero rating. So there is sufficient safeguards to ensure that only legitimate expenses qualify for this. Zero rating would be quite good for this particular sector. We don't remove the exemption. Instead, we alternate the exemption with zero rating.
Thank you. Moving on to provision number 5. It's a new provision. Since this bill, we are talking about a lot of cleanup provisions from the Tax Laws Amendment Act that took that took effect from 27 December 2024. We have noticed a lot of changes, cleanups that have been recommended in this bill, which is a good thing. In addition to that, there were some gaps also that we have noticed that have not been picked up in this finance bill, and we'd like to recommend a few changes. For instance, if you look at section 10(4) of the Income Tax Act, which talks about where you're a resident owner of a digital marketplace, you are supposed to withhold 5% for any sale that is happening on that platform. So I'll give you an example. If you have the likes of Jumia, where they make a payment to a supplier who's transacting on their platform, they're supposed to withhold 5%. The argument on the goods that they're selling. Remember, the argument here is these sellers are MSMEs. They're already on the 1.5% turnover tax regime. So by withholding 5%, it does not make any sense to withhold 5% when they're only paying 1.5%. So what is happening? A lot of the people will start moving to the other platforms such as Instagrams, where it's very difficult for KRA to catch. If you look at Facebook, it's very easy for me to go and buy a product. So what this provision, we are just trying to emphasize, there was a removal of the word goods. I remember last time the committee gracefully also removed from the definition the word goods. But if you look at it, it still talks about in respect of digital content monetization, property or services. Property can be vague. Although there is no definition in the Income Tax Act, either we put a proviso of what that property should be excluding goods, because I know the intention, if you look at last year's report, the intention was that we should not have goods on this. But if you look at the definition of property outside, which is under the Interpretation General Provisions Act, property includes goods. So that's where we could get caught. But what we're trying to move and drive away is the business that these people can generate. So let's see if that can also be incorporated in this cleanup bill, as I call it. Another one was, I know it's a ask, but the PAYE bans. Is that something we could consider? Because 35%, as we all know, has been quite penal for all of us. What we want to understand is, by bringing in 35%, what has been the collection overall? Has it really improved or has it really declined? Did it generate the intended collections, or did we really drive people out of employment? Or move into a consultancy type, So there you're not really making the PAYE that you intended to earn. So if we move back and go back to the old rates, that's the proposal, is to move it back to the 30%. And let's bring the PAYE, as it was at 30%, because that's also in line with our MTRS that we are the medium-term revenue strategy, the national tax policy, and keep it stagnant. And let's see if it spurs some element of growth in terms of income tax collections. The other proposal, which we would like us to just tidy up, if you look at the capital allowances rates that have been provided under industrial building and docks, they're not really well worded. So our proposal is to make sure we add the word 10% per year in equal installments, and under dock as well, 10% per year in equal installments. Right now, one is just showing 10% and the other one is showing 10% in equal installments. So this is a tidy up provision that we would like us to add into this, into the bill. The other one in terms of a new provision is, I think what Finance Act 2023 introduced, capital gains, the anti-avoidance provisions on capital gains tax, where you have an offshore structure which is holding the Kenyan company. So if you sell the shares of the foreign company, but the 20% or more of that value of the shares is derived from the Kenyan company by way of immovable property or the value of the company, then remember CGT is applicable. That has now become quite penal for a lot of structures. So what the proposal in this instance is by the members is, can we amend that to add a paragraph that for the purposes of transfer of shares from an offshore jurisdiction and registration of such shares in Kenya, they're saying this provision to be exempt until 30th June 2027 for people to bring those structures back onshore. It allows people to bring the holdings back onshore so that we can have visibility of all these offshore structures that are seated outside. But if you grant them this tax-free period, a lot of structures can come in, money will stay within the country, and it will avoid all these non-visibility that we currently have within the economy. So that was another one. And
why 2027?
We're looking at 2 years because we're already at 25, so it gives 2 years to wind up structures, you know, to bring it back onshore. But even 1 year is good enough if that's something that you could consider.
Maybe since Chair has interjected, what is the merits that you're looking at giving 2 years, 1 year? What factors do you consider so that you give that period? That if you give them 2 years, they will have wound up, and what parameters are you looking at?
As in, we just want to ensure that these structures are one, you know, it's not easy. There are some complex structures that we have seen in many organizations offshore to wind every company up and then bring the necessary shareholding back into the country. It's a lot of work. And remember, they have to wind up offshore. They have their own administrative challenges, even abroad. So to bring all that back into the country, and the fact that they can only bring it back if there's some incentive. So that's what there's a request is to incentivize and make that transfer, that reorganization of that group structure to be CGT free, exempt from CGT, so that those cleanup structures can be brought back. 2 years is an ask in terms of just for purposes of the time it could take, but even 1 year could be considered if that's something that is more digestible. Lastly, I think from a VAT Act perspective, I will not go into everything, but the whole issue of exempting, you know, the generation of solar and wind energy, I think we really need to relook into those provisions because we're just looking at increasing. Remember, VAT exemption in totality just means increase in costs to the end consumer. So is that really the intention in this instance of the bill to, you know, increase the costs up to, because then that really doesn't encourage because we are blessed with good weather in this country. So I think this is something that should be promoted as we find that Kenya lacks in that space of energy generation and all that. So construction of housing, Steve has already discussed. And yeah, maybe you want to take on the next one from 15 onwards or something.
Okay. Chair, the e-mobility people were here with us yesterday, and I believe the day before yesterday. We are proposing that we support e-mobility sector by retaining the exemptions, and we support the lithium ion, the materials which are necessary for that particular sector. Most importantly, the lithium ion batteries. The national policy, the government policy, is to go green. This is Kenya government's policy, is to go green. So we are proposing that in light of that, tax policy should also pursue that agenda to retain the exemption for items relating to e-mobility, items relating to solar and green energy and wind and exploration. So this bill proposes rolling back sufficient incentives that were put in place to help grow these new sectors, including the raw materials used to generate bioethanol or fuel, which is a much cleaner energy being used. Cocoa is the main player in this particular sector, being used in the slum areas and other rural areas. So the bill is really going back on incentives that were put in place for Kenya to progress forward in the green agenda. This is the main point, and the sections of this document on VAT relates to the rollback that is proposed, and we are requesting the National Assembly to not allow that rollback because these are very nascent sectors. They are still growing. Let's support them for at least another 5 years for them to grow into full-blown sectors that can provide value to our country. It's important to note one thing, that very few countries in the world have the advantage that Kenya has in terms of generation of clean energy. E-mobility is one of the ways in which we can utilize our excess electricity, which is green, and convert it into vehicles and bikes that we can use. So we are proposing that that support continues. I'll pick on a few issues on the tax procedures, and the proposals that we are making on the tax procedures are quite significant. One of them aims at solving the problem of VAT refunds. Chair, as we sit now, the VAT refund backlog is more than 130 billion Kenya shillings. This is a position. Every single month, the amount that KRA repays is about 2 billion or 3 billion, and some months they skip. It means there is going to be no way in which we are going to utilize, to pay all these VAT refunds in a timely fashion. We've had disputes going to court, people suing KRA to pay their VAT refunds, or asking KRA to pay them interest on that. But these are just plastic solutions. We need a more solid solution to clear the backlog of VAT refunds. We are proposing in the Tax Procedures Act that one of the mechanisms for settling VAT refunds is for government to securitize the refunds and issue bonds to those whose refunds have been verified and have not been paid for years. The Commissioner may place guidelines, the Cabinet Secretary may place guidelines to facilitate this process so that we know we are not going to pay these refunds. Let's give bonds to the people who are owed these refunds and let them liquidate them in the NSE. This is a recommendation to clear the backlog of VAT refunds so that we can start afresh going forward. This same mechanism was used when the government settled in the petroleum industry, the rebates. The government just did not have the funds to pay the rebates. They gave bonds, and these bonds have been sold in the market. We are proposing that the same be applied for VAT refunds because, or realistically, we are not going to settle this 130 billion because even more refunds applications are being filed every single day. So this is one of the recommendations that we are proposing in the bill. The second one is we are proposing the reinstatement.
So that is that's a new clause you are recommending?
That's a new clause. That's a new clause to settle the VAT. Now, we are proposing the extension of the amnesty period to 30th June 2026. Kenya Revenue Authority has made a significant amount of collections due to the amnesty program, and this government needs the money. Why don't we extend the amnesty period for 1 more year as an incentive so that the collections that they are gathering continues, and in addition to that, we extend the applicable period up to 31st December 2024. This is a request for extension. It will be good for Kenya Revenue Authority's collection, and it will be good for taxpayers.
24 or 26?
For 30th June 2026. We are proposing the extension of amnesty to 30th June 2026.
Now you will make Kenyans to They will now say, we know next year they will still.
Chair, if I may.
think it will now, it will work against what the intention of that amnesty, because now we are making Kenyans to believe that after all, next year we know they'll still push it to 2027 June. And last year, when I remember when we were doing the tax laws amendment bill, we actually said that was the last call for Kenyans to respond to the amnesty if they want to benefit. Now, if we go to that direction, I think it will go against the intention. Mr. Steve.
Chair, Kenya Revenue Authority has started the process of ledger cleanup, and they started it this year. This is migration of legacy. We are using iTax right now, we are using iTax. But before iTax, there was a ITMS system, and before the ITMS system, there was a manual system. Kenya Revenue Authority is bringing what they think is the status from the manual system and from the ITMS, and many taxpayers this year have received demands of taxes arising from all the way since 1992. In my tax team, I was the only one, I think I was the only one who was alive in 1992 in my entire tax team. So you can imagine how long a time that is. So Kenya Revenue, you are receiving a letter from KRA saying you owe this money from 1995, 1996, as a company or an individual. You need to present documents, bank statements, everything, and then it's cleared and it's found you have a penalty of 1 million or 2 million. And they have just started issuing the letters. The letters are now beginning to come. I think the majority of letters are going to come in forward. To enable people to clear this issue of legacy and the manual system, let's allow, because KRA has just instituted this process this year, let's allow 1 more year for people to clear their legacy issues. And this will also be good for KRA to also collect those taxes from the 90s and from the early 2000s, so that we have a clean ledger now going forward. These are items that are not even on iTax. They are from the previous system. They're just being loaded. I think you've seen it, or Chair, or the issues that are coming. 1 more year will enable us to clear the legacy issues, and it will be good for government collection.
It will also aid in avoiding disputes, because otherwise what will happen is if there is so much of penalty and interest that have accumulated, somebody might do a cost-benefit analysis and say, I'd rather go to court than pay this amount. So this might be something that might entice someone to pay the principal tax than to go to. So it's a good way of collection. And then there are so many KRA audits that are also ongoing at the moment. So I think that'll help clean up ledgers, KRA audits, everything for the taxpayers.
Chair, we are also proposing a new clause in this bill for the reinstatement of the old amnesty on foreign-sourced funds. Many Kenyans have money out there. We are recommending that we give them amnesty to bring this money into the country. They can invest it in the bonds that we are proposing for refunds, or bonds that we are proposing. They can buy these bonds from the stock market. We put a condition that bring money back, no questions asked, no tax issues raised, but you invest it in the Kenyan market. We've made a provision and a proposal with a write-up as to how it will look for this particular.
How did the previous amnesty work? Do you have statistics, Mr. Steve?
I have data.
How much money did we get from outside because of that amnesty? Do you have it here?
It is actually about 8,000 people came forth with funds, and on an average, it was about $1 million for each of those 8,000 Kenyans who came forth. So it is average. Others was tens of millions, others was a little bit, but on average, at least $1 million was coming in. And more Kenyans now even have more money out there. We need to allow these funds to come in and we utilize them for our economy. We are making these recommendations as KEPSA because most of the time, many people have come before you just with complaints, but we are coming with proposed solutions to solve the public debt issue, to solve the VAT refund issue, so that with the resources that we have and the mechanisms that we have, without doing much more, or without having to borrow so much from the local market or to borrow so much from the external market.
Chair, I think that's a very fantastic proposal. Instead of government keeping these refunds, they can issue bonds, so that if you issue me a bond, I can also decide to sell it to somebody else who has money. I can even sell it to somebody outside the country. But now that one now brings another issue, that there are so many pending bills also, which has been declared legible for payments. Do you think giving bonds to these the VAT refunds owners, the people with pending bills, they are also not going to complain, they are not going to court and say that they're also being discriminated? Yeah, this is an issue of multicoloniality problem. I mean, you try to sort out one problem, then another one comes in, even a bigger one, right? Yeah. You remember that mystery snake, which when you cut his head, another one germinates. Two of them, not even one.
Yes.
That's the concept of multicoloniality. My friend here, CPA, has been wondering what is multicoloniality, because he has never been to serious macroeconomic class, and advanced macroeconomic class.
Thank you, Chair. I think you need to protect me from Honorable Mboni, who said that in CPA class there is no economics. Anyway, Chair, I wanted to also, this is a very interesting discussion, topic that is coming up. From now accounting point of view, I wanted to know whether tax claims, especially VAT refunds, can it qualify as a bending bill for that purpose? The number two, we know we approve budgets, deficit budgets, with deficit financing. And the aid group that is provided the fiscal space, if we shift now to move the claims and use the bonds, don't we challenge the fiscal space that is meant to finance the budget, which entirely it will trigger the growth multiplier effect on the aspect of building up the requisite tax and enable taxman, KRA, have reserves to honor these claims. So I wanted to know from that point whether the refunds qualify as a bending bill from the perspective of Mheshimiwa, and looking at it, if we go that way already, it means then we are opening up the deficit in the budget. Thank you.
Actually, just to add, you see, at the end of the day, you're still going to pay the bonds plus the interest. At one point, if you give a bond of 5 years, at 5 years you have to pay interest. So that's the thing I was talking about. That you may try to sort out this problem, and then other problems will come in. Even if it's 10 years, at the 10, you're still going to pay interest rate. So maybe you can educate us on this.
I think I just wanted to add a comment on that, because when we were discussing this solution, what is the issue? The issue is refunds are verified, but there is no money to pay them. So what happens to business is you then have to go to the bank to borrow. And interest rates being what they are, then the business side suffers. But when you look at government borrowing in the domestic market, they've crowded out the private sector. Actually, we were looking at the banking report, and private sector borrowing has not grown. It has actually grown at 0%. So it means this is a conundrum, and what we're trying to do with securitization of these VAT refunds, since they're not a pending bill but an advanced it's already tax already paid. So it's money already paid. And what we're trying to solve is how do we unlock liquidity back to business? And since government is borrowing heavily from the banks, and you can see the record profits, and in fact, as a committee, you need to look at how is it that banks are making as much money as they are making, because then what we are looking for as business is how do we recover the finance cost so that the money that government owes, you are able to cover for me my finance costs so that I can go back to the same bank, which is awash with cash, and it releases capital back. So I think that's the rationale that we have. So whether the bonds will fall due at a particular time is an important matter, but again is how do you release capital back to business so that it can continue?
Okay. So, Chair, it's true what you've mentioned, but the Kenya government still has headroom to borrow more, much bigger headroom to borrow more. If you look at the Public Finance Management Act, VAT refunds or other tax refunds are not classified as, in law, they are not recognized as pending bills. But practically, they are pending bills. In law, they are not classified as pending bills, but practically, they are pending bills. We are seeking a solution for the market, for the economy. This backlog, we don't think the way we are going is not going to work. 2 billion
because
sometimes.
well, you know very well the refunds are not paid through consolidated fund. You know, it is the commissioner who should organize and arrange in such a manner that he pays from his end, not through consolidated fund. And that is why financial reporting will miss out to capture that one.
So if you ask about the multiplier and collinearity effect, it's true, or the people who are still owed by the government may also say, give us bonds. If you verified our pending bills, also give us bonds, and we call it a day. So this kind of discussion may arise. If it arises, in my personal view, not KEPSA's view, I think it would be good for them also to be issued with bonds, because pending bills is hurting the economy. Pending bills and refunds is really hurting the market. If we can take this solution, and we have already tested it with the petroleum industry, and it has worked. Some people have even made profit from the bonds that they got. They sold at higher prices. So this is something that we've tested it, and it works. It can work for us. We need to look for solutions for the problems that face us. Now,
Actually, Chair, that's a very good proposal. We should put it down when Treasury comes. This is something we need to discuss with them on this. Because you remember last year, the CS Treasury told us that by February this year, they are going to come up with solutions to pay pending bills. And you see, these refunds in the courts, they're also pending bills because government is about to pay them. It's only that they are not classified as pending bills as such. But you see, this money which government owe people, right? If I owe you money, it's a debt, regardless of how you define it, but it's a debt. So I think I buy the idea, but we need to discuss it with the Treasury to see how they can. If they did it for oil industries, then they can still extend to other sectors so that at least companies can have liquidity to move on with their businesses.
Okay. The other point that we proposed in this bill, which was discussed also earlier, 2 days ago, is to grant the commissioner powers, to exempt special players from withholding VAT. So we are making this proposal as a new clause. Let's give the commissioner powers to exempt particular players from withholding VAT. And those specific scenarios, we've outlined them in our document. We've even worded how it will look. Those whose retail prices are directed under law by the government of Kenya, where you are told you can't sell beyond 100 shillings or 120 shillings. your retail price is fixed by the government. Those whose margins are so thin such that the gross margin is below 5%, and the Kenya Revenue Authority has all the data from all industries. They know the margins from all sectors. Or those who are in such massive VAT input credit, let's say you built a hotel, you have 100 million input credit, input credit. It will take you years to offset that particular input credit. Why will you further suffer withholding VAT? The commissioner should be granted leeway to look at that situation on a case-by-case basis and grant or exemption from withholding VAT. Withholding VAT is not really a tax. It's an advance payment collection of VAT, which was going to be paid, if payable, at the end of the month. We're just saying, in situations and circumstances where it's not going to be paid anyway, let the commissioner look at it on a case-by-case basis, and they can give it for, you are exempted for a year, or you can be exempted for 2 years, depending on the circumstance. We are requesting that this power be given back to the commissioner. It used to be with the commissioner, it was taken away. Let's give it back, or to allow administrative mechanism, or
Can you give us an example?
Yeah. Let me give you an example, Honorable. From the petroleum sector, which I come from. That provision was removed in Finance Act 2021. Prior, the commissioner would grant exemptions, and what would happen is we did not have the problem we have right now, because in the petroleum supply chain, we do have players that are called resellers. Now, resellers, because of the way our supply chain is structured, do not appear in the price breakdown that is given by EPRA. So what they are, they're actually brokers or commission agents. So what you find is a reseller just adds a very minimal amount. For example, on a truck of 10,000 liters, he'll charge 20 cents per liter to facilitate that trade. So if you ask that person to withhold, with the prices of fuel today, he will be, the customer will withhold 34,000 out of the supply, yet the person was only making 2,000. So what we have seen with this is the industry somehow has not agreed to comply, because they would say, okay, for me, if you want me to sell you fuel, pay my full invoice. And then for us, as a matter of fact, if KRA comes and says you have not withheld, we prove that we paid the whole 16%. So what was I withholding? So you find that a lot of either some resellers have left the market, they have left the business completely, or there's been a refusal from wholesalers to allow you to withhold their money. And I don't think that's a good way to look at it. When we did have that exemption, the industry was working properly, and what an oil marketing company would do is the exemption they have, they would forward it to the resellers, and it would flow like that back to the market. So it didn't cause any issue. So that's where we see that power coming back, helping the industry to unlock the funds that are held. And really, you will see that the amounts that are held by...
Please mind the time.
Oh, thank you. I was just...
Chair, allow me, so that I don't come back to interject. I'm trying to understand this business model.
Yes.
The model that there are players in between in the value chain. But there is another level of, how do I call, is it domineering or manipulation? Because when you say, is this broker a legitimate business distribution line?
Yes, they are legitimate.
And the law is very clear. He knows shoulders of agency has been paid as long as the commodity is changing hands. So the value chain and the VAT comes up. Why is the owner of why is the wholesaler like undermining the work of this distributor in the quest of this particular value chain? The 2 cents is net of VAT, I'm sure. So if it is subjected to VAT, then it will grow over. Whereas EPRA has given a limitation in terms of price. So how do we describe these people? How do we identify them? Where do we place them? Because EPRA gives the price at the retail, at the pump price. there is, in terms of breakdown of the pricing structure, these people are not defined. So how do we put them? Because there's a change of hands, there's change of value in that. So how do we put them? How do we cluster them if it comes to income tax? Again, to avoid discrimination and lack of uniformity, how do we describe them?
On responding to that, EPRA carried out what you call the cost of service study, or COSOP, which shows what is the cost of supplying petroleum product. And in looking at resellers, they noted that resellers are extensions of wholesalers. So the work they do is that they allow fuel to get to the far-flung areas where oil marketing companies cannot get. But the role they play is just like the way you have marikiti brokers. They facilitate that fuel getting to the most remote areas and the far-flung areas, because when you get out of town, you'll find one single pump where they'll say, just deliver for me 1,000. An oil marketing company will not do that business. So the reseller is the one who does that. And the margins they make are so little that they are below what is expected to be withheld. So it is that the technical application of withholding VAT for that person becomes an impracticability. But when we did have the proviso from the commissioner that he could grant exemptions, you would go back and see in record that actually petroleum businesses were the ones that were getting those exemptions because it made sense.
Now, I think you are even complicated it. Because I think in the oil industry, there are three players, mainly. The oil farms, the big ones like Shell, that is the people in energy, whatever, those who import, right?
Yes.
Then there's the distributors, right?
Yes.
Then now there's the retailers. And all of them, because I think last parliament we had a start on that, the profit is supposed to be 12 shillings per litre. If you sell a litre, it's 12 shillings.
So,
but it's,
sorry, it's not profit, it's the margin.
The margin. Margin is the profit. It may not be net profit, because net profit, you have to also to...
Gross profit.
And gross profit. So each is supposed to get 4 shillings. The multinationals, 4 shillings. Distributors, 4 shillings. The retailers, 4 shillings. Right? So where is the problem? You need to understand where is the problem. Because yesterday when we were discussing here, we realized that when you go to a retailer and you are buying fuel, like myself, I'm buying fuel, and my friend here, there's no withholding tax, right? But if he sells to a county government or institution or NGO, because those ones are supposed to withhold tax on behalf of KRA, now there is withholding tax. So what is the problem? If you make us understand, we can now think. Yes. But just explain in layman language. Don't complicate things. If you complicate now, you leave us.
I think, honourable members, let us also be mindful of time. And then I do not know whether you are in oil sector.
Yes, I am. I'm the CEO of Petroleum Outlets Association of Kenya. Okay,
so you are the right person to answer that question.
Yes.
Okay.
And we look after the local investors in the petroleum space, especially what you call independents. When I talk about resellers, petroleum cannot be supplied properly in this country without resellers. Now, when the cost of service study was done, EPRA noted that resellers are actually extensions of wholesalers. So the only business that a reseller does is buying fuel from the oil marketing companies and pushing it back to the retailers or even to other businesses wherever they may be. The structure of his business is that he is only making maybe 20 cents a litre. When you subject that reseller to withholding VAT, he cannot afford to continue the supply because his margin is very little, way below that 2%, which is required for withholding. And that is a case that we've presented to KRA, and they understood it, but the thing they told us was that we do not have a legal provision to exempt you.
While you're doing that, from presentation of Honorable Mboni through the chair, looking at the structure of the margin that EBRA has provided at 12 shillings, allocating 4, I think, to the importer, 4 to wholesaler or distributor, 4 to the retailer. So the 3 4s makes the 12. Where is this reseller in this structure?
The reseller is in the wholesale part, but he does not stand alone in the supply chain. He's just an enabler of that transaction. He's not recognized in that margin, but he's the enabler of that transaction. He is not recognized. And if you even make reference, and we can bring that document on record, the cost of service study that was done by EPRA, it shows that, yes, they recognize that resellers play an important role, but only as enablers of wholesale of petroleum products.
I think let's shift the debate back to finance bill. I think maybe it's an interesting debate. We need a day for that. Let's refocus on finance bill issues. Steve, I see you still have 11 minutes. How many points do you still have?
We will just highlight 2 points.
Okay.
We'll give back the balance of our time. We promise to be very judicious with time, and we want to fulfill that promise.
Thank you.
Gilna, you can pick the...
Thank you. I think one key proposal, especially under the Tax Procedures Act, would be to delete the Section 52 of the Finance Bill, which allows the commissioner to have access to private or personal data and trade secrets of customers. I think that one, we are finding it very dangerous, I would use the term, because we don't know the data going into the hands of who, and where is the legal, comfort from that perspective, that what happens should the data go in the wrong hands. So it's prone to a lot of disputes, especially through the Data Protection Act. Has that been considered? So our proposal is to please reconsider this, because this one is it's too dangerous, especially personal data. Can you imagine even having personal data around the amount of hacking that experts that we have now, to have such data also going into the hands of, the wrong hands, basically, can create a lot of chaos as a country. So it's important, especially when you're looking at minors. We have information about health patients. So banks having a lot of information about this can also lead to a lot of extortions. So please.
I think we've heard you. I think every presenter was appeared before us.
Thank you. No more comments.
Even Steve was here yesterday. He made the same. The other day, I believe, was there. He made the same. So I think everyone has really mentioned that issue. So we are already seized of the matter.
The final point, and just before I go to the final point, the key issue on granting the commissioner powers to exempt this is because the margins are so thin, such that if this withholding VAT wipes out the margins of the business. So it's not a practical thing for industries where the margins are so thin, below 5%, or for persons who already have too much input VAT. That's the tax angle to it. Now, going to the final point, and this is really an issue that has come through over years. There is a proposal to grant KRA powers to collect money from people's bank accounts if you have a dispute with KRA, a tax dispute with KRA. This kind of provision will be quite dangerous. It means we are saying we don't have trust in our dispute resolution mechanism. We don't have trust in our legal system. This power is not necessary. It is only bound to be abused or by KRA whereby they will bring huge assessments which many may not have a basis. Much of it they can raise billions worth of assessments, and then they go or pick money from your bank account or while the matter is still in dispute resolution. So just on their word of mouth alone from one party is not sufficient enough to actually go to people's bank accounts or go to people's creditors or suppliers to ask money or to be paid. This power is not proper. The dispute resolution mechanism in Kenya works. Most disputes, tax disputes, are resolved in objection review, which is a KRA mechanism. When KRA issues an assessment, you object to that particular assessment. Most assessments are resolved by KRA and the taxpayer in the independent review of objections. So there is already an internal mechanism. Where is the hurry? The second batch of most disputes is resolved through ADR. ADR is also a process which is controlled by KRA. If they say ADR is slow or ADR is controlled by Kenya Revenue Authority as we stand. So this excessive power is not warranted. It will only be used for harassment and rent seeking. And it's also unconstitutional. So we are asking that such powers not be granted. The system is good as it is, and it is working for everybody.
You know, from your end, your arguments are good. When you talk also to KRA, they say, as I don't know to say all Kenyans, but some Kenyans also, they want to use the legal process to delay the payment as much as possible. So in your view, where is the win-win position?
50-50.
Where is the win-win position where we take care of these Kenyans who want to delay the payment intentionally, and also we allow you to follow the due process faithfully?
So I want response to that KRA position. We need to go to the facts. Picking an outlier, one taxpayer out of 1,000 who is abusing the process. You see, if you make a provision that is going to hurt the 1,000 because of one person who is a rogue taxpayer, those ones we leave as outliers. Society must have rogue people, but they are very few. If you make law only for the rogue, then you will hurt the entire market. Facts speak for themselves. More than 80% of tax disputes don't go to a judgment of the tribunal. They are resolved by KRA and the taxpayers, either through objection review or in ADR. Two processes which are controlled by Kenya Revenue Authority. These are facts, actual objections filed and how they are resolved. So the bulk of the disputes are resolved within the control of Kenya Revenue Authority. The ones that then go to the tribunal, the win by KRA and taxpayers is 50-50. KRA wins 50, taxpayers win 50. That means we are only left with 10% of the disputes going to High Court. If there is a rogue party, and in High Court...
Maybe our secretariat, you should take note of that. We need to establish from KRA how many cases went to tribunal in the last 1 year, how many cases went to court in the last 1 year, so that we see your point. So take note of that, our secretariat.
So this is our last point, and we can in addition to that, you should also take the data of how many go to the tribunal but are settled by consent. That is ADR, because that also cuts the figure. So only 10% of disputes go to High Court. So if there is a rogue player within the 10%.
I will confirm your statement, Steve.
I have the data already myself.
Okay.
But you can confirm.
Can you move to conclude?
Yeah, you can conclude.
I think whilst we are reviewing the finance bill, it's always good to step back and see what the previous two bills have been able to generate in terms of an impact assessment, as we always say. Even the public wants to know what is it that we were looking for in terms of the money? Did we really achieve that or we did not? Then it might be a time to do a comprehensive review of what we are proposing in these finance bills. Because I think the whole issue of having a finance bill does not mean that we have to keep changing a lot of things. We've tried to minimize that in this bill, which is good. But if it's a cleanup that is required, let's do a comprehensive cleanup of everything. Let's see how we can generate more revenue investments in the country. Remember, that's what we need at this point in time as an economy. The private sector has really suffered over the year, over the 2 years, I would say, in terms of more investment, putting in more money. So what are we doing to enable the cost of doing business to be low so that the investments stay in Kenya and we are not moving the investments to our neighboring competitors, because that's what is now becoming a problem. We need to ensure our laws stay stable, levies, costs of everything that we are considering be looked at it in detail. I know there is a deficit issue, which we understand as well, but wouldn't it be an issue of right now we have maximized in terms of income, that's the max we can generate at this point in time as an economy. Let's now see, can we bring in more business to this country? Let's see if we can entice foreign direct investment and see more we can collect through revenues. And that's how we can generate more jobs, because remember, this private sector also contributes to a lot of employment. And right now, as you can see, the statistics of employment is rather high, unemployment, is rather high. So what are we doing to build that conducive environment for foreign investors to feel attracted to the economy? Because if we keep removing everything from, in terms of incentives, everything, what is in it for them? That's also a question that we get asked as private sector. So thank you so much.
Chair, so that as they wind up, I see they have some few seconds. This issue of carrying forward profit losses, tax losses, business losses, is becoming a heated debate. What I know and all of us know, business environment is not the same, nature of business is not the same. Maybe in future, we need to think around it, because if we make a general law to cover these particular losses, don't you think it can be misused? Because as it is right now, there are people who perennially plan their taxes in such a manner that these losses are visible. We agree strategic maybe investment on extraction might take time before you realize the cash flows as far as any other investment. We need to agree on that. Otherwise, to say indefinite, I still feel we are not doing justice to the collection. Thank you.
Mheshimiwa, you're going back to the
question?
Yeah.
I was listening and trying to match the words of Steve and also following the provisions of the accounting principles, the issue of merging concept, because you gave reference to accounting. And I was also like, okay, do you know the principle of merging concept, the year of income and the year of expenditure, unless it is a deferred expenditure, which then can be recognized in future.
We actually have prepared one of the documents that we are giving is there's a whole analysis on this issue of losses, including the industries that are likely to be impacted. It's a whole technical brief that we are providing to the Secretariat. We couldn't go into total details of it with references to credible material, so that is available. But the summation of it is that it is a genuine business expense. It's only that it's not utilized in the particular year, and it's, if you don't allow it to be utilized in the subsequent year, it means the shareholders have to chip in capital to plug that deficit. So it means we are capitalizing government expenditure, and that's not good principle for attracting investment or retaining investment. The other point is that even businesses that perennially make losses contribute immensely to the economy. And a good economy requires a mix of different, not be doing well, but they are all contributing to jobs, they are contributing to productivity, they are contributing to development of skills. Some people even start business without any intention of making a profit. They just want to keep it going, but they have staff and they pay VAT, they pay as you earn, they are providing services to the community. We don't just live to make money. Some people just live to keep on going, and it's a good business, And that's the reason why you find...
Steve, I like that, but your colleague is looking at you and wondering, what are you talking about? What are you saying? But it's true. Actually, what he's saying is true. There are some people who can start a business, not to make a profit, but to be there, just to be there, to be seen, and they are happy when they are doing
Chairman,
it.
you need to close this discussion because Mboni is also misleading us.
No.
In business world, those are strategies. You might end up to just build a name with an intended objective of making a gain somewhere. So there's a compensating.
Other members can one person.
But what he's saying.
Can you have one person speaking?
Yeah, what he's saying. What I was thinking is that this indefinite is not very good, because you see, as my colleague has said here, the ultimate goal of somebody starting a business is make profit. You may make losses, but you may also have intention of selling the business in future, so that you can also recoup your money and make money from it. But if you have a limitation, maybe 10 years, leave alone 5 years, 10 years, don't you think this one will encourage the owners to come up with innovations and strategies of addressing the financial situation?
Chair, you have one of the examples in the paper that we presented is real estate. In a commercial real estate investment, the return on investment is 5% per annum. That means for you to recoup your investment takes 20 years. 5% per annum is 20 years. So that's you put 2 billion, 3 billion into a commercial building or even a residential building. A commercial building, you get the capital allowance, commercial building allowance. So it means you are eligible for this. You go into a massive tax loss. It will take you a minimum of 20 years, just if you don't have any operational expenses. So it means in a typical one investment, we are already looking at 20 years. Manufacturing is even a much longer period. So for major businesses, 10 years is still not sufficient.
Thank you, Steve. And thank you for keeping time. I think we are slightly, I think you missed by 5 minutes, which is because you're interrupted by my members here. Thank you very much. Thank you for your presentation. We shall consider your presentation at a relevant time. But thank you very much for doing a lot of research on the Finance Bill 2025. So we are done with KEPSA. Next is fourth generation capital. Santeni-san. But you can still sit to keep us company.
We listen.
Yeah, they keep. Yeah. Where is the fourth generation capital? Okay.
Vice Chair, good afternoon. Vice Chair, committee members, good afternoon, and thank you very much for letting us discuss today. My name is Julian Mitchell. I'm the CEO of Fourth Generation Capital. As the comment was made earlier, I will give a quick introduction to who we are, what we do. I'll give a little bit of context about the comments that we would like to make, and then I will pass over to my colleagues.
You start. How many issues do you have?
We'll be discussing 2 issues today, sir.
So I'll give you maximum 15.
Sawa. Okay, so Fourth Generation Capital is an award-winning fintech. In fact, just this week we've won the leading fintech award at the Africa Bankers Award, which I'm very, very happy about. I'm going to give you some context about the business now. So we've been around for 10 years. We've got 190 branches across the country. We monthly typically serve about 100,000 unique customers, and over our history have disbursed over 5 million loans and employ over 1,200 people. All of those people we employ are PAYE employees, and we always pay above the living wage. Why am I telling you this? Because I believe we us to be a good corporate citizen, and I want to
How much do you pay as you earn monthly, approximately?
I would have to get back to you on that exact figure.
Because it will be good. It will be good for us to know
It's a serious chunk of change, to be very blunt. We pay a huge amount on PAYE.
You said you employ how many people?
1,200 people. We don't employ, there's no agent models to source new business and stuff like that. Every single person who works for us is effectively an employee under a full-time contract.
Okay.
Yeah. So I'm telling you that because I want you to understand that we're coming at this as someone who, we believe we're a good corporate citizen, we're B Corp certified, we try to lend in ethical ways, etc. We lend to the micro and nano enterprises. Our average loan size is only 17,000 shillings. Our smallest loan size is 5,000 shillings. And the reason that we do well is because we have very good touch points, hence a lot of staff with our customers. And we grow our customers, and we actually do well when we actually grow our businesses, when we grow the businesses and their capital needs grow over time. So that's how we do well as a business. Now,
so you are a digital lender?
We are a digital credit provider, and we are regulated by the Central Bank of Kenya, yes, sir.
Okay.
Yeah. The definition of digital lender is a tricky one, so I will let my colleague answer that one. That brings me on to the first problem. A loan is a loan is a loan. The banks for decades have been giving out loans, and they recently, and the way the loans work, as we all know, you get some money, you get it, you charge an interest, which is your margin, you get it back. Everything's good. Some of it doesn't come back. That's your bad debts, and those are your losses against your thing, and that gives you us our gross profit. Now that's something that's taken place in Kenya for decades. It's well understood around globally as well. Now, recently the KRA started to interpret those the principal components of those losses as a capital asset, not an operational loss. The consequence of that is multiple. For me to grow my business, for me, it's first off, I mean, it introduces a huge amount of uncertainty within the industry, and I'll talk about that in a second. But secondly, it's just difficult to understand from a kind of lay person point of view. The bad debt losses are effectively our cost of goods sold. So if you have no cost of goods sold, it very artificially messes up your profit and loss and makes investment more difficult. To be quite clear, the 100,000 customers I mentioned earlier, I'm looking to increase that by an order of magnitude in the next 4 years. For me to get to 1 million customers in the next 4 years, I need a lot more capital. Now, that capital will come from local sources, and it's going to come from foreign sources. I'm already having problems with foreign lenders already because of the ambiguity that's been created by these interpretations and the way these rules have been applied. So that for us is a major, major problem, and I don't understand the rationale for wanting to treat capital losses, as non-tax deductible when in fact they are operational losses. I'll let my colleague go into details. The second point is around the excise duty. I think it's more of a drafting issue whereby we've not been, DCPs have not been included within the exemption from the excise duty on interest rate. There is no good reason that I can see where that should be the case. So let me hand over please to my colleague Brian, who will take us through some of the details of that.
Honorable Vice Chair, honorable members, my name is Brian Rono. We are supporting 4G, fourth generation capital. So I'll just take us through what my colleague has taken us through. So the first issue that we have relating to bad debts is a proposed new introduction to the finance bill. So we want the finance bill to include a provision that would specifically exempt capital expenditure relating to bad debts and allow it for deduction. So the context around this is that the law right now is very clear. Under Section 15, you can deduct bad debts that you incur in the course of your business. So in this context, as 4G, as I mentioned, they do lend out money. And some of those people that they receive these loans don't pay. So the practice has always been that if 4G lends out 100 shillings and they're supposed to get 10 shillings in interest and fees, and that loan is not repaid, 4G could, pursuant to the provisions of Section 15, deduct the 110 loss they've suffered against their income. So what we've seen the commissioner do is come back to 4G and tell them, no, don't do that. You're only supposed to deduct 10% as a bad debt, the 100 shillings that you lent out will be considered capital. So how the Commissioner has been doing this is that Section 15 expressly allows for the deduction of bad debts if they are incurred in the ordinary course of business. But then the law also allowed the Commissioner in Section 15 to issue guidelines on how to determine that a debt has become uncollectible. So the Commissioner did issue Legal Notice 37 of 2021. These are guidelines basically on allowability of bad debts. So the key provision under those guidelines that the Commissioner has been relying on is what we'd call paragraph 4, which provides as follows. It's in the previous slide. For the purposes of these guidelines, a bad debt which is of a capital nature shall not be an allowable expense. So according to the Commissioner, the principle that you lend out is not capital in nature. Something we don't see in Section 15, because Section 15 clearly says any bad debt that is incurred in the ordinary course of business. And for a money lender such as 4G, the entire component of that loan is the bad debt immediately, it's not repaid. So our request was to amend Section 16, 1A.
How is it treated in the normal banking system? Because,
it would be deductible as an expense.
You do lending like any other bank, right?
Yes.
So if it becomes bad debt in a bank, how do you normally?
It would be written off as a loss, the whole lot, principal and interest. And this is both like within the current banking sector, within the local market, but it's also international norm as well.
So I think if we are doing digital lending and it becomes bad debts, I think where we are, it's clear. It's a bad debt like the way it's a bad debt in a bank.
In a bank, yes.
Yeah. So I think proceed to the next point.
Sorry?
Proceed to the next point. I think we have made your point there.
Yeah. So that's very clear. So the next issue is what you had alluded to earlier in respect of the classification of 4G as a digital lender and the digital lender definition that is introduced under Section 38A of the Finance Bill. So what we have in the new Finance Bill you'd see is that the definition of a digital lender has been proposed to be defined as follows: a person extending credit through an electronic medium but does not include a bank licensed under the Banking Act, a SACCO society registered under the Cooperative Societies Act, or a microfinance institution licensed under the Microfinance Act. So for all intents and purposes, Fourth Generation Capital is licensed as a digital credit provider under the Central Bank Act. So pursuant to this new definition, they would fit within the definition of a digital lender. However, the challenge that they are facing is that if you also, the challenge that so the challenge that we are currently facing is that if you look at the definition of financial institution within the same legislation, it says a financial institution includes a person licensed under 1 Banking Act, 2 Insurance Act, 3 Central Bank of Kenya Act, and 4 Microfinance Act, and then B, a SACCO society. So all these people who are listed under the definition of financial institution have been excluded in this new definition, except those that are licensed under the Central Bank of Kenya Act. So the consequence of that...
What I want to hear from you is what exactly affects you with that...
So this new definition means that Fourth Generation Capital will be considered a financial institution and a digital lender.
So what is the problem? What is the problem on your side with that?
The impact of that is would be subject to an excise duty that the peers, our peers in a banking or microfinance institution would not be charged. So suddenly we have a revenue tax when there is when our peers who are licensed slightly adjacent to us are not charged the same. But for all intents and purposes for the customer, they have a similar product. So there's a mismatch between the various definitions.
Are you a member of, I think there is an Association of Digital Lenders?
DIFSAC, correct, we are, yes.
Have you discussed in that?
At length. and they are of the same opinion.
Okay.
We feel very strongly about this, which is why we came to make an individual submission on top of the submissions from DIFSAC.
So what is your proposal?
To include regulated DCPs as part of that definition.
Persons who are excluded under the definition of digital lenders.
Because I know we amended the law last year.
Yes.
Requiring digital lenders to register with, to be regulated by central bank. So summarize exactly what do you want?
If I may, what happened in the law last year was exactly what was needed, and we're grateful. This unwinds some of the work that happened within the bill last year. And it treats us in an uneven, it treats DCPs in an uneven manner.
Okay, I think you made your point next. You have any other?
Yeah, only those two issues.
Okay, so thank you very much. I think we shall consider your comments when we retreat to make a final report on this bill. Thank you very much for your time, and we wish you well.
Sir, thank you very much for taking the time to listen to us as well.
Thank you.
Very much appreciated.
Thank you.
Santeni sana.
Sante. Let's have which one? Where is SKM Africa?
Uber.
Uber. Okay. So let's have SKM. Or are you together?
No, Chair.
Okay. You can come and sit. Okay, let me. There's some members who have walked in. Sorry. Let them introduce themselves.
Thank you, Chair. My name is Chiforomodo Mangale, MP Lungalunga, a member of Finance and National Planning Committee. Thank you.
Chair, and I hope you're aware that the ladies have really also waited, and the priority usually is given to ladies. There are 3 ladies there.
You're right about Mheshimiwa. I know what you are saying, but we also have a schedule depending on when they arrive. So how many issues are you prosecuting?
Thanks, Chair. We have a number of issues, but we'll focus on 5 issues.
So I give you 15 minutes. Focus on the most important issues.
Chair, with your indulgence, could you kindly make it 20?
Okay.
Thank you. Much appreciated. So, Chair, I guess we start with the introduction. My name is Mokaya Caleb. I work with SKM Africa, and my colleague can introduce himself.
Hello, everyone. So my name is Fred Gitonga from SKM Africa. All right. So we'll quickly brush through our submissions. Then we'll put much more weight in the key issues that we'd like the committee to consider. Quickly going through it is we want to recommend or request the committee to consider the proposal to limit the carry forward of tax losses that is being proposed to 5 years. We are requesting the clause to be amended so that now the period can go beyond the 5 years limit, because some investors have incurred huge investments, and within 5 years it will be a very short time for them to break even and recover these genuine tax losses that they claim. The other one is on withholding on royalty. We have noticed that the definition keeps on expanding. Yeah, so we are proposing that this clause be deleted, and so that now we try to reduce the cost that will be passed through to the final customers. And this will also make the competitiveness between the software distributors to be very minimal, and this will discourage investment in that space. So there won't be any investors who would like to go in there, and also for the customers, others will go away from, or they try to avoid, since now it's shifting additional burden to the customers.
Chair, just to reiterate a position, we have a client in the extractive sector. He sunk in about 4 billion in the past 4 years. At this point yet, they have not yet been able to start the extraction of the minerals. They are still in exploration stage. Now, Chair, if you were to strictly adopt this position that's proposed, it essentially means in year 5, they would have put in, say, give or take 5 billion. If they are lucky to have some meaningful extraction in year 5, I don't think they'll have much, they would have extracted much minerals, and that share then speaks to what losses they'll be writing off for year 1 that essentially would have expired. Chair, the same case applies to farming. If you are doing large-scale farming, the level of investment you need in year 1 and how long it takes for it to trickle down before you even break even, it's definitely more than 5 years. Chair, if you look at education sector, the same concept. The level of investment you need for brick and mortar, it's too high to recoup in 5 years. So, Chair, we really beg that, as a committee, you consider this proposal. We retain the status quo as it is right now, and we rather look for other ways of dealing with tax avoidance, if there is any, because of perennial losses.
Chair, our other submission is on
the 150% and the 100% capital allowance that is given to investors who invest in remote places and in SEZs. Chair, devolution has done wonders in this country. And the reason why devolution is working is because for a very long time, we had a centralized regime and resources could not trickle out of Nairobi and out of major cities. Now, devolution brought decentralization, and this decentralization then allowed resources to go down to the people. What this current provision does is it incentivizes and it risks investors to develop in extremely remote places which are very convenient from a sourcing of raw materials perspective. Chair, you will appreciate that we still have a fairly huge poor road network. Electricity is not in most of our interior places, but those are the places where we have raw materials. So to incentivize, to de-risk investors who are willing to move closer to where the raw materials are, we then ought to consider retaining this provision. And Chair, if you look at the downside and the upside, the downside being the tax expenditure that is forgone because of this provision, vis-a-vis what will be collected if we repeal this provision, I still submit, Chair, that the upside is way, way more advantageous to the country than the downside of repealing this provision. And Chair, may I also submit that where we need to repeal some of these provisions that have been there for 2-3 years, Chair, let's please consider a transition provision, because there's an investor who has put in $1 billion, $2 billion, $3 billion because of this provision. Then sadly, 2 years later, we repeal it, we remove it. This investor has just scratched the surface in terms of investment. What are we telling the investor? Uncertainty, unpredictable tax environment, we are chasing away the investor, Chair. Rwanda is chasing after our investors. Uganda is chasing after our investors. Other African countries are positioning themselves to take over our investment. So I really beg that, Chair, we consider retaining this provision for the sake of developing our non-urban areas, our rural areas, and where raw materials are sourced from. Chair, our next provision relates to the proposal to repeal the tax rebate that is currently extended to developers of residential houses. Currently, the law allows developers of residential houses who develop 100 units to enjoy a tax rebate of 15%, which effectively means they pay tax at 50% the normal tax rate. This proposal, Chair, was there last year, and your committee, Chair, had considered dropping it. The finance bill that went to the President that was assented, though it didn't take effect, had dropped this proposal. It didn't make its way to the Tax Laws Amendment Bill of 2024 in December. We find it now. Now, Chair, the President yesterday commissioned a huge project in Kisumu. He'll be commissioning a huge project today in Homa Bay. He did so recently in Nairobi, and he will be doing so very recently, into the future in Machakos. Chair, these are investments that have been developed because of this provision. We are almost achieving our targets of housing because of the incentives that the government has put in place for CIT and VAT. Now, Chair, for an investor who came into this sector of residential housing development, because we add this particular provision, and Chair, they are at 20% completion level or at 30% completion level. What are we telling them when we are retracting this provision halfway? Chair, for someone who has already sold units, because, Chair, you know, most of these developers lately, they're doing what we call off-plan sale. So you already have a contract, price or price for the project, for your apartment, which is pegged on this incentive, because they know they will meet the criteria required for eligibility, and they have priced considering this incentive. Chair, then we are really making it extremely difficult for our investors to operate. And Chair, this is one of the cases where you see very good developments that have been abandoned in Nairobi because the investor, the developer, can't see any good reasons of completing it. It will be a pure loss. He is already committed contractually. He can't change the sale price. So the best thing to do is to abandon the project. So, Chair, we submit that the number of employment opportunities, Chair, that the revamped construction of housing is creating can compensate any tax expenditure from this issue. The contribution it does to Mamboga, who is selling chapati there and food, the contribution does to plumbers, it's a whole ecosystem, Chair. So we submit, Chair, that we consider retaining the current provision as is. At least if, Chair, your committee must repeal this, then we beg you consider a transition provision. You say we're giving 2 years so that anyone who began any project with this in mind, then they can, explore the 2 years to benefit.
Chair, my colleague will take over the next item for VAT.
So on VAT is the proposal to amend the first schedule of the VAT Act, where it seeks to remove VAT exemptions. We are going to touch on 4 key main areas, one of them being goods that are used for construction and equipping of hospitals. So I'll just mention through, then I'll explain on each. So one is the inputs for construction of hospital. The other one is inputs for construction of tourist facilities. The other one being for construction of houses and affordable housing. And lastly, on specially designed local assembled vehicles that's used for transportation of tourists. So, Chair, we humbly request the committee to consider do away with these proposals, as much as there's a transition for 1 year up to next year, June. It will still be a short time for the players or maybe investors in this area to be able to complete the ongoing projects that are going through for these ones. And specifically, if we intend to increase or maybe to charge VAT, consequently, the ripple effect of this is that these additional costs will eventually go to the normal citizen For investors who are in construction of hospitals, so they like to recoup back these additional costs that they've incurred. So these will translate to higher health services to the normal mwananchi. For tourism, this is also a key sector in the economy, where it has also contributed growth to the Kenya's GDP, and we're also looking forward to continue adding more tourists coming to Kenya. So this additional revenue that we're having, so if we are going to charge VAT in the construction of these facilities, consequently it will also lead to increase of either the entry fees and other fees that is charged or comes along with this tourism sector. For houses, that has been covered and previously by my colleague here, and also for locally assembled vehicles. Remember, we are pro Buy Kenya, Build Kenya initiative. So if we tend to impose VAT on these specially designed locally assembled vehicles, then this will put away the players in the tourism sectors and the tour operators to go and start importing motor vehicles from outside. And that's for the investors who have really invested to be doing this local assembling of motor vehicles, then they won't be able to recoup back the investment, and it will also discourage them expanding further with the operations here in Kenya.
Chair, just to buttress that point from my colleague, I just want to place some small context to the aspect of tourism, Chair. Our neighbors are quite keen to take our share of tourists, to attract our share of tourists to their countries. If you look, Chair, Tanzania has really improved their tourism facilities for the last few years. They have gone further to reduce their park entry rates, Chair, in a bid again to try and make it more attractive for tourists to go to Tanzania when they visit East Africa and not Kenya. And of course, Chair, this is not expressed, this is implied, it's by way of conduct, the way they are looking, the way they are doing their thing, yeah? So, Chair, we ought to be conscious that we are in a very competitive region as far as tourism is concerned. And if we are to continue growing this sector, which has been the backbone of our forex, the backbone of our GDP, the backbone of many opportunities of employment, then, Chair, it will be important that our facilities, our hotels, our parks are well done, and the entry fees, the accommodation costs are also reasonable, so that we compete favorably. Thanks, Chair. Fred.
Yes, the next submission is on the changes to the second schedule, which seeks to reclassify the supplies from zero-rated to exempt. And on this, we are going to touch on the transportation of sugar from farms to milling factories, and also supplies of local assembled and manufactured phones, and the supply of solar and lithium batteries. With these are going to, one, for these players in these industries, you see, they're going to not be able to recover on the input they've already incurred. So consequently, as much as it's being exempted, in a way they're going to pass these costs, especially on the input that they incur, to the final consumer, which basically is going to increase the cost of these prices for such items. Yeah.
Yes, Chair, and while on it, our cost of healthcare services, Chair, is still a thorn in the flesh of many Kenyans. Chair, I can confirm that most of you are in WhatsApp groups and in sort of caucuses where you are trying to fundraise for a constituent, for a relative who are overwhelmed by medical bills. And Chair, whatever we need to do as a country to bring the cost of healthcare down, we need to do it both, be it from legislation perspective, be it from policy perspective, it ought to be done. And Chair, at this time then, we cannot have a proposal to reclassify raw materials for making drugs from zero-rated, because then they will automatically be expensive.
we submit, Chair, that your committee considers that. Chair, our next proposal is on excise duty.
You still have 3 minutes.
Thank you, Chair. Our next proposal is on the imposition of excise duty on articles of plastic that are manufactured locally. And this proposal, Chair, is a new proposal to the finance bill of 2025. It's not currently there. So we are submitting that, Chair, you consider having an addition to Part 1 of the first schedule to the Excise Duty Act. And the proposal, Chair, we are requesting for addition or for inclusion is to remove excise duty on articles of plastic that are manufactured locally. And Chair, what wisdom informs our proposal? We need to be protectionist, Chair. We need to protect our local industries. We need to protect our local manufacturers. We need to make it expensive to import that which we can manufacture locally. Any importation, Chair, we make of a finished product is equivalent to 5-10 jobs we've exported to another country. And it's as basic and simple as that. And where we have an opportunity, where we have investors who have invested in a sector, Chair, then we ought to be selfish as a country and protect that sector. And this proposal is geared towards that direction of being selfish as a country, of protecting that which is ours, of retaining local jobs instead of exporting jobs to other countries. And Chair, you will appreciate that 90% of what we consume in the house, if you look, Chair, all this water that we're having is packaged through a plastic container. Everything in the everything that we consume in terms of kitchen stuff, Chair, they are packaged in some plastic. So which means plastic is really a daily affair. We have a concern on the disposal of it, but imposing excise duty on locally manufactured plastic as well as imported ones does not deal with the problem of disposal or of the environment. So even as we deal with the problem of how do we dispose in a manner that we do not affect the environment, we ought to be quite clear that let it come from the local players. Let's protect our employment opportunities in the local space. Let's not exhaust our forex, Chair, because we need to pay for imported plastics. Let's not export jobs, Chair. And most importantly, let's not steal from our GDP because we want to promote other economies. So, Chair, we submit that that proposal be considered by your team, by your committee, and if possible, it be included in the finance bill of 2025. Chair, we have one more proposal, which my colleague can take up, then we close.
Thank you. So the last proposal is, so I'll just combine them into one. So one is on the proposal to grant the commissioner powers to issue agency notice. We feel that the commissioner might misuse that empowerment, so that now they issue adverse agency notices to taxpayers as much as the matter is still before the law. So it needs to allow the taxpayers to fully exploit all avenues that is before them. Before now, they're being both followed up with agency notices. And lastly is the proposal to exclude Saturday, weekends, and public holidays in determination of days to lodge an objection. We feel like this proposal came recently with the Tax Procedures Amendment Act, whereby the taxpayers have not had enough time to fully enjoy this benefit. And we feel that there is no rush to come and repeal it. We just let the taxpayers have all the time so that now they fully prepare accordingly on the matter, on all the tax disputes before them. Yeah, so that's it.
Thank you, Chair.
Thank you very much. Thank you for your presentation. We will consider your presentations alongside others when we retreat to do the final report. So, Santini-san.
Just, Chair, before they leave, I just wanted to ask, they were talking about the tax losses utilization period of 5 years, but they didn't give their proposal. How many years would you think would be okay?
Thank you very much, through Chair. The current position is the taxpayer as it's open-ended.
Correct.
And our proposal is we retain the status quo as it is. And what informs our proposal is because if there is any manufactured tax losses, there are other avenues of dealing with that. Because there is no business set up to make losses. And therefore, if the losses are genuine, we are of the view that they should be carried forward indefinitely. However, if there are expenses that are fictitious, if there are transfer pricing issues that inform the losses, then the tax authority has avenues within the tax law to adjust for those losses and collect taxes accordingly.
Thank you. Any other, maybe Honorable Sonkoya, you can introduce yourself.
Thank you, Chair. My name is Sonkoya George, MP Kajiado West. I'm a member of this committee. Thank you.
Honorable Humu.
Good morning, good afternoon. My name is Omo Kasim. I'm the county MP for Mandela, member of this committee.
Thank you very much. Any other member who wishes to say something?
Chair, on this issue of which has been talked about by my colleague here, I think we need a wider discussion, but otherwise every presenter has been telling us that they need no limit of time. But I think we need to regularize this matter, because why should one venture into a business which you cannot control within time? Anyway, we've been getting proposals that there are some who do capital investments and many other. Well, you've said there are mechanisms, but why should we go to the mechanism while we have a way here we can control? Otherwise, I think it will be a discussion in our report writing. We'll make a decision, but we need more insights about it. Otherwise, why should we leave it without any control? Thank you.
Chair, if I may.
Maybe, you see, there is the business person, and then there is the tax collector. Each one of them has different interests. So maybe in my honest opinion, we need a win-win situation where we take care of what the taxman is saying, and then also we consider the business people. So I would have maybe expected you to say, okay, if not 5, maybe 10 or 7, so that we take care of both sides.
Chair, if I may, we used to be at the position of 5 years, I think up to 2015 or 2017. Then the same was increased to, I think, 10. Then in 2020, we repealed the cap and left it open-ended. And Chair, this was because so many investors had lost their investment, because tax losses are tax asset. It's a tax asset. And there are most of huge investments, Chair, impactful investments, are those that require a huge initial capital outlay. Now, Chair, the honorable member has rightly said, why could you invest in a venture that you are likely to make losses? And Chair, the reason why America today rules the world, is because they have what we call appetite for loss, and they are risked by the government. The government allows you to invest in extremely what you could call risk investments. But then you have a fallback option in form of a fund created by the government to allow you have a soft landing in the event you fall. And Chair, not unless we have that level of appetite and government risk investors, then our innovation will never be as great as America. Our advancement in technology and in unexplored ventures will never be as great as America. So, Chair, I submit. Thank you very much.
Chair, again, this discussion on these perennial losses and carry forward looks like to be a debate of interest because we are fully aware of the nature of businesses that we have. Some of the businesses, common practice on extraction businesses, are of interrelated party transactions. And in that, over interrelated, for good strategy, that's a game theory, the investor would will to sacrifice or to report a loss on the other one to facilitate, and that is good for tax planning, to facilitate the other company, probably is a foreign, maybe the consignor, the conveyor, or the ultimate destiny of the market, especially on mineral, which is common mineral setup. How do we handle that? Because we make a law that is so general, and we end up calculating, providing pilferages through what could be seen as legal tax planning, but then the taxman loses. That would be one of the discussion around here. One of the issues is that intentionally, if you put up a concern, intentionally knowing that it's not going to make, there must be a motivation, because the essence of investment is for growth in wealth and for profitability. So it must be facilitating something. For Kenya to keep pumping money to KQ is because of the brand and because of position in the country, in the region, KQ. That's why government puts as much as it's filing losses, but through exchequer, sustaining it because it has an image to protect. What about an investor for this purpose?
Through Chair, and a very good question. There are cases where taxpayers or investors look like they are not in the business of making money, they're in the business of making losses. But for where there is interrelated transactions or trading, CPA, Honorable, there is Section 18 covers what we call transfer pricing. And ideally, then the Commissioner has all the power to review any related party transactions and make adjustments according to the rules under the transfer pricing regulations. Now, of course, transfer pricing is a very complex topic, but the authority has over time collected a very handsome amount of revenue from adjustments on transfer pricing. But the way I would want to look at it is there are investors who are in Kenya because of strategic footprint in Africa. They invest, just like we could want to have KQ running, though it's not viable economically as an enterprise, but we know that the reason why we have KQ running, despite the huge losses, is because our tourism will be greatly indented or affected if we discontinue KQ. The same way, there are corporations that need Kenya because of their global footprint, especially in Africa. That is just one reason. But the other reason is there are just other market dynamics. For example, South African companies, most of them have come to Kenya, they have done 10 years, they have had to wind up because this landscape has just been too terrible for them to cope up with. Look at the number of retail stores from South Africa that have had to wind up for the last 5 years, 4 of them. So it's really not an intention to come and make losses, it's just also business dynamics.
Thank you very much. Thank you for your time.
Just the last one, Chair, I know time is up. But I just also wanted to know that, I wanted to ask that now that they say, or you say that you shall have many abandoned projects if we repeal the 15% preferential tax rate. There are so many abandoned and stalled projects currently. Do you think it is just because if now the 15% is withdrawn, do you think that is going to aggravate it because we have so many right now projects and yet it is the 15% is on force? So is that really the reason?
Through Chair, and thanks for the question, Honorable Member. It can only, if we, in my view, repeal the current incentive, the situation can only worsen. And the reason why I think it will worsen is because most of these developers have already engaged their buyers through an off-plan sort of arrangement. Now, that off-plan arrangement has already factored in the cost of the project, and in determining the cost of the project, you have already worked with how much corporation tax are you saving at the end of the day, and you have factored that allowance to your project cost. So, most of these investors who have abandoned projects in very prime areas is because they look at the completion of the project vis-a-vis what they intend to collect and the investment remaining for that project. They don't see any profit. In fact, they see a loss. So what do you do if you are in a hole? You stop digging. And that's what they have done. And for you and me, honorable member, who have invested in that project, is like we have put in money and we are not getting a return. And the investor has just abandoned it. And they haven't really frauded us. They're just saying they don't see viability in the project.
Thank you, members. I think we have listened to them, and I believe I'd already said we'll consider some of your recommendations. Please take your leave.
Thank you very much, and we wish the committee a very good afternoon. And you guys are doing a great job. Ongera na eko mingi sana.
Asante sana. Let's have women in real estate. How much issues do you want to address?
1.
So I give you max 10 minutes.
Good afternoon, Chair and members of the committee. Women in real estate.
Please introduce yourselves.
Okay. Women in real estate is an advocacy for women in the built environment, different professionals. With you here is I'm the president, Rachel Patience Mulondo. This is our research and advocacy officer, Esther Wanjiku, and one of the board members, Ano Mufira. So our submission was on the budget allocation for gender-based violence. So Women in Real Estate, the leading professional network championing the inclusion and advancement of women in the built environment, is deeply concerned by the proposed reduction in the national government's budget allocation for preventing and responding to gender-based violence. So this was not captured as gender-based violence.
Maybe I think maybe it's that would go to budget committee because what we are dealing, there are 2 committees in Parliament. We have okay. So let them.
No, but what we are dealing with is the finance bill. So they should be quoting the clauses that they need to be.
Okay.
Chair, under your guidance, let us not harass the beautiful ladies before us.
Okay.
They are looking a way of approaching their point, so let them give background.
Okay, proceed.
Yes, so first, as I was saying, gender-based violence in particular is not captured anywhere in the finance bill itself. And even in the allocation showed, it's the particular amount related to this has not been given. However, in general, the allocation given to the State Department for Gender and Affirmative Action has gone down, and as a result, this will have a trickle effect on the work that has been done to do with gender violence. Gender violence affects women in all sectors, so we've also picked it up as women in real estate because we're also impacted by it in our day-to-day activities. So we were requesting that the issue of it comes at a time when the funding has been reduced, and so now as a country we have to pick it up. We have to budget and consider allocation for it more than we currently are doing. As a result, we are requesting that the budget be restored as it was last year and even be expanded so that we are able to have rising femicide statistics and GBV incidents decreased, investing in prevention, survivor support, and accountability mechanisms, well-resourced prevention programs, proper domestic budget allocations, have more incentives implemented to accelerate, to prevent gender-based violence, to mainstream gender-based violence safety in construction and other industries, not just the construction department, strengthen monitoring, evaluation, and public reporting, and engage industry associations and civil society. It's important to note that gender-based violence is not just against women, it mostly affects women, but men are also affected by gender violence. And with the increasing trends, that is also affecting our economy. It's not a number that is properly allocated to show the losses that the country suffers, but it's something that has to be taken seriously so that we are able to improve cohesion between men and women and see that we have less money going into trying to sort out issues of gender-based violence and instead have that money building the economy. Thank you.
Chairman.
Thank you very much. Honorable Umu, you okay.
Oh, we allow you to just maybe
you have not finished?
For a minute or two, yes.
Okay.
With what your colleague has said, then.
So.
Thank you, Chair, and the committee. So as we are saying, this is not specifically related to the finance bill, but it's related to the national budget. And we felt that it's important to bring this issue up, especially given the rising cases of GBV and femicide that we've been witnessing in the recent months. And so it's just our submission that this be taken up and considered. Yeah, thank you.
Let me give it to Honorable Humu.
Yes, Chairman, thank you for the opportunity, and thank you, the good ladies from Women in Real Estate. We are aware that GBV is a pandemic. It manifests in different forms. I am sure what brought you here is because you also experience it in the real estate market. It's good that you brought it out that we are not handling this issue of budget directly, but we will ensure that we take it up with the budget committee to ensure that issues on GBV is well financed in the budget. Thank you for your time, and as women, this is something that we should lead at the lowest level. Given an opportunity even elsewhere, issues of GBV should be brought out because it's an everyday issue that occurs. But my colleagues felt that this is not the issue we are dealing with at hand, but your colleague brought it out. And it's an issue that we need to fight in whichever spheres we're in. You know, Chairman, when I hear about GBV, I get kind of emotional in whichever way, because this is something that is not well talked about, is not well financed. I'm sure what brought the good ladies here is what is out there that you men sometimes don't understand, that you subconsciously also do.
Point of order, Chair. I
And,
think you need to give guidance.
This is not an issue. Chairman, protect me. This is
I
not
think
an
you
issue
need
that
to
we
give
are
guidance.
opening. You are not given a chance.
I will give
cannot
you time
speak.
to speak.
This is not an issue that this is not an issue that we need to gag whoever is speaking about, whether it is me, whether it is any other person. So you need to protect the good ladies and the lady that is seated over here, the only lady that is here now. Thank you, Chairman.
Chair.
And the other ladies in the... No, I'm not saying the only lady from this other side. I'm the only honorable lady in the committee. But our secretariat, I'm sure, have more ladies than in the committee that who would support me in these issues. So let's not, I also want to indulge you, Chairman, that we should not open a debate on this issue.
Point of information.
Members, I do not want. I do not want emotions here. I want us to stay focused.
There's another lady called Betty Mamaina.
Chair.
In the committee.
Okay. Chair, with your guidance, I think we don't want to debate much on this one, but also we appreciate as a country, Kenya, that we are now in this dispensation of appreciating that there are challenges through gender. As much as it's coming out from women, but sorry to say, even men nowadays are going through a lot of frustrations. But Chair, you may need to guide our beautiful ladies. They have a very interesting topic of discussion, but probably maybe they have missed the committee to present this one. They should have gone to the committee on budget and appropriation. Unless maybe they want to highlight to us that why should you discuss a finance bill to finance a budget that is not considerate of this particular topical issue, which I don't want to believe it's a question of sending signal to us. You know, last year, we had this issue of reject finance bill with a lot of other discussions, especially which was touching on the issue of sanitary pads and what. But probably you may need to guide. But Honorable Humu, you should have picked up yourself to help the ladies here, because I know the budget is yet to be concluded, and you will be in Parliament so that you can represent now when you will be discussing the budget estimates at second reading, so that you can now represent the issues in Parliament, because they are probably agitating issues, but probably now at the wrong forum. Thank you.
Point of correction, member for KSS. We all do it together. The ladies have appeared not to talk to me, but to all of us. So
Thank you.
So when that time comes, we all agitate for that.
Thank you. I think, Honorable Humu, you started very well. Somewhere you started now agitating the other members. But I think the topic before us, I know it's a very topical topic. And maybe the good ladies, there is also a task force which was created by His Excellency the President, I think 3-4 months ago, dealing with gender-based violence. I think it is now functional. That task force is functional. It is also good to approach them and share your views with them. On the question of budgeting, we have heard you. We shall, as Umu said, we shall pass your regards to the budget committee. There is also a committee in social protection. Maybe you should seek audience within the National Assembly, which the issues of gender-based violence is part of that committee. Maybe you should seek audience through the clerk of National Assembly, so that then you can advance. In fact, if you want to succeed in budgeting, you start from the Departmental Committee, which handles matters of gender-based violence. At the very early stages, when we are doing what you call the budget policy statement, that is where you need to engage them But I think I like the way you are doing. You want to seek help from all other quarters. So I think we have heard you. We shall pass the message through the Budget and Appropriations Committee if there is still room to change. But my advice going forward is you start engaging the Social Protection, Departmental Committee on Social Protection, which is the committee that deals with matters of gender-based violence. Otherwise, Asanteni sana.
Chairman, maybe I the ladies felt our body language, but I believe you have not finished your presentation according to what you have submitted here. Your recommendations now I feel aligns with why we are here. Maybe you could tell us on your recommendations.
Thank you, ma'am. So thank you so much for the guidance. I'd also like to mention that we did make a submission and we were directed here, but we are grateful for the guidance and the steps forward. So the recommendations we made are as follows. Implement more incentives to accelerate growth of the construction sector and empower women to transact more business in the industry. Most have already been mentioned by the speakers who are here before us. This includes reinstatement of preferential tax rates for developers of affordable housing, lowering loan rates to alleviate capital constraints, and increased support for local building materials to promote and support local production. I think this is already happening, but can also be increased. Increase the financial year gender-based violence prevention and response allocation. As mentioned, it's not just for women, it's also for the men, and this is costing the economy a lot. Mainstream gender-based violence and safety in construction through mandating gender sensitivity and anti-harassment training in all public sector construction projects and inclusion of gender-based violence and harassment response protocols in contractor performance contracts. Strengthening monitoring, evaluation, and public reporting on gender-based violence expenditure, and engage industry associations like WIRE and others, and civil society in defining the budget priorities, the service standards, and the performance metrics for both the construction industry and the gender-based violence response. Thank you.
Yes, asanteni sana for your presentations.
Thank you.
Whatever recommendations you've given, we will ensure and endeavor to take it forward and consider it. Thank you for your time.
So, asanteni sana. Asanteni sana. Thank you very much. Women in real estate. Thank you very much. We will finish the morning session at UPA. Then we go for lunch. Then we come and proceed with. I hear there is Electric Mobility Association of Kenya and Kenya Flower Council. That will be afternoon. But for now, we'll deal with UPA only. How many minutes do you require, my friend?
Honorable members,
how many issues, first of all?
20. Yeah? 20. I have 6 proposals to highlight. I only require 20 minutes, 20 to 25 minutes.
UPA, you require 30 minutes?
20 to 25 minutes, with your kind permission.
I'll give you 20.
Yeah. Honorable members, esteemed colleagues, my name is John Kiragu. I come from the law firm of Anjawala and Kana, but today I'm here to make submissions on behalf of UBA. Now, honorable members.
Where are your clients?
Unfortunately, they could not join this forum, but they sent me to share their proposals.
Okay.
Proposals we've already shared with yourselves for your consideration. And so I'll take just a few minutes to highlight them. Honorable members, UBA is a household name. It's an unresident platform that facilitates transportation services by connecting drivers to riders. As we began the session, somebody made an honorable member, Mr. Mboni, did make a comment that we all used Ubers to come here. And so he asked that I don't spend a lot of time speaking about the business model of Uber. But what I'll do today here is highlight 6 proposals which touch 2 provisions of the Income Tax Act. These 2 provisions are provisions that we brought into law through our tax laws amendment bill in December of 2024, and we've had about 5 months to work them and see what the pain points are. And so Uber's proposals today are just to do proposed cleanups based on based on the challenges that they are specifically having, but also these are challenges affecting other entities with such business models. Mr. Chair, to my first proposal, Uber is requesting for a harmonization of their non-resident, their VAT and SEPT obligations with their withholding tax obligations. Specifically, Mr. Chair, if you remember, and on the last day of the public participation last year, I had the incredible opportunity to appear on this provision. We did introduce a withholding tax, a new withholding tax provision that is supposed to cover non-resident platform owners who are facilitating services and goods over digital platforms. Now, in its application, the withholding tax timeline for the withholding tax timeline under that specific provision is that non-resident platform owners are required to withhold and pay to the revenue authority the monies that they've withheld within 5 business days. Now, what is the challenge with this provision and what is Uber's ask? Uber's ask is we harmonize this 5-day timeline with the other obligations that they have in country. This has to do with their VAT obligations and their SEPT obligations, both of which have to be remitted before the 20th of the next succeeding month. Now, the reason they request for this proposal is so that they can to reduce the compliance burden, because as you can appreciate, on each and every day, non-resident platform owners have thousands and thousands of transactions. So it's becoming increasingly difficult on a daily basis, including Saturdays and Sundays, or rather on a daily basis to comply. So this proposal is really just meant to harmonize the timelines for the withholding tax obligations together with their VAT and SEPT obligations, so that all these are done on the same day.
Proceed, we have made a point on that.
Thank you. Thank you, Mr. Chair.
Don't overkill.
Sorry?
Don't overkill the point.
Yeah, no overkilling from me. Like my clients' rides, I'll keep them short and sweet. The second proposal still relates to an amendment to the withholding tax regime. And what Uber is requesting is a clarification on the cost base within which this withholding tax provision applies. Now, sorry, Mr. Chair, maybe if I could go back to my previous proposal, following guidance from last year's public participation.
Maybe before we proceed, I think we have had consultations with members here, and we have agreed that we will listen to Electric Mobility and Kenya Flower Council after Uber. I hope they are here. So you are not there?
Come over here.
You want to make a presentation now or in the afternoon? Okay. Where is Electric Mobility? Electric Mobility, are you here?
Yeah, very good, sir.
You can speak through this one.
Thank you. My name is Dedan Shadrach. I come from the same law firm as my colleague, Anjarwala Nkana. Even though we've registered to make our submissions, our schedule is that we propose to make 2 submissions first thing in the afternoon. That's when my...
So you are not ready for now?
Yes.
So after Uber, we'll go to Kenya Flower Council and then we adjourn.
Thank you, Mr. Chair.
Okay. So proceed.
Thank you, Mr. Chair, and thank you for your guidance. As I was noting, is that we've proposed some language that this committee can consider, and you'll notice that this language only provides for an exemption for the withholding tax obligations that we introduced last year, because these are the only withholding tax obligations that are onerous. So that's the only thing that's the only exemption we are proposing. Second to that proposal, Mr. Chair, we are proposing that a clarification be introduced to clarify the cost base upon which the withholding tax that we introduced last year, on the cost base on which that proposal applies. Now, Mr. Chair, you might wonder why is this a challenge, yeah? Non-resident platform owners like Uber and Bolt, at the point when you make a payment using your card, the money that is ultimately remitted to the Uber driver is usually net of the commissions and service fees that are due and payable to Uber. Now, these service fees and commissions that are due and payable to Uber and Bolt and other such business models is monies which we tax under the SEPT regime. But you see, in relation to this withholding tax, it's unclear whether we impose the withholding tax on the whole payment or on the net payment that actually goes to the driver. So our clarification and our proposal here is that the withholding tax that withholding tax under Section 10(4) is clarified to state that it applies on the net payments that are paid to the drivers. And Mr. Chair, we've also proposed some language that will help clarify the provision in this respect. Honorable members, our third proposal is still on this withholding tax regime under Section 10(4). And under this proposal, we are humbly requesting for the exclusion of the withholding tax regime that we brought in last year so that the same only applies to non-residents and does not apply to residents. Now,
maybe on that, because the law says to non-residents.
The law says both residents and non-residents.
So what is the clarification? Because what we pay to Uber, the net amount we pay to Uber is, then the rate should be the one for non-residents.
Yes.
And then if it is a driver's, the law is also clear.
Yes.
And the rate.
Yes.
So
perhaps I could guide better.
So what is the clarification you want?
Thank you, Mr. Chair, for your question. The law as is currently drafted, the withholding tax regime we introduced last year in December applies to both resident and non-resident platform owners. So if I'm a resident and I'm or a non-resident platform owner, every time I make payment or I facilitate a payment to somebody here in Kenya for services that are being provided over a digital marketplace, then I'm required to withhold. So it applies to both the resident, the withholding tax obligation is on the non-residents and residents. The request here is that the same only apply to non-residents, so that the withholding tax obligation only applies to the non-residents. The reason we request for this proposal is because with the current drafting of the law and noting that the resident platform owners in country, we have sight of all the revenues they are making and all the payments that they make in country, then this withholding tax regime has now just increased the compliance burden for the resident platform owners. And in real sense, Mr. Chair, if we do this, we don't lose any revenue. So the clarification here, the proposal here is that this withholding tax regime applying to platform owners only applies in respect of non-residents. Mr. Chair, our fourth proposal has to do with the clarification of the term property. Now, as the law is currently drafted, the withholding tax regime we introduced in December applies in respect of both services and property that are traded over a digital marketplace. So this means that every time we have a non-resident platform owner or a resident platform owner making payments for goods or property over a digital marketplace, then they are required to withhold. Now, in relation to services, it's clear what that withholding tax relates to. In relation to property, it's unclear, and here is why. The term property has not been defined under the Income Tax Act. So taxpayers are currently being forced to look at the interpretation of General Provisions Act. And when you look at that provision, we then see an absurdity in the application of the law. Because the term property under the interpretations of General Statute Acts includes cash, includes real estate, it includes land, it includes money, it includes every description of estate, it includes interest, it includes profit. Now, when you think about it that way, it's almost as if it looks like we are saying we are imposing a withholding tax obligation on land. We're imposing a withholding tax obligation on profit. A withholding tax obligation.
Doesn't it say whatever has been traded through the platform?
Pardon?
Whatever has been traded within the online system?
Yes.
I thought it is very clear. So that if you sell a car using that system, yeah, whatever you pay, whatever the car owner pays you a service fee, that is what should attract withholding, not the price of the car.
That is true. So it applies in respect of goods and services traded over a digital marketplace. So on that point, Mr. Chair, you're 100% correct. But here is the challenge. This item property is what remains unclear. Because
it is saying property traded in the platform.
So then the question then becomes, for example, if you make a profit over a digital marketplace, are we then saying we are imposing a withholding tax on that? If, for example, it says easements. If there's an easement that has been transferred over a digital marketplace, is then the intention to charge a withholding tax on that? When we think about profit, are we then saying we are imposing a withholding tax on that?
And so, I will ask our legal officer later on to check for us also.
Yeah, I think, Mr. Chair, the problem is, the question we are asking is, we are just asking for a clarification. So if at all the intention is to subject land to withholding tax, that is land or interest traded over a digital marketplace, if that's the intention, then our proposal is then we make it clear by incorporating that definition in the Income Tax Act. So that then taxpayers are...
So can you give us now, what are you proposing?
I think, Mr. Chair, for this specific provision, we did not propose a definition. And the reason we did not propose a definition is because it's not clear to us the legislative intent on this term property. So we've left it to the drafters of the law to guide us.
Okay.
Yeah. But I think upon your request, Mr. Chair, we can perhaps ruminate on a definition of this term property and provide some wording for your consideration.
On general rule, what is the meaning of the word property? I would ask what, in terms of any other definition, especially in relation to copyrights, what is property in relation to assets, whatever assets, the physical assets, soft assets, anything that carries monetary value.
Yeah.
Yeah. What is property to you?
So that's the challenge. I think that you've got it right. That's the challenge that all taxpayers are grappling with. Because if you look at the definition that has been put under the interpretation of General Statutes Act, it's an all-encompassing definition. So it says it includes goods, it includes interest, it includes profit, it includes land. So it's an all-encompassing definition which covers each and every other thing, every asset that you'd think on this.
Plus virtual asset, because we are now doing a bill on virtual asset, is also a property.
Per the definition of the interpretation of general statutes, yes. And now this then brings what we are pointing out is a cleanup which is required. We need to ask ourselves, for purposes of the withholding tax regime that we introduced in December, do we want to, for example, capture digital assets that we're already taxing under a different regime? Do we want to capture interest, which is subject to withholding tax under a different withholding tax regime? And that's the clarification we are requesting for.
Okay, can you make progress?
Mr. Chair, the last two proposals relate to the SEPT provisions that we introduced as well. Now, if you remember, Mr. Chair, I also had the incredible opportunity in the last day of the public submissions to make submissions on this issue. And our client this provision having been in operation for about 5 months now, we proposed the following 2 cleanups. And for purposes of this submission, I want to begin with our point number 6, then come to point number 5. On point number 6, Mr. Chair, in the course of last year, we introduced a section 23A3A of the Tax Procedures Act. And what we did with this provision is we said that if each and every time I, as a purchaser, am dealing with a small trader, a small business person, or a farmer, the requirement to generate an invoice, an ITIMS invoice is on me, the purchaser, i.e. to self-invoice. Now, in relation to the ride-hailing business, if you took an Uber today, coming to this space, like I did, a reading of that provision says that I am the one to generate an invoice and invoice the driver. So therein lies a challenge, a compliance challenge, because by the application of this law, what we are requiring is that all customers of Uber, all customers of such ride-hailing apps to self-invoice, because the drivers in question would qualify as small business owners by virtue of the fact that they fall below the 5 million threshold. So you can already see there is a compliance challenge here, not only for our client Uber, but for all the other people who are doing ride-hailing services, but importantly, also for the customers like me and you, who, for example, want to have an ITIMS compliant invoice for purposes of using it to deduct the expense. So what have we proposed in this regard? We do understand the legislative intent of introducing a reverse invoicing regime, and we do understand the reason why we want to exempt small business owners and farmers from having to issue ITIMS invoices. But when it comes to the ride-hailing part of the business, then it sort of becomes even more difficult, because that then now means every time you complete a ride, you not only have to pay your driver, you have to log in onto your KRA, ITIMS, generate an invoice and issue the driver. So it's a catch-22 there, and to date, many customers have not complied. And so our proposal here in respect of this is that then an exemption is provided for ride-hailing transportation services. So that for ride-hailing transportation services, there is no requirement to generate an ITIMS invoice. And then the last thing I want to say in relation to SEPT, which is our proposal number 5, is that the provision has been the SEPT provisions have been in operation for about 5 years, and our client takes judicial notice of the idea to delete this term turnover, and they have nothing to say in relation to that. But what we do note as Uber is that since we've brought in this new SEPT regime, no regulations have been issued. And regulations are going to be important because even in its application, even the application of the SEPT regime, there are so many other things that remain unclear. So for example, if we say turnover, what exactly do we mean? Do we mean turnover inclusive of taxes? Do we mean turnover in country? Do we mean turnover of the whole business? It's not clear based on how it's drafted on the law. It's not clear how the income becomes subject to the SEPT regime. And by this I mean, if you look at the previous regime, the DST regime, we had provisions that told us, for example, what constitutes a payment, what constitutes a service that has been rendered in Kenya. And there are simple issues that we need to think about that we can clarify in the regulations. So our ask is for this esteemed committee to take judicial notice that 5 months in, we still don't have regulations. So it's becoming a slight challenge for taxpayers to comply, and our request is that this esteemed committee initiates the process of regulations, that we've sent out some 6 issues that we propose that to be considered. for purposes of the SEPT regime.
Thank you. Is there any member interested in? Okay, thank you very much for your presentation. We shall sit and consider.
Thank you, Mr. Chair, and I hope all of you guys, whoever came with an Uber, has a safe ride home.
Thank you very much. Thank you very much. So we now have Kenya Flower Council. You may wish to move to this. So please introduce yourselves.
Good afternoon, Chair. All protocols observed. My name is Catherine Mukoko, Chief Operations Officer at the Kenya Flower Council.
Good afternoon, Chair. All protocols observed. My name is Ruth Kagwiba, Finance Manager, Kenya Flower Council.
How many issues do you want to prosecute?
5. Very brief.
15 minutes.
Okay. First of all, allow me to just talk briefly about who the Kenya Flower Council is and what we do. Currently, Kenya ranks among the world's leading producers and exporters of cut flowers and is a cornerstone of this economy. We are the fourth largest global exporter of cut flowers and ornamentals. And the industry is a vital source of foreign exchange, employment, and rural development. Floriculture contributes 1.6% of Kenya's GDP. We generate about 110 billion annually. 72% is horticultural exports. We directly employ over 200,000 workers and support an additional 1.5 million in direct jobs in logistics, packaging, and ancillary services. We, as the Kenya Flower Council, represents the interests of the flower sector, and our submission today is to give proposals that seek to promote competitiveness, ease of doing business, and sustainability in the flower export industry, which is a major foreign exchange earner and employer. So our first issue is a repeal of excise duty on packaging material. Materials such as test liners, fluting paper, and imported carton boxes are subject to multiple layers of excise duty under Section 14 of the Excise Duty Act. Our proposal is we remove this excise duty on test liners, fluting paper, and imported carton boxes, or alternatively, draw an input offset mechanism for excisable packaging materials used in the production of finished goods. Our justification is excise duty is a consumption tax that is intended for the final consumer. Levying it at intermediate production stages increases our production costs and renders Kenya's exports uncompetitive. Other justification is it also aligns with global best practices and which are necessary to maintain our position in the global floriculture industry. Currently, the sector imports for use in export and not used locally. So whatever boxes we use come from recyclable material, which is very expensive here. The manufacturers of this recyclable material, it's expensive and it adds a cost for us if that can be considered. Our second request is on reclassification of agricultural products from zero rate to exempt. This reclassification is critical for agricultural inputs, especially your fertilizers and crop protection agents. Our proposal is to reinstate zero-rated status for all agricultural inputs. Our justification is that the exemption prevents farmers from claiming VAT input, thereby increasing their net costs of production. and negative impact on cash flow and production viability for thousands of farmers. Our third issue is on VAT refund timelines and fund allocation. Our proposal, the issue is a proposed reduction of bad debt threshold from 3 years to 2 years. That's the issue. Our proposal is to establish a dedicated VAT refund fund to address the refund backlogs. Justification for this request is many of our flour farms are owed VAT refunds in billions of shillings, and these current delays create persistent negative VAT positions, and they harm cash flows and business operations. Our fourth issue is on the export and investment promotion levy on inputs. The 17.5% applies to critical imports, and craft paper and packaging materials. Our proposal is reduction of this rate to 5%, or if possible, abolish the levy altogether on these inputs. Our justification is the levy causes input inflation and double taxation. It directly affects pricing and competitiveness of floricultural exports. Our last issue is on legacy VAT refund claims from the credit adjustment vouchers. The issue for us is that businesses remain in a refund position even after applying for old CAVs pre-June 2019 due to the zero-rated supplies. So our proposal is an introduction of a legal mechanism to facilitate clearance of the backlog. The capital here can reduce the cost of financing the sector and expand farms, improving research and development. Justification, the CAVs serve as a confirmation that the government owes the industry money. So outstanding CAV-related refunds also distort the tax position, and resolving these legacy cases will improve business liquidity because currently industry has to borrow money to pay government, in the sense that we have to pay for VAT on the inputs. We don't have the cash, we have to get financing somewhere for that to be effected. So our request is we urge the National Assembly, yourselves, and the Treasury to consider these proposals in support of a more competitive, tax-efficient, and sustainable business environment for Kenya's floriculture sector.
Thank you very much for your presentation. Members, do you have, okay, Roboruto?
Thank you so much for very brief presentation and very straight to the point. You have requested the timelines on launching VAT refund from 24 months to 12 months. Already you are saying, as it is right now, the sector is owed a huge, colossal amount of money.
Absolutely.
So your request against the reality on the ground, how do you match? Do you want to imply that the taxman is deliberate not to release the money, yet the taxman has the money? The other question is on the bad debts threshold from 3 years down to 2 years. What is the reasonable period employing due diligence to follow up on debts? Because even when it comes to a matter before court, you must demonstrate that you want that again due diligence before you are allowed to write off the bad debts. So what is the reasonable period? Because if you say 2 years, what basis can you say a debt has gone bad in a period of 2 years for you to warrant get advantage of tax redemption from that? Thank you, Chair.
Thank you very much. Where do you import these cartons, the packaging cartons?
Where?
Where do you import them from?
From various sources, because the farmers deal directly with different countries that can, so directly with different countries that can give it to them. The thing is, for us as we import, we also have, for example, EU regulations that we have to adhere to. So they are very specific that we want packaging that can be recycled, So we are really bound by that, hence our request for support. That way, if that is done, it means even the local industries will be supported, because I know there are a couple of people or manufacturers that are dealing with that, but the cost for them is expensive, which they in turn pass on to the growers, you know, as a cost. So getting it from outside is cheaper for us. So that
and as you're responding, you've given a lot of prayers. I wanted to know whether you have a case study on the sector, both regionally and internationally, so that while you are praying, how is the issue of export investment levy and exercises undertaken in the other countries that are party the same market with Kenya?
Yes, we can provide that information to you. We currently benchmark against Ecuador and Colombia, because after the Netherlands, they are the number 2, number 3, Kenya ranks as number 4. Colombia has been successful because of the favor, you know, and exemptions that they've received, so that the sector continues to flourish. So we can provide that information to you on what they have done and what we need to do as a country so that we can get to that level. You talked about due diligence on bad debts. Because the process takes long, if we say 1 year, probably it will not be enough. 2 years is reasonable time for all due diligence to be done, everything factually, to make sure that we are okay.
Laziness.
No.
In the business, now that there is an opportunity we are making for ourselves through tax, so that why waste time writing letters, going to court, and there is tax benefit you can derive.
1 year then will be sufficient. We will rewrite this, we put it at 1 year. He asked about something else. You had asked something else on...
The refunds you're saying, it be brought down to 12 months against 24 months, against the reality, the real situation, that you are owed a lot of money. So which one is practical for you?
We stand to be guided by you, because it's an issue we've been following up on for a very long time. And it moves from KRA saying they cannot cap because it depends on National Treasury. KRA may be able to refund us if National Treasury is able to increase the capping amount on VAT refunds. So that is where the stalemate is.
If
I can come in, unfortunately, when then we bring the issue exemption, the production cost goes high, because at least with the VAT having an input and output, then at least the movement is still happening. So it being exempt, then the cost of production goes higher.
Which one is the better level? Is it
the better level is reinstated of reinstation of zero rated?
No. Yeah. I ask about the 2 levels of exemption or normal VAT position.
Both are biting, and I think the big thing, especially on VAT refund, the big issue has been on the capping, because why then we would want the extended period, because within the short period then we will really
no, I think we were at the position of exemption vis-a-vis the normal tax position, standard 16%. Which one is the better level? The zero rating is the angel.
Yeah. Yes. But it's easier.
You know, the other day, reports indicated the tax expenditure has grown almost 500 billion, almost equivalent to budget deficit. and we still from the sector requesting that we sustain the same scenario, and it's unbearable. So if we exempt, you're saying it is becoming expensive. Now the chairman is asking, what if we standardize? Would it be better?
Or
if you don't
it
have
can be standardized or reduced on some items. For example, the fertilizers. So instead of capping it at 16%, there could be some provision on some items having a lower VAT.
Preferential rates.
Yeah.
Okay.
Yeah.
Maybe something we can discuss. We can consider, but
okay.
Like we used to have 8%. Was it 8% for fuel?
Yes. Yeah. Yes.
For you to trade on a cheap business environment, so you report the profit, but the actual cash is tied somewhere with commission.
I think that's a very good point, because the truth, where it bites heavily, is the cash flow aspect that the industry has to go even to the bank to finance. So that's heavier, because if we can be able to have something to sort this bit so that the payments are given back, then both cash flow and investment is given back to the industry.
Thank you. I think we have heard, unless there's anything you have not mentioned.
No. Okay. We'll make sure they are
delivered. Flowers here.
We'll make sure they are delivered to you. We didn't know how many people would be here. But we normally work with flowers.
Thank you very much.
Thank you too.
From here, we adjourn for lunch break. And then we resume again at 3 p.m. 3 p.m. So this meeting stands adjourned until 3 p.m. The rest of the presentations, we'll hear them in the afternoon, 3 p.m. and beyond.
told us that by February this year, they are going to come up with solutions to pay pending bills. And you see, this refund.
And Chair, if you look at the downside and the upside,
how much?
A couple of people or manufacturers that are dealing with that, but the cost for them is expensive, which they in turn pass on to the growers, you know, as a cost. So getting it from outside is cheaper for us. So that
and as you're responding, you've given a lot of prayers. I wanted to know whether you have a case study on the sector, both regionally and internationally, so that while you are praying, how is the issue of export investment levy and exercises undertaken in the other countries that are party the same market with Kenya?
Yes, we can provide that information to you. We currently benchmark against Ecuador and Colombia because after the Netherlands, they are the number 2, number 3, Kenya ranks as number 4. Colombia has been successful because of the favor, you know, and exemptions that they've received so that the sector continues to flourish. So we can provide that information to you on what they have done and what we need to do as a country so that we can get to that level. You talked about due diligence on bad debts. Because the process takes long, if we say 1 year, probably it will not be enough. 2 years is reasonable time for all due diligence to be done, everything factually to make sure that we are okay.
Laziness.
No.
The business, now that there is an opportunity we are making for ourselves through tax, so that why waste time writing letters, going to court, and there is tax benefit you can derive.
1 year then will be sufficient. We will rewrite this, we put it at 1 year. He asked about, there's something else. You had asked something else on...
The refunds you're saying, it be brought down to 12 months against 24 months, against the reality, the real situation, that you owed a lot of money. So which one is practical for you?
We stand to be guided by you because it's an issue we've been following up on for a very long time. And it moves from KRA saying they cannot cap because it depends on National Treasury. KRA may be able to refund us if National Treasury is able to increase the capping amount on VAT refunds. So that is where the stalemate is.
If
I can come in, unfortunately, when then we bring the issue exemption, the production cost goes high because at least with the VAT having an input and output, then at least the movement is still happening. So it being exempt, then the cost of production goes higher.
Which one is the better level? Is it?
The better level is reinstation of zero rated.
No. Yeah. I ask about the 2 levels of exemption or normal VAT position.
Both are biting, and I think the big thing, especially on VAT refund, the big issue has been on the capping, because why then we would want the extended period, because within the short period then we will really
no,
lose.
I think we were at the position of exemption vis-a-vis the normal tax position, standard 16%. Which one is the better level? The zero rating is the angel.
Yes.
But it's
easier.
You know, the other day, reports indicated the tax expenditure has grown almost 500 billion, almost equivalent to budget deficit. And we still, from the sector, requesting that we sustain the same scenario, and it's unbearable. So if we exempt, you're saying it is becoming expensive. Now the chairman is asking, what if we standardize? Would it be better?
Or
if you don't
it
have
can be standardized or reduced on some items. For example, the fertilizers. So instead of capping it at 16%, there could be some provision on some items having a lower VAT.
Preferential rates.
Yeah.
Okay.
Yeah.
Maybe something we can discuss. We can consider, but
okay.
Like we used to have 8%. Was it 8% for fuel?
Yes. Yeah. Yes.
For you to trade on a cheap business environment, so you report the profit, but the actual cash is tied somewhere with commission.
I think that's a very good point, because the truth, where it bites heavily, is the cash flow aspect that the industry has to go even to the bank to finance. So that's heavier, because if we can be able to have something to sort this bit so that the payments are given back, then both cash flow and investment is given back to the industry.
Thank you. I think we have heard, unless there's anything you have not mentioned.
No. Okay. We'll make sure they are
delivered. Deserve flowers here.
We'll make sure they are delivered to you. We didn't know how many people would be here. But we normally work with flowers.
Thank you very much.
Thank you too.
From here, we adjourn for lunch break. And then we resume again at 3 p.m. 3 p.m. So this meeting stands adjourned until 3 p.m. The rest of the presentations, we'll hear them in the afternoon, 3 p.m. and beyond. maybe you need to find your, okay, let them finish and then you can find your way here. So we'll start with the electric mobility. How many issues do you want to prosecute, Mr. Daniel?
Honorable Chair, we think we need maximum about 30 minutes.
No. No. How many issues, first of all?
We're talking about the current changes to the finance bill, and we have some gaps that we also want to bring into play. But we'll be grateful for that opportunity.
Okay, I wanted to give you 15, but now, since we have negotiated, I'll give you 20. And this time we are very strict. We put your minutes there. So how you use them is up to you. Thank you. Proceed.
Thank you very much, Honorable Chair. Good afternoon to the members today. What we will do is that we will give you a bit of a background as to electric mobility. I will be requesting the chairman of the Electric Mobility Association, who is here with me.
Maybe the way we are doing in the morning, you can introduce yourself.
No problem.
As a group here.
Yeah. So my name is Daniel Ngumi. I am, in this case, coming as a legal counsel from ELN supporting the association. I am joined by my colleague here, Caleb, and I will ask the chairman to introduce his team.
Good afternoon, Chair. My name is Hesbon Mose. I'm the president for the E-Mobility Association of Kenya. And for the sake of time, I'll introduce my team. On my left is Ignatius.
Let them introduce themselves.
Oh, okay.
Good afternoon, Chair. My name is Ignatius Maranga, a member of the E-Mobility Association of Kenya.
Afternoon, Chair. My name is Samuel Kamunya, a member of AMAC.
Okay.
Afternoon, Chair. My name is Elijah Odur, also a member of EMAC.
Okay. Tuendelee.
Chair, as we begin, there was a presentation. I think there is the written submission, but we wanted to set some context, so we will request that they put up the PowerPoint very quickly, just for purposes of the explanations we need to give. But I will ask the chairman to give the background for the first 5 or so minutes, and then we will then move to the other issues to do with the submissions. Thank you.
All right, I'll go ahead and start to give some background. I think this is our third year presenting. Started in 2023 to now, as we keep on presenting to Parliament, we get experience based on your feedback. We keep on improving our presentation and more guidance based on your feedback. So we wanted to put some context into e-mobility status in Kenya so that we can set pace for our submission. We had a presentation, but I guess it's not working. All right. First presentation is just to give a background in terms of the vehicles in Kenya. Today we have about 3.8 cumulative vehicles in Kenya. 3.8 million vehicles in Kenya. Out of that, 0.2% are EVs. In the last 7 years, we only have 0.2%. I'll insist on that number. From that 0.8%, 88% of the vehicles registered last year were imported. 88% were imported, and these were mostly ICE, obviously, and locally assembled were about 10 to 12% of that number. I guess from an EV perspective, the primary competitor for local assembly is actually the second-hand imported vehicles, which cover about 88% at this point. To give you a perspective in terms of statistics, EVs, the numbers that we have in 2018, we had 65 registered EVs in the country. Once we got to 2023, when we presented to Parliament, we were able to get some incentives on EVs. The following year, we had 4,047 registered EVs. And from that 4,047 EVs, 2,557 were motorcycles. Buses at that point were 18 buses. And last year, to fast forward, we had about 4,800 motorcycles registered last year. and buses were 32, showing an increase between 2023 and 2024 based on just the incentives that we received that year. And a key metric on that, when you look at passenger vehicles metric, is basically we started with 11 vehicles in 2018. After the incentive, we jumped from 3 in 2022, it was 18 in 2023, and 32 last year. And most of these passenger vehicles are actually commercial vehicles, because EVs are significantly expensive. I think it just makes commercial sense for the Ubers and the Bolts to actually get the EV vehicles. When you look at the global trends, in 2022, those are the numbers that we have. US had about 8% market share of EVs in the country. China at the time had 29. Last year it was 50%.
I think, Mr. President, that should be enough for background. Let's now move to finance bill.
The 20 minutes will... Are you still sticking on 20 minutes?
I'm seeing already you are almost 7 minutes.
It's okay. That's okay.
Okay. We will get another time so that we discuss those matters.
Okay, that's okay. Thank
when
you.
we have a lot of time. For now, let us focus on issues that are on finance bill.
Chair, if I may then talk about the document that you see on the screen. I hope that you also have it in front of you.
Yes.
The reason why the president of the E-Mobility Association was giving you that background is because these tax changes came into force in Finance Act 2023. So they've been in force for only 2 years. But in those 2 years, there was a very good statistic that I think he has mentioned.
Correct, yeah.
That the e-mobility vehicles have significantly increased in the market. In fact, from what he can say, is that the changes have effectively allowed for doubling. But even though doubled, you only really have only 0.2% of all vehicles in Kenya are EVs. So they have doubled from a very low base, from literally 0 to 9,000 of them. But those 9,000 of them that are there now on our roads are nothing in comparison with the 3.8 million vehicles that are on our roads today. So he was laying that background because we wanted to bring to the committee's attention two critical things. The first critical thing is that the provision that has been proposed in the law seeks to move the supply of electric motorcycles, that's the first change you see there, clause 36(0) of the finance bill, from zero rated to exempt. We propose that that change is not effected. Effectively, it remains zero rated for the following reasons. The first one is that the law only came into force 2 years ago. And we fully understand that the government's policy is that you consistently retain, to the extent possible, the provisions of the law for the time that they apply, and you do not necessarily need to change it from time to time. The second reason is that when you look at how these obligations for Kenya on greening our economy and also greening, meeting our obligations, it is critical that we allow for this to grow. It is the future of the whole world. There's a move and a shift towards EVs, and we believe that by doing this change, it will discourage the growth of e-mobility sector, the uptake of EVs, and particularly for local assembly. We think that it will be quite damaging for local assembly, and we believe that local assembly is really the way to go. We can tell you, Honorable Chair, that particularly in the two-wheel sector for motorbikes, literally 98% of all motorbikes you see today in electric motorbikes, which are being used by Uber, are locally assembled. So the effect of this change is that it is actually going to be damaging local assembly, and we believe that this is not something that should be done. We also think that it will discourage investors who have brought in considerable foreign direct investment in this area. As you know, in the presentation which has been shared with you, today you have about 4 or 5 companies, Spiro, Ampersand, a number of them, all of whom are now going to do local assembly. They came into Kenya knowing that the law provides for zero-rated status. Shifting it to exempt will will have a damaging impact. And we think that this is an nascent area that should be encouraged. And we think that it's an area that should really be given these incentives and rather than discouraged. So Honorable Chair, if you look through the presentation we have given you, and I'll ask the gentleman to scroll down, you will see that most of the changes we have proposed under clause 36O, we have talked about electric motorcycles. There is electric bicycles which are being moved from zero rated to exempt. If you continue, you have the lithium-ion batteries, which are being also moved under paragraph 161 of part 1 of the first schedule, also proposed to be moved from zero rated to exempt. And also the buses as well, buses under tariff heading 8702, they are being proposed to be moved from zero rated to exempt. We think that it is a premature move, particularly when you think about the fact that only 0.2% of all electric vehicles, of all vehicles on our road are electric. And if this status is retained for a longer period of time, you will see that that move will significantly enhance and allow for Kenya to move to, in accordance with its global obligations on climate change, and also will go a long way in terms of changing what we see in the area of job creation and investment. So, Honorable Chair, what we have then done in the presentation, and I note we now have only 9 minutes, is that we have made the second set of our presentation, and I will ask the gentleman on the slide to move to page 11 to talk about the new changes. So if I may really summarize the gist of the first set of the proposals, is that we are actually seeking for retention of the current status. The current status is it's zero rated. We're requesting that you retain that and don't move it to exempt, particularly because this change only came into force 2 years ago in 2023, and for all the reasons that we have set out in the paper and which I have explained. But there are gaps, and the second set of the presentation deals with those gaps. So the key thing to bear in mind, Honorable Chair and Honorable Members, is that today as we speak, there are incentives that cover bicycles, there are incentives that cover motorbikes, two-wheelers, there are incentives that cover buses. But there is the middle area, which is, I will call it the silent middle. And the silent middle deals with passenger cars, it deals with tuk-tuks, it also talks about medium and heavy-duty EVs. There's also a gap when it comes to EV components and local assembly of EV components, particularly those that deal with semi-knocked down and completely knocked down kits. What we are asking for is for you to consider giving the same treatment that has been given to two-wheelers, which has been given to buses, to be given to this category. And there is a reason for it. I will explain as follows. In that presentation that has been just given, one of the things, and I wish you could have seen it, but one of the things that was critical for you to note is that of all the motor vehicles that we have today, which are electric, last year there were only 45 cars, which are used, passenger cars that are used by individuals, only 45 of them.
Which slide is that? The one that shows the statistics?
It is in the PowerPoint which has been submitted. The first one.
Okay.
Yeah. There were only 45 electric cars in the whole country that were being used by passengers. Now, in 2024, they moved from 45 to 123. But you can imagine in a country which has 3.8 million vehicles on the road, there are only 123 vehicles which are on our roads that are electric. And these are the ones you're seeing now, Bolts and Ubers being used. Individuals who have cars are very few. The government, and I heard the president say this, is that he's hoping that the government can order 3,000 electric vehicles. But more than that, even beyond what the government can buy, the reality of the matter, Honorable Chair, is that in 10 years' time, there are countries that will completely have switched to electric. So if we joke, as a country, we'll become the dumping site of second-hand used vehicles, because the rest of the world will be looking for African countries that are not progressive. The change, in order for us to spur on the whole ecosystem of electric vehicles, needs to happen now. And what I mean by that, Honorable Chair, is that you need, for example, people who will learn how to repair electric vehicles. You will need people to invest in charging infrastructure throughout the country. They cannot do so, Honorable Chair, with 123 vehicles only. 123 vehicles is not enough demand for someone to put charging infrastructure from Mombasa to Nairobi. You need these vehicles to be more than those in order for them to be able to create the demand for everybody else to come and say, I want to make my investment, and if I make my investment, I will then be able to allow for, I know I have the market for electric vehicles to repair them, to basically charge the roads and the network. So what we are suggesting and really proposing, Honorable Chair, is that unless we change the law, in order for us to incentivize in the same way we have done for these other vehicles. Now, we're not asking for this as something that is exceptional. And global statistics show that when you have such a small base, only 123 vehicles out of 3.8 million, if you want to incentivize Kenyans to buy an electric vehicle, you need to at least consider that they need to be given a way that they are going to even the playing ground. Saying the real competition, Honorable Chair, is actually the second-hand vehicles that are coming from Japan. So today, if you try to buy a brand new electric vehicle, you will find that the cost of an electric vehicle that is brand new in Kenya is nothing in comparison with the second-hand vehicle that is being brought in from Japan. And if you look long-term, the point that I'm still making is that we have to prepare for a future where Kenya is going to be competing with the rest of the world for electric vehicles, and we need to then allow for that ecosystem to grow. So the provisions, the proposals that you will see, going on to page 13, page 14, page 15, and in the interest of time, I know we only have a very short time, and I'm also anticipating there might be either additional comments or follow-ups from yourselves, is to deal with each of those provisions. We have first dealt with EVs for three-wheelers, that is on page 13. What we have proposed is for zero rating and excise duty exemptions, which is the same that has been offered to the bicycles and the motorbikes. On page 14, honorable members, we're now dealing with EVs, four-wheeler passenger cars. This category, I dare say, is critical, because if we do not think about this, we will not be able to get the numbers that we need for vehicles on our roads. Rwanda is doing it. Uganda has even gone so far as to even give stays on import duty. So we think that this is an area that needs to be thought through carefully. Ultimately, the benefits of these sort of categories will open the door for local assembly and local manufacturers to then think about these things. When you go to the next page, Honorable Chair, we talk about EV buses. In this case, we're not talking about VAT, we're talking about excise duty. And the same thing for heavy duty and medium heavy duty trucks there. When you go to the next page, which is page 16, we're talking about lithium ion parts and components. Just to say on this one, Honorable Chair, on page 16 at the bottom, we already have companies like Spiro, which are going to be doing local assembly of even the batteries. So the need to think about the VAT status of these issues is critical. And the final point on page 17 is what we're calling telemetry units for battery assembly, which come with electric vehicles. Just to say on this is that electric batteries and electric vehicles need the telemetry units because they measure how the energy is being used, and they give valuable data even for the government. So for example, it is easier for you to understand and know how many vehicles, where are they. It's easier to track the movement of electric vehicles. You know how quickly they are charging. So telemetry units will be critical in terms of being able to enable this sector to grow. I am emphasizing that because of the few vehicles you have, 138 out of 3.8 million, if you really want this industry to grow, you need to think about this area very critically, and that is really the thrust of these issues. I think I have used the time very well. I will ask my colleagues here. I don't know whether they want to add anything, and I'm sure you might have a question. Over to my colleagues.
I'll give you another 3 minutes. Maybe we can get those statistics. I think I have seen the importance of those statistics. I've seen Daniel has really spent a lot of time mentioning 123.
I think the number that our council is missing is on the motorcycles. We have a total of 8,000 motorcycles out of close to more than 2 million motorcycles which are ICE. So keeping that number in mind, 8,000 out of 2 million, that actually we need to actually get to that critical mass so that we can actually start doing battery assembly even in Kenya at this point, based on our proposal from Daniel. So those are the key statistics to actually we need to look at, and to help just grow the industry is maintaining what we have today. As we do presentations to our investors, I think consistency is key, and the regulatory consistency is key for us to actually continue getting more investments in Kenya to grow the industry. That's my submission. I leave it to my colleagues.
The projections.
Oh, I think you think my colleague is telling me to tell you the projections, which I do have, I think, 5 seconds. With the incentives that we have today, we're looking at about 12,000 this year, between 12,000 and 20,000 EV vehicles. If we proceed with what we have plus more, we'll get to 12,000, between 12,000 and 20,000, depending on which incentives we get. By 2030, we'll be at 70,000 on low incentives, and we'll be at 140,000 with high incentives. That's creating that critical mass that we need to help us kind of also get back and actually start paying all the taxes plus more once we get to 2030 with the incentives that we're proposing.
So in East Africa, where are we in terms of the numbers?
When you look at Rwanda, Rwanda has more than 50,000 EVs on the road, including vehicles and motorcycles. Uganda also has, I don't have the numbers for Uganda. When you look at Ethiopia, they actually mandated everybody, expatriates, to actually have EVs. The electricity is cheap. So I think in East Africa, we are lagging behind, though we started earlier than all East African countries. But it's because on their regulatory space allows the growth of EVs in those countries. In Rwanda, for example, you don't pay duty, you don't pay VAT. The electricity is 50% compared to domestic tariffs. So I think they've created that conducive environment for that growth. So if I was to compare, I think at this point, we started earlier, but we are behind in comparison to East Africa.
Here, gentlemen. Chairman, there is something that I think Ignatius should mention, very briefly, which is on energy usage, because it's an important issue. And maybe you can...
Yeah, that's actually what I wanted to talk about. So I know one of the questions that comes up is, if we have a high number of EVs, do you have enough energy capacity to do it? Now, at the current state, electric vehicles consume about 18 gigawatt hours of electricity in a year. Now, if we have the incentives, if we get the incentives, say this year, we'll have about, EVs will consume about 35 gigawatt hours. Okay?
I think you have the incentives now.
Yeah, okay, we have the...
What you're defending is it's about to be taken away.
Yeah, so basically...
Because you already have.
So, I mean, if you get more incentives for the four-wheelers, which consume more, you know, two-wheelers consume, the motorbikes consume less, okay? So if we grow this number, then the energy consumption will grow. But then one key thing that is important to mention is the energy curtailment. So from the EPRA statistics report, in 2023-2024, we curtailed 812 gigawatt hours of electricity. So that means that was electricity that was wasted. I mean, steam that was just vented wherever. Now, if you compute this, say in terms of tax revenue lost, this is about 8 trillion Kenya shillings. Now, this can be consumed by electric vehicles if you have enough electric vehicles. That is money lost in terms of tax revenue from the sale of electricity units. So this is also just to show you, I mean, beside having a high number of electric vehicles, then there are more areas of getting revenue. And all these were shared in the slides that you have.
Maybe my colleague.
Thank you, Chair. I would wish you also give some exact quantum on what you're saying it was lost and how it can relate to the need, the demand for EVs so that we avoid that loss. But nonetheless, to say, that was one of the questions I wanted to ask. The other question, which is very general, is what is the demand of EVs in Kenya? What is the penetration? What is the desire of Kenyans to move? And lastly, other than the response to climate change mitigation and adaptation inventions, what are the economical benefit that you say? Because asking everything you presented here is like zero-rated VAT, exemption on excise. So actually, the incentive is this particular sector should be tax-free completely. So what is the give back? What is the compensation? Thank you.
So thank you for the question. I think my presentation was going to highlight those areas. However, I can just quickly give an overview of that. So EVs, when you look at the statistics I earlier said in terms of two-wheelers specifically, we started with about 144 in 2021. 2022, it was 366. Once we got the incentives, we had a 500% increment from 366 to 2,500, just to highlight on the demand on two-wheelers. Last year, coming from 2 years ago, last year, the total registration on EV motorcycles was about 60,000. From that 60,000, motorcycles took 4862 from that registered. So we took 7% of the market share from the total motorcycles registered, just to show you the demand. Why is there demand? The value proposition for EVs versus fuel is 30 to 40% on every single vehicle, from buses, passenger vehicles, and motorcycles. Just to show you, capital is usually a struggle, but the reason why we're asking for these incentives is actually to reduce the cost to be more competitive.
That scale of economy would have given you an advantage than taxes alone.
Yes, so to us to get to scale, good point. If we get to scale, we will get cheaper, and actually we won't be coming back again after a few years. We'll just be paying all the taxes in a few years. To answer the question in terms of benefits, I'll start with fuel. Looking at the fuel.
So, Chair, I think they now have the PowerPoint. So if they're able to put the PowerPoint on, this is, I think, the slide number 11.
Proceed.
When you look at the projected growth is based on history, and what we are looking at this year, we are looking at 12,000 to 20,000 in terms of demand, based on also research from the industry. Subsequently, with that growth, we will basically be saving importation of fuel of more than 12 million USD, because instead of actually importing ICE vehicles, we are basically bringing in EVs. So it basically increases, the trajectory is from 12 million USD this year to about 80 million to 200 million, depending on which incentives, in 2030. That is on fuel importation only. The next one is basically revenue on taxes only for EV charging. This is from the electricity. When you go to the second slide there, we are looking at EV charging will contribute to 2 million to 5 million USD based on the incentives, to about 30 million USD in 2030 as we continue growing in that trajectory. When you look at the next slide, skip the two slides, I think my colleague talked about electricity. Energy consumption. We are looking at, I think he mentioned about 813 curtailment. And how are we going to use that 813 gigawatt curtailment? The energy consumption from just EVs, which most of them charge at night, will be basically taking that 813. Our projection by 2030 will be taking about 350 gigawatts from that, which is about 40% from what is being curtailed today. So that is to give you in terms of how much we'll be giving back.
They don't need to add more generating stations.
Yes. Lastly is carbon credits, carbon emission. In terms of the environment, I think he mentioned in terms of what is the climate change mitigation. So carbon reduction footprint, when you look at those numbers, this year we are looking at 312 tons. By 2030, we'll be getting to about between 28 and 71,000 tons. That is climate mitigation. In addition to that, those are credits that we can sell. If we were to sell it at 40,000, the subsequent slide, each ton 40,000, we are looking at a revenue that the country will be getting between 128,000 million to about 4 million in 2030. I don't know if I answered.
I think we have done. You have done enough. I think we have heard you. You are requesting the status quo, and you want the small vehicles and tuk-tuks, and medium and heavy duty EVs. So we have heard you. We shall consider.
Yes.
We will get time to. I think it's a very interesting area. Maybe our clerk here should arrange another meeting when you have time, so that we can discuss further.
The good thing, we always have time for you, so anytime you're available, we'll avail ourselves to present.
So, asante sana.
Thank you very much. Yeah.
Thank you.
Thank you.
Asante sana.
Thank you.
Okay. So let us have a HHK or HK. Mr. Barat, we are coming to you shortly. Please introduce yourselves.
Thank you very much, Chair and honorable members. My name is Abdurrahman Yassin. I'm from the firm of HHK Consultancy. I will let my colleague introduce herself.
Hello, good afternoon, Chair and members, esteemed members. My name is Wairimo Kenya from HHK Consultancy.
How many issues do you want to prosecute?
Sorry, around 12, Chair.
Huh?
12.
Huh?
12, 1, 2, yeah. But noting the time constraints, we shall skim through some of them and just focus on what is truly important.
Please do it in 20 minutes.
Thank you.
So I'll proceed directly. Sorry. So I'll go to clause 8 on the Finance Bill 2025, which proposes a 5-year cap on tax loss carry forward. While the clause may offer short-term fiscal revenue gains, there is a long-term burden that's going to be caused on these businesses, especially those that are capital intensive. So this is going to make it more burdensome for some of these businesses that need to generate, that use a lot of capital initially, and 5 years is going to be a shorter time. So our proposal is to retain the indefinite carry-forward period for tax loss to encourage investment in Kenya. I will move on to clause 27, which similarly proposes to remove the 100% investment allowance in major projects outside Nairobi, Mombasa, as well as in special economic zones. Chair, if I was to start my business in Kanyekine, somewhere far from in Central, it would be hard for me. By removing this incentive, given this 100% investment allowance incentive, it's going to be hard for me to start up. There's no incentive to start up there. So I just rather stay in Nairobi where I have access to transport or whatever, hence leading to encouraging rural-urban migration, and which is going to strain the urban areas. So our proposal is to retain the 100% investment allowance so that to encourage investment and especially to encourage regional competitiveness. Over to clause 36, which proposes to have the VAT reforms for tea and packaging materials from standard rate, which is 16%, to exempt. So this might have been put there to encourage the value addition process of packaging materials, which will end up being a burden, as exempt status input VAT makes input VAT non-recoverable, hence making this production process still value addition process still high. Hence, our proposal will be to, instead of making this packaging material exempt, we propose to have it at 0 rated so that it can incentivize this packaging in the people in the packaging materials for tea and coffee. I will still in clause 36 on the special VAT. The bill proposes to delete the section where VAT exemption for specialized hospitals development. So, Chair, if you, the rationale for this exemption was to improve the healthcare access and also to strengthen Kenya's position as a regional medical hub. But by removing this exemption, this makes healthcare difficult to access. So it is our proposal that we retain the current VAT exemption for goods used in construction and equipping specialized hospitals so as to encourage and to enable universal healthcare coverage. I will capture some of the additions that we would like to talk about in the Excise Duty Act. One of the additions is for the direct air capture machine. So a direct air capture machine is a technical equipment that is used to capture the CO2 from the environment and capturing CO2 from the environment and storing the carbon away from which helps in fight climate change. So in Kenya, Kenya is actually the only country in Africa that has this direct air capture machine manufacture, where they do the manufacturing from ground using the raw materials to now what it is, the full machine. They have employed over 60 skilled Kenyans who carry out this research development, which is a process of improving the direct air capture machine, which is also a major milestone for Kenya and with regards to environmental cleanliness. So our proposal will be to introduce a 25% excise duty on the importation of the fully built and semi-built direct air capture machine with an exemption for locally manufactured units. This is going to encourage local manufacturing of this direct air capture machine, and also encourage this industry, But for the implementation, we would propose that there is clear clarification when it comes to the HS code used, which is 8421-3910, that should capture strictly just the direct air capture machine and not affect other machines that are under the same HS code as for the direct air capture machine.
So is that a new proposal to the finance bill?
Yes, it's an addition to the finance bill.
Okay.
Thank you. This is also an addition to the finance bill, where aluminium was a leading supplier in aluminium extrusion industry. This aluminium alloy is used in windows and door frames, and currently it's operating below 50% of its capacity. And this is because of the importation of aluminium that leads to unfair competition. So our proposal would be to have an excise duty on certain HS codes, which have been stated in the document shared, of USD 3,500 per ton, or 25%, whichever is higher, excluding goods manufactured in partner states, which is EAC, if they are in conformity with the rules of origin. Another addition to the Excise Duty Act would be a proposal for non-reusable non-refillable lighters, which most of the time when you walk around, you'll just see match thrown around on the ground, because these lighters are imported in large quantities and they cause pollution due to the plastic containers used. So our proposal, and they're also not as safe as the refillable lighters, as they can cause fire hazards. For the plastic, they cause pollution. So our proposal would be to include an excise duty act, a specific rate of 1,000 Kenya shillings per kg, or 35%, whichever is higher, on non-refillable lighters. Kindly note that for the refillable lighters, it should only capture the non-refillable lighters and not affect the other pocket lighters and the like, the goods in the same HS code. I will allow my colleague to continue.
Thank you very much. I'll pick up from there. Like you've rightfully noted, Chair, our submission, or rather our presentation, is on two fronts. One, we are giving our views on the finance bill as a whole, and then we are also giving proposals on what should be implemented in the Finance Bill 2025. So continuing with the theme of proposals, we would propose a specific excise duty on imported glass bottles. And why is that so? So Kenya's glass bottle manufacturing industry has witnessed significant investment in the recent years, especially in support of the local beverage and pharmaceutical sectors. Now, there being the rise in the demand for glass packaging is typically driven by consumer health consciousness, sustainability goals, and industrial growth. Therefore, as a result of this, the industry has built strong links with the agricultural sector in terms of juice packaging, the health sector, and the FMCG sector. Now, despite this growth, the industry, like any other, is facing challenges. And basically, the sector is facing mounting pressure from unregulated imports of cheap, ready-to-use glass bottles, which are preferred by bottlers due to their low cost, resulting in dependency on foreign packaging, thereby threatening the viability of their local manufacturing. And as a result of that, we would therefore propose a specific excise duty rate of $350 per metric ton on imported glass bottles to supplement the current 35% duty rate, which is in place. So the applicable duty will be whichever is higher. And why are we saying that? Why are we making this proposal? Well, it might not be known, but many of the glass bottles used in Kenya can be produced locally using both virgin and recyclable inputs. However, low-cost imported bottles are displacing the demand for local production, fracturing supply chain, and discouraging domestic sourcing, which is why we need to safeguard this sector. Additionally, local manufacturers have invested heavily in automated furnaces, energy-efficient kilns, and cullet processing lines. These investments require predictable demand to remain sustainable, without which these producers risk scaling down operation. Additionally, an over-reliance on imported bottles exposes Kenya to global shocks like shipping delays, container shortages, or geopolitical disruption. This is why we need to build local capacity to enhance resilience and avoid such vulnerabilities. Lastly, unlike local bottles, rather bottles which are produced locally, bottles produced locally have recycling in mind, and on the contrary, imported bottles are not standard in color, design, and are therefore excluded from the otherwise used recycling streams. Any other additional environmental benefits include the quality and safety standards which the Kenya Bureau of Standards assure, and this will go a long way in supporting Kenya's extended producer responsibility commitments, which it has entered into. Now, that is our submission on the glass sector. I shall move on to the paper. industry. And on this, we seek to introduce 3 clauses, which we shall get to. But before that, it is worth noting the significant strides Kenya has made recently in terms of its paper industry. At the moment, Kimfei has secured funding from NoFund and I&M Bank to establish a recycled paper manufacturing facility in Tatu City. The East African Paper Mills has increased its production capacity to 100 tons per day, and the Competition Authority of Kenya has approved a joint venture between Amstrel Trading Company and Kingsborn Assets Limited to establish a paper converting facility in Kenya. All these signify confidence in the sector and its potential. So what are the challenges facing this sector? Well, there is competition from imports. Ideally, the influx of imported paper products, which are often underpriced, pose significant threat to local manufacturers. There is limited availability of specialized paper grades, and affordability issues for small converters also tend to hinder market expansion. And we would also like to cite the case of Webuye paper mills, which collapsed and resulted in massive job losses and economic decline as a result of lack of support for the sector. And based on the aforementioned, and to support the future of this sector, we are proposing 3 amendments to be made to the Excise Duty Act. And if you could move to the next slide. We can see the proposals. So on the far left column, the one titled Brief Description is what is currently there in the Excise Duty Act. So on imported paper or paper boards, labels of all kind, whether or not printed, of HS code 482110 and 482190, excluding those from the ESC, while their current excise duty rate is 25% or 150 shillings per kg, we propose that the same be amended to 25% or 200 shillings per kg, whichever is higher. This is, of course, excluding paper manufactured in the East African community and that which meet the rules of origin criteria. Equally, in relation to the printed paper or paper board of HS 48114190 or 481149, which has the current rate of 25% or 200 shillings per kg, we would suggest the addition of the word imported at the beginning of the description. And lastly, on imported cartons, boxes, skillets of HS code 481910, 48192010, 48192090, we do have 2 proposals on that front. That one, the excise duty rate be amended to 25% or Kenya shillings 200, whichever is higher, and there be an exclusion from goods of ESC which meet the rules of origin criteria. We believe those will go a long way towards helping the Kenyan paper industry be the very best version of itself that it can be. Lastly, this is on the steel industry, and this is as a result of, yes, just the first slide, the one that's starting with breaking the pact. Yes, so this is on the steel industry, which recently has faced some legislative shake-ups, wherein in 2024, the Tax Procedures Amendment Act was passed, which amended Section 6 of the Tax Procedures Act to include a new subsection 4. The subsection 4, which has been quoted at the bottom of the slide, reads, a provision in any multilateral agreement or treaty that has been entered into by or on behalf of the government of Kenya or made pursuant to such agreement or treaty relating to the imposition of import duty on 2 items. Item 1, imported steel billets of tariff heading 720711, and B, imported wire rods of tariff heading 721391 and 72139190. So there is a proviso there that those multilateral and bilateral agreements shall not apply for a period of 2 years from the commencement of this subsection, or for such longer periods as the Cabinet Secretary may by notice in the Gazette prescribe. So this presentation, that provision was passed following submissions made before this very committee in support of the steel industry. It was in response to concerns raised where cheap imports were flooding the market from South Africa and other member states of the African Continental Free Trade Area. So prior to that, prior to the introduction of the provision, we do note that Kenya and other ESC member states adopted legal notice number 154 of 2023, which contained a tariff reduction schedule on a number of products, including the steel billets and wire rods, both of which were placed at zero duty until the year 2030. Indeed, it was in response to that the provisions were received, that were introduced following the cries from this industry. However, while intended to help the local steel industry, it is our opinion that the legislation as phrased has a far wider and damaging consequence. So as a result of the provision, there is currently no basis for the imposition of any duty for using that or for using the HS code or for any administrative framework for KRA, rather, and specifically for customs to clear the goods into the country. Now, we have to take note that Section 6A pulls Kenya out of all bilateral and multilateral treaties in relation to the aforementioned products. This treaty includes the ESC Treaty, which creates the Common External Tariff, which imposes the duty rate, and the East African Community Customs Management Act, which sets forth the administrative framework for the various processes of customs. Just noting the time constraint, I shall briefly rush through. So by excluding itself from the ESC Treaty and its associated legal instruments, Kenya now lacks a lawful customs mechanism to process, regulate, or control the importation of these products. The ECMA is the legal framework which governs every stage of cross-border movement of goods, that is from the arrival at the port to clearance, to audit, to post-clearance, inspection, verification, release, warehousing, and so forth. So without the ECMA and without the CT, which both draw their legitimacy from the ESC Treaty, which Kenya has sought to exclude itself in relation to those products, then there is no valid basis for the introduction or for KRA to perform its basic functions. Additionally, this is going to subject us to retaliatory measures from other AFCFTA member states. As we know, Kenya does not exist in isolation. We do draw a number of supplies from our neighboring countries. South Africa, for example, supplies fertilizer, machinery, and coal necessary in the agricultural and energy sector. Uganda and Tanzania are conduits for regional transportation, warehousing, and logistics, and Egypt plays a vital role in supplying chemicals, pharmaceuticals, and equipment. We have coastal fragmentation in the ESC bloc. There is a violation of the treaty supremacy and Pacta sunt servanda, which means that all international obligations are to be adhered to, and there is a breach of procedural and institutional obligations. I'm sorry, I'm rushing through, noting the time constraints. And if I could perhaps have a minute or two just to finalize on our last bit on the miscellaneous fees and levies. Thank you, Chair. Luckily, on the miscellaneous fees and levies bit, this is just our opinion on the finance bill, and both of them are in overwhelming support. We note that clause 57 is a technical cleanup, whereas section 9B of the Miscellaneous Fees and Levies Act referred to excess tax refunds, and section 47 of the Tax Procedures Act. We note that the deletion of those two particular references is a welcome proposal, because these amendments is a necessary cleanup. Section 47 of the Tax Procedures Act specifically addresses overpaid tax and does not relate to penalties or interest in administration. So making its reference in section 9B was unnecessary and potentially confusing for the taxpayers and administrators. Lastly, again on the steel industry, the reduction of the export promotion and investment levy from 17.5% to 10% on the select steel products represents a significant cost relief for local manufacturers, and on that we applaud the amendment as is. And that will be it for the presentation on HHK. We welcome any question, Honorable Chair.
Thank you very much. Maybe on this proposal of excise duty on paper.
Yes, Chair.
Do you think we have sufficient capacity at the moment to discourage imports through the excise duty that you are proposing? And then number two, have you run through the impact in terms of costs of your proposals of 25% or 150 shillings, 150 per kilo? Have you run through the figures?
Okay.
to show the impact. Maybe my colleagues, if you have okay.
That's it? Yeah. Okay. So to answer to your questions, yes, I do believe that we have sufficient capacity. At the moment, there are a number of players in the paper space, and like I said, there is significant investment in the sector, which at the very minimum is indicative of the potential and the growth that it is likely to receive. So we believe that Kenya at the moment is positioned enough, strongly enough to support its own local capacity. And in terms of the costings and figures, we did not have access to that database. This is just our opinion based on our analysis of the market as we see it, and unfortunately we did not delve too deeply into finding out the figures. And
this matter of carry forward of losses, I think you started by that issue.
Yes, we did, Chair.
What is your proposal?
Thank you, Chair. For the 5-year cap, we believe that most of the investment, most of the companies that are in play have and are capital intensive, need a longer period to recover their profit, to get into a profit position. So our opinion is, our proposal is for it to be retained at indefinite, so that they can be able to get profit and be able to expense their losses.
There is a concern by, of course, for business people. I can see the business people here are very happy about I can see from their faces. But there is also the concern of the taxman, that some people are using it maybe to not to pay tax for a long time. So how do we get a win-win position where we take care of the concerns of the taxman, at the same time we don't disadvantage business people?
Thank you, Chair. I believe that businesses should have a proper documentation of what expenses they've incurred. Also, the taxman should be able to see which business is actually doing the right thing, is trying to not pay tax because of the income that they're going to be generating for the period. And also, if it's most businesses, like let's say real estate, for instance, it takes time before they're able to get the income. So I think for some of these businesses, it maybe proper guidelines and documentation of the expenses would be required.
So if we put, say, what happens in other countries, maybe? You have what happens in Uganda, Tanzania?
We do not have the statistics,
okay.
But we can confirm, then we'll provide the same.
Okay.
Yeah.
I think we have heard you, and we shall consider some of your comments in our final report. Thank you for good research. I think you have the most detailed presentation of the day.
Thank you very much, Chair.
Good. Thank you. So you can take leave. There is one other. Which one? Before we go to Kenya Association of Manufacturers, there is one more. It's called Koru Ram. Koru Ram, where are you? Koru? Just take the seat here. One final one, then we come to you. So you can introduce yourselves.
Hello, good afternoon. My name is Gitahi Kunyuga. I am a co-founder and director of a company called Yamaroku Limited. We are the makers of a new kind of alcoholic beverage called Koruram that is not in the market yet, but we are hoping to introduce to the market.
What is the name of the company again?
Yamaroku Limited.
Okay.
Yes.
Hi, good afternoon. My name is Yu Yamakami. I'm also the co-founder and director of Yamaroku Limited. And so I'm Kenyan. I'm originally from Japan, but now I'm in Kenya resident. And habari zenu. Yeah, I am a.
Maybe before you proceed, I am interested in the name Koru.
Koru?
Because I come from there's a village called.
Ah, really?
Is there any relationship?
And Chair, to attach our discussion,
From?
I wish today have a sample so that we can attach.
So, sorry, did you say you come from near there? Or?
No, I just saw Koru.
We're based in Koru, so it's the village. It's just named after the village that we come from. So it's in Kisumu County, near Muhoroni. So that is what we just decided to name after the village that where we are located.
Oh, okay. I'll come and see because I come from. My
yeah,
home is walking distance from there.
It's
really?
Fort Sanan.
That is a very good news.
Remember last year we had a lot of discussion on this thing.
Yes.
The parliament and some of you were supposed to go there.
Yes.
Okay. Yeah, our presentation is a very.
I see that as an empty bottle.
Yes.
As I've said, I needed to know what somebody does.
Unfortunately,
Are you saying? Are you saying you wanted to test or what?
Yeah. Yeah, I'd really love to. We'd really love to produce and start market this product in Kenya. Not only in Kenya, we also export in overseas. And so our presentation is very short. And I had a presentation last year, this committee, and I raised the concern that the KRA regulations were too stringent for micro distilleries like us, which prevented our business from starting. And we are here today for two reasons. The first, to provide an update since last year, and second, to request your cooperation in developing the legal framework for simplified regulation concerning micro distilleries. And first, after the committee appearance last year, and a meeting was held under the leadership of KRA Deputy Commissioner. And after that, KRA and the Weight and Measures officials inspected our micro distillery in August 2024. During that inspection, we reached an agreement that as a short-term solution, KRA would grant approval to begin production once we obtain the permit from other agencies, such as the Ministry of Interior and KEPSA. We, that is our company, and KRA, Weight and Measures, and CAM signed the minutes of that meeting in October 2024. Since we've completed the requirements for the other agencies, we requested an inspection from NACADA, and the multi-agency team conducted an inspection on May 21st. The issues raised by agency other than KRA during the inspection were very minor, and we can be addressed immediately. We believe that KRA will grant approval based on the agreed upon minutes, as a report by the multi-agency team is currently being drafted. I recently sent an email to the Deputy Commissioner regarding this, and we kindly request the Deputy Commissioner's prompt action. And if we receive approval as per the minutes we signed, we could begin production in June and potentially exhibit at the Tokyo International Conference on African Development. It's called a TICAT, to be hosted in Japan on August 20th. The second point is the development of legal framework. We propose an exemption for some equipment requirements for micro distilleries, such as flow meters and automated facilities. It's showing the presentation on the front. So we'd like to request to exempt some measuring devices like flow meters and also automated manufacturing machine and continuous piping, that one is very difficult to start production, especially for the micro distilleries. So we'd like to propose that.
Which exemption are you seeking? Is it on VAT? Is it on...
No, it's the actual flow meters. So when you try to get the excise duty license, so the regulations ask you to input this kind of flow meters. So it's more of a regulation side, not the actual duty itself or VAT.
Okay.
Yes.
Yeah.
Because then maybe there's a subject we can discuss outside this process, because this process is for finance bill. But anyway, proceed. But that is something we can discuss outside this process.
Okay.
Okay.
Yeah. Okay, let me finish just a few sentences. And so if the exemption is granted, it would enable micro distilleries that had previously given up on investing in Kenya to now do so. And finally, let me add that Japan, in a country with a booming alcohol production industry, and recently, Japanese micro distilleries are looking for raw materials such as sugarcane and sweet potato from other countries to make their premium alcohol. If this legal framework is promptly established, promoting this simplified legal framework at TICAT, which will be held in Japan, could encourage Japanese alcohol companies to establish factories in Kenya.
Just to add a few things, just to expound. One of the things, if you can just scroll up what we are showing. I don't know who's in charge of this. Scroll up on that. My presentation, can just scroll up.
Who is
up,
doing it?
Up, not down, up. So if you just look at here, where there's, in the middle of the sentence, there's something called suggestion there. And then right there, reference 1, reference 2, agrochemical and EABL. One of the big things that you need to, we want to highlight is that a company like agrochemical produces 15 million liters a year. EABL produces 22.5 million liters of spirit a year. We are thinking, for us right now, our production level is 10,000 liters. So some of the regulations that we are suggesting, that the exemptions is for micro distilleries, because you can just see the level of production is completely different. The regulations are set up for the large producers. Another thing is, one of the things that we have seen is that in the world right now, the growth of like this kind of micro distilleries, or rather what we call craft spirits, the growth is about 30% per annum, while the other the spirits are around 6%. This is something that we have not explored in Kenya. If you go to the high-end wines and spirits shops, you'll find these kind of craft spirits which are made using using agricultural products, but they're usually from South Africa or UK. So this is something that, if we encourage this kind of industry, it's something that has a lot of potential. So we talk about value addition, we talk about growth of SMEs, we talk about creating industries in rural areas, but the only way to do this is to actually back it up by using policy. That is what we are proposing here.
Maybe,
yeah.
What is the cost of flow meter?
The cost of flow meters is what we have, the approved flow meters that we have seen in the market. So the ones that are approved by the Weights and Measures Department, Ministry of Trade, they are upwards of 15 to about 20 million shillings, which if you look at the micro distillery producing at our level of production, it's not really, doesn't really make sense, because by the time you pay back a loan for that kind of production level, it will take years. Another thing is also that the way that it's made, it's for this kind of the meters approved are usually as the large producers, which do like 24 hours continuous mass production. For us, we do in batches, so it's one batch per week, one batch another week, and this is not really something that is feasible with the kind of meters that are approved.
What about production line automation on the continuous piping?
Yeah, the same thing, because when you're doing batches and the kind of thing, if some of the people who have come to actually see, it's that when we do batches, when you're doing in batches, so it's difficult to do automation, because another thing is when you're doing like craft distillery, you need to do adjustments, like minor adjustments, depending on things like the weather, the things about like kind of raw material that you have. While when automation is when you make the same thing over and over again, like mass produced. It's like if you go to like places like let's say France, and you hear somebody say like a wine that was made in 2024 is better than the 2023 one, because they make them in batches. But if you do mass production and try to produce the same thing, the same taste every time, that one does not really fit with what you call micro distilleries, or rather craft production.
Okay, I think maybe you need to seek another appointment with us separate from this meeting.
Okay.
Because these matters doesn't belong to finance bill per se, but they are business.
Last year when we were here, we presented, and we were able. The Deputy Commissioner for KRA was around, and he was instructed, or rather, he was asked to provide us with a meeting, and we did, and we have seen some movement from there. But we still see there's some kind of. Sometimes they say there's a bit of. They need a little bit more of like legal backing, or rather a legal framework, which we think can only be availed from the legislative side. So that is why we are here.
So maybe you just arrange a meeting with us,
okay.
Then we'll also call KRA.
Okay.
And then we see whether we can...
Is it possible to actually know who I can arrange it with?
Get in touch with our clerks here when there are people seated behind there.
So
they will advise you.
Okay.
Yeah.
All right. Thank you very much.
Thank you very much. Anything else?
Do you want? Okay.
Asanteni sana.
Thank you very much.
Asante. We come to Kenya Association of Manufacturers. Welcome. Big team as usual. We want to agree on time. Mr. Barat. Well, how many issues how many planning issues do you have?
We are a strong team here. So
I can see, as usual.
But the venue is good.
Where is our paper guys today? You didn't carry, where are they? Oh. Huh? I'll give you 1 hour 30 minutes, but I will consider. I will consider another 30 minutes if you don't finish. Yeah. So we're starting the.
Thank you. Thank you, Chair.
Maybe you can run through the introductions.
Yes.
Self-introductions.
Yes. Tobias Alando is my name, the CEO of CAM.
Chair Hitesh Medirota, Vice Chair at CAM.
Chair Rohin Vora, Chair of the Pharma Sector at CAM.
Good afternoon. My name is Ashit Shah, Vice Chair, Trade and Tax, CAM.
Good afternoon, Chair. My name is Rao from Leather Sector.
Good afternoon, Chair and honorable members. My name is Jay Shah, KM, Textile Sector.
On this side, my name is Kimani Maura, East Africa Packaging Industries CEO. On the paper sector, I'm the chair for the subsector for corrugated cartons. We also have the subsector chair for paper, T-sacks, and the rest, Rohin.
Go ahead. Go ahead, introduce yourselves.
Honorable Chair, Irene Gaturo, Ernst & Young, joining in with CAM. Thank you.
Chair, good afternoon or evening. Helena Chieng from Ernst & Young, supporting CAM today.
Good afternoon, Chair, honorable members. My name is Akinyi Gikonyo,
consultant at CAM.
Good afternoon.
The mobile mic. You can give them to introduce themselves also. Behind there.
Good afternoon, Honorable Chair, Honorable Members. Miriam Bomet from the Kenya Association of Manufacturers, Head of Policy and Regulatory Advocacy. Thank you.
Good afternoon. Wait, Bharat Shah, KEM Director.
Good afternoon, Chair. My name is Jackson from KAM Secretariat.
Good afternoon, Chair. Simon Geduku from KAM Secretariat.
Good afternoon, Chair. My name is Dominic Mutai from KAM Secretariat.
Good afternoon, Chair. My name is Ruth Lemlem from KAM Secretariat.
Good afternoon. My name is Jitu Savani. I'm the chair for the paper manufacturers as well as the paper converting at KEM.
Good afternoon. My name is Suresh Patel, Vice Chair of Chemical Sector.
Good afternoon. Malcolm Mwangi, KAM Secretariat.
Afternoon. We're also members of CAM.
Good afternoon. Darshal Wadia, Building, Mining and Construction Subsector Chair.
Good afternoon, Shanae Patel, CAM Secretariat.
Good afternoon, everyone. Enid Curie, the Vice Chair, Cosmetic Sector.
Good afternoon, everyone. Dharmesh Savla, CEO Tononoka Group, and representing the metal sector in CAM.
Good afternoon, Tabitha Munyagia from MCOPA, member of CAM.
Good afternoon, Chair. My name is Rohin Chandaria, Vice Chair for the paper sector.
Good afternoon, Chair. My name is Viren Joshi, Dune Packaging.
Good afternoon, Zipora Kuria from BAT.
Good afternoon, Hannah Fundi from BAT, member of CAM.
Good afternoon, Chair. Excuse my voice, I have a flu, but Subsector Chairman for the electrical sector, CAM.
So, thank you very much for the introductions. Our chairman has walked in. I keep him to introduce himself and proceed from there. Chairman.
Thank you very much, Session Chair and the Vice Chairperson. Good afternoon. My name is C.P. Kuria Kimani, MP for Molo, and the Chairperson of the Departmental Committee on Finance and National Planning. Karibuni. We look forward to having a great engagement, and thank you, honorable members, for the good job you've done in the morning session. I was able to follow most of the discussions, and I think so far so good. Over to you, but you have three different presentations.
Yes.
Could we start with the one on the finance bill, and then we go to the others later? So I think it's important that we deal with the current matters, and then now we go to the CEO's presentation on the other one.
So, Chair, I had given them 1 hour, 30 minutes, with a possible extension of 30 minutes.
Yes. Chair, it is just a small brief setting the scenario, because without understanding the implication, then I'll take 5 minutes, if you allow me.
It's fine, proceed.
Okay. So, Chair, first we'll start with the positive sides in terms of what the government has done, and we're appreciative on the monetary policy, stability of the shilling, and also the engagement that we've had previously. Just move on to the next slide. So if you focus on the GDP contribution, move on to the next slide, please. So if you focus on the economic growth of this country, we have dropped 1 point from 5.7 to 4.7. And a great indicator of reasons why we have dropped is also because the manufacturing sector has really not grown. If you go to the next slide, it gives you an indication of how the manufacturing sector has performed. The other sectors of the economy have really done well. Agriculture, just remain there. The other sectors of the economy have grown well. Agriculture has done well, service has done well, but there's this one child called manufacturing. The manufacturing sector is stagnating, and we did identify 3 key reasons why the sector is really stagnating. One is around pending bills and VAT refunds issue, and then taxation of industrial inputs, which comprises the conversation that we are going to have today in regards to the proposals. Just move to the next slide. Skip that one, the importance of the manufacturing sector. The other critical thing that we needed to highlight is our comparison with other countries in terms of manufacturing contribution to the GDP. As you can see, Egypt, South Africa are really doing well, and our aspiration definitely is to grow. We have dropped from 7.6 in 2023 to 7.3 in 2024. And if all these important points that we are raising today or submissions we are putting today are addressed, then the impact to the contribution of the GDP is going to change. Just move to the next slide. Exports. Exports are crucial for us. Look at where Vietnam is in terms of their share of export. They are almost at 90%. We are still at 30%. Decision needs to be made to address some of this concern to improve our trade deficit, which stands at 1.6 trillion. Chair, the other last 2 slides are very important. Just move to the next one. The next, yes. So we've identified around 4 things, 4 or 5 things that touch around our proposal. One is the unstable and predictable policy, regulatory burden, high cost of industrial inputs, high cost of power, and illicit trade. So if you go to the next slide, we have a financial fiscal deficit of about 867 billion. And if just look at the 3 sectors that we have identified in terms of illicit trade, textile, alcohol, and tobacco, there is a revenue loss of about 162 billion. And these figures are available, Chair, from the Anti-Counterfeit Agency that shows you that the government is losing about 826 billion because of illicit trade. Your revenue actually is on this issue around illicit. Kenya has become a transit platform and also a destination for illicit product. Mark, we've only touched on 3 sectors. If you look at leather, also has the same issues around smuggling. So if our decisions and our policies can be made to curb this issue on illicit, your budget deficit, or our budget deficit as a country, will be addressed. The last slide, Chair, is around the cost of power. I think I need not to delve much on this because we know the issue, but we still reinstate on this matter because any decision that the committee will make in regards to the manufacturing sector, touching on the regulatory burden, touching on the high cost of electricity, touching on illicit, will have a positive impact on our GDP contribution, Chair. Lastly, in terms of reviving the manufacturing sector, we want to propose that we continue, and we've seen this engagement on the public-private dialogue. We've done a session with your committee, Chair. We've done a session with KRA and MITI separately, and we've done a session with the National Treasury. We just hope and believe actions will come out of this conversation. The last issue is on the data-driven decision-making. It is important that verification exercise that has been done to form part of the final decision-making that we make as the committee and not decision being made out of any verification. The verification exercise are being done with the support of government institutions. And through this data, I think we can make very good decisions. Lastly, Chair, predictability of the tax environment and business environment is really important for us. And I hope that through this presentation and our conversation today, we will make a difference and we can evaluate ourselves and assess from the previous conversation, because every year we come here and make this same submission, we need to evaluate and assess ourselves, are we making progress? So I'll ask my technical team to proceed in terms of the submission, Chair. Thank you.
Thank you, Mr. CEO. Please proceed.
Thank you, Honorable Chair. Chair will proceed with our memorandum, but we'll also have a slide running through, but we've been able to also submit that to the committee. So, Chair, we have proposals around the Income Tax Act, the VAT Act, Excise Act, all touching under the Finance Bill, and also proposals to be included in this particular Finance Bill, which we feel are pertinent for supporting the industry. Chair, so under the Income Tax Act, there's a proposal under Clause 2 to amend the definition of royalty. Chair, this is a proposal that has repeatedly been brought into the different bills, the finance bills, the tax laws amendment bills, but we still retain our position that we need to have royalty, the definition of royalty, align with the OECD rights-based approach, where only payments for the use of or the rights to use copyrights qualify as royalty. We also had a court decision which had emphasized this, so we are hoping that this issue of royalty can be addressed in finality. But our proposal is to delete this proposal to expand the definition of royalty outside what is provided globally. The next proposal is on Clause 6. It's on the significant economic present tax. Our proposal is to review this proposal in order for us to support small and micro enterprises in the digital business. Manufacturers are users of the digital services, and we hope that this is something that can be considered, as much as we know that the significant economic presence tax was to also try and net in the businesses who operating digital services out of the country, but to ensure that the cost doesn't become exorbitant to the users in the country, especially manufacturers. Clause 8, our proposal is to delete this proposal that's proposing to enable tax deduction of expenditure incurred in that year of income for sponsoring sports. Honorable Chair and members, manufacturers are one of the largest supporters of sports in the country, supporting football clubs, different sports in the country. So if this tax incentive is removed, we might see a decline in terms of support to the sports in Kenya. And we have seen that one of the priorities of this particular government is to support development of youth and sports. So we are recommending that this proposal is deleted so that we have more corporates supporting sports in the country. Honorable Chair, we can go to Clause 8. Our proposal is to delete this provision proposed in the Finance Bill, which seeks to restrict the tax losses carried forward to 5 years. Honorable Chair and members, our proposal was that industry has quite intensive, high capital intensive industry, and recouping their investments takes a long time, a long gestation period. So the proposal by the industry is for either we delete the provision and retain it as it is to allow manufacturers to be able to have a longer period to recoup because of the high investments, or in the alternate, we extend it to 7 years, or on the alternate, we exempt manufacturers so that they are allowed to be able to carry the tax loss forward to be able to recoup. So those are the proposals we've given there, and we've given our justification. in terms of the investments that are made, our assessment that most of the industries would recover their investments within a 7-year period, and the request is for either an exemption of manufacturers from this specific provision if they intend to delete it from the other sectors, but they specifically consider the impact it will have on the manufacturing sector. We also looked at best practices, and we saw that in Tanzania, the carry forward losses is actually indefinite. They don't have limited time, and Uganda has 7 years. And the reason for this is to attract more investments, allow businesses to come and invest, and to be able to be allowed to recoup this within a longer period.
Chairman, this capital loss is very important. Do we want to remain a small manufacturing country or a large manufacturing country? Now, what it means from business point of view is that if it is 5 years, then I may invest $1 billion shillings in the first year. But if it is over 10 years for big investments, then I'll invest even up to 10 billion or more. You know, the larger it is, they need more time. It's like pay as you earn. The more you earn, you pay the tax more, correct? So if you are putting larger investment, we have to give them some. So unfortunately, this study was never done and time was limited. Otherwise, we agree that it should not be permanent, but let us have slab systems where it can be a win-win for all of the stakeholders. So the proposal is there 7 years, and then 10 years for up to from 1 billion to 10 billion, and up to 10 billion and over should be 15 years. Thank you.
Thank you, Chair. The next proposal is on Clause 8D. It's similar to what we have just talked about, and these provisions allow the Commissioner to extend the period for deduction of such losses to beyond 10 years. So the proposal under the Finance Bill is to delete this, and we are proposing that we retain these provisions in the event that the provisions on Clause 8C will be deleted, so that we allow the Commissioner to have powers to support sector-specific areas. But of course, we hope that that will be specified in the law to avoid any ambiguity and to be able to support the industry. The other proposal is on Clause 27. It's on removal of the investment deduction.
Okay, I think, Chair, I can take that up, Helena Ching. So there's a proposal in the Finance Bill to remove the incentive granted for investments outside areas of Nairobi, Mombasa, and also investments in special economic zones, where investors in these particular regions, that is outside Nairobi and Mombasa, and within special economic zones, are granted an accelerated capital allowance for all expenses incurred with respect to buildings used for manufacturing, hotel buildings, and machinery used for manufacture. So what the bill is proposing is to remove this particular incentive, ideally reverting those persons to the second schedule of the Income Tax Act, whereby they will only be allowed 50% deduction of that expenditure, as opposed to the full 100% that they currently enjoy now. The purpose of this incentive in the first place was to encourage investments in areas outside Nairobi, Mombasa, and to also develop our special economic zones. Now, removing this incentive now would revert us to the position that we were in before, whereby now people would now be concentrating on investing in these overly invested areas in Nairobi and Mombasa, and now overlooking the SEZ. So our proposal is to delete that specific provision and retain the provision in the ITA as is, to just encourage investments in these outside sectors, because that's essentially the purpose of this incentive. So we'll see more, and I think we've also seen from statistics like the investments, especially in the tourism space and manufacturing space outside Kenya, rather outside Nairobi, Mombasa, and within SEZs. Yeah. Oh, okay, good. But I think the point has been made, so we propose that that is deleted. I'll hand it back over to Miriam.
Thank you. Chair, the next proposal is on clause 28B, 2 and 3. The proposal is to delete the preferential 15% tax rate for the first 5 years investment in the construction of residential units and the local motor vehicle sector. Our proposal is that we delete this proposed deletion so that we retain the 15% tax rate, so that we can encourage investments in the two sectors, the housing development and also the local motor vehicle assembly. The other proposal is a new proposal. This is it's on the withholding tax on foreign scrap. Under the Tax Laws Amendment Act 2024, which was passed in 2024, there was introduction of a 1.5% withholding tax under the Income Tax Act on imported scrap. We are proposing the removal of the withholding tax, the percentage tax of 1.5%, because, and the justification for this is that scrap metal is used as a key material for the production of the semi-finished metal products in making construction items such as the steel rods, angles, and channels. And Honorable...
I can
okay,
elaborate with the permission of the Chair. So this proposal is
number 8.
Number 8 is a proposal which was we feel snuck into the 2024 December tax laws amendment. It wasn't there in the bill, and all of a sudden, when the law was enacted, we saw that it's been there. Now, withholding tax on products is actually completely unheard of. Withholding tax is generally levied on services such as consultancy work or construction or management fees, professional fees, things like that. It's never levied on any kind of product. On top of it, when you're importing a raw material that is used by smelters who are recycling scrap metal, it's a cost for recyclers, and that is a totally unheard of thing. Nowhere in the world do you have such a situation where you're telling recyclers who are doing environmental service that, hey, for recycling we're going to tax you guys. This is just totally unheard of. So we are requesting that at least on the imported scrap metal, 1.5% withholding tax should be removed. Thank you.
Chair, if I may just add to that, when we talk about withholding tax, it means we are withholding a tax which is being imposed here in Kenya. Now, when we are buying the product and importing it into Kenya, how then do we withhold the tax that would have otherwise been payable by the seller in that country? So enforcing this particular law is going to be a little difficult. So yes, like has been mentioned, our proposal is that we delete it. And if you look at the Act, paragraph 3 caters for withholding tax on scrap, on sale of scrap in Kenya. And I think that is where it was supposed to sit. But it was duplicated when we are dealing with non-residents. And non-residents, if they gave the service in Kenya, then it's easy to withhold that amount. But when I am buying it off the shelf, then it becomes difficult. Thank you.
Maybe our technical team, one of the things we should find out is how much has, since the law came to pass in December, whether there has been any collections on this, so that we test that implementation as claimed by KEM. Proceed.
Chair, maybe to confirm the challenges the sector is going through during importation after paying the prior taxes, excise duty, all that put together. This particular withholding, is it intended to levy on the total cost of the importation after all that taxes?
Yes. It is on the gross amount.
Chair, the next proposal is it's a new proposal on Section 12D on minimum tax under the Income Tax Act. Minimum tax was declared unconstitutional at the Court of Appeal, and there's been no further appeal, and we are proposing a deletion of those provisions in the Act. But as per now, they are not implemented because of the court decision. But that's just the part of the cleaning up of the Income Tax Act. So, Chair, we'll move to the value-added tax. As part of our enclosures, we had prepared a table because there's a lot of proposals moving items from exempt to zero rate and back on a lot of items.
Okay. Oh, please. Thank you. Thank you, Chair. I will try to break this down so that you help us to understand the thinking of the decisions, the policy decisions that are made when we shift products from zero rate to exempt. So when we look at that table, we are bringing out the three rates we have under VAT, where we have exempt, we have the 16% VAT, and we have the zero rate. Now, when exempt is applied on any product, on a finished product, animal feeds, adult diapers, motorcycles, what it means is that all overheads, all VAT incurred in the processing or manufacturing of these products form part of the cost of the finished product, because there is no provision to offset, to claim, or to refund. Now, when we say exempt, it then means that for manufacturers in Kenya, the VAT incurred will form part of the cost of that product. Now, assuming that the goods which are being imported into Kenya are such that there is no tax because they are export goods, it means when they land into Kenya, they will come in at 0%. So agrochemicals, animal feed, adult diapers, locally assembled mobile phones, getting into Kenya will come in at 0%.
So, honourable members, sorry, you have given us 4 documents. So they have moved to a different document. So it's not what we had on your screens. Proceed.
Sorry. Yes. So
you're
that
cross-cutting on both. I think now you need to remind us which one you're referring to, because you're the one who knows your document.
Sorry. So we are on the presentation to the economic overview of manufacturing sector. What is that?
It's the enclosure.
No, sorry.
Estimated impact on Finance Bill 2025, case studies.
Okay, sir. Proceed, that's fine.
Okay. So what it means is that the finished product imported will come into Kenya at exempt. Country of manufacturing outside Kenya will also not have charged VAT. While in Kenya we exempt the finished product, all the input to manufacture in Kenya is taxed VAT, and we cannot claim because of the fact that it is exempt. Now, if it is vatable, where we have 16%, then it means that the product coming into Kenya will pay 16% VAT. And the Kenyan product being manufactured in Kenya, at the point of manufacture, we will pay the input VAT and recoup that so that it does not form part of the cost of that item. But the manufacturer then does not include it because he does not bear it as a cost to the price. So being VATable is definitely a better position for manufacturers than exempt. Now, when we come to zero rate is a good place for manufacturers to be. I guess the only problem is when it comes to the refund process. If the system was efficient, then zero rate would work. Now, when we are at zero rate, the input VAT is refunded. So we do not have a double VAT tax on the finished product, because that amount is then refundable to the manufacturer. And even the imported product coming into the country will then not attract VAT. So there we have a level playing field, and manufacturers are comfortable to compete with imported goods. So our prayer is that we either allow the VAT to remain and probably try to understand why the mechanism of zero rate does not work. Right? So we would prefer to remain at zero rate for the products we produce, or pay a VAT, and if the rate can be nominal for manufacturing, so that it doesn't have to be 16. But if it is 16, we are better off at 16% VAT where we can offset than exempt. Then now there's a new proposal coming that if we are going to exempt the finished product, then we may wish to consider exempting the input, so that we don't have an exempt product and input to manufacture in Kenya is then VATable, which makes it difficult for us to do. And probably just to demonstrate the next slide. No, that's not the one. Okay, so in one of the documents we have demonstrated the position of paper, of paper bags, where we are saying today in Kenya, we want to exempt tea bags and coffee bags from VAT. We have exempted them at the same time from import duty under the Customs Management Act. The paper to make these bags, which we have exempted, we have imposed, it's coming later. Oh, sorry, I've jumped.
No, on that document that was up already.
Yeah, it's okay.
Oh, there.
Yeah. Right? So if you look at that table, the input to manufacture these packaging bags, which we have exempted from import duty, from excise duty, from VAT, attract a VAT of 16%. They attract an import duty of 35%. This is the input. They attract an export investment promotion levy of 10%. They attract RDL and IDF. So when we look at the total tax that a Kenyan manufacturer inputs to manufacture these products, which Kenya is proposing to exempt from tax, is 65%. Now, the imported one, which could be coming out of an EPZ, which could be coming out of a special economic zone into Kenya, or which is coming from the international agreement, free trade areas we're talking about, will pay 4.5%. So if you try and do the math between what we are proposing to exempt and what we have as policy for manufacturing, the picture doesn't demonstrate like we are then supporting local industry or manufacturing. So, Chair, our proposal is that that proposal is done away with completely. And we even look at the other areas to support industry to grow. If you look at, yes, can I just finish with this? So, Chair, one more. If you look at this slide is demonstrating our export position as Kenya. And we have tried to show against the years, and you can see where the dips are, the policy decisions that were made. So if this could inform the thinking or the decisions we then want to make, we believe that somebody will see that really we have never intended to take the dive that the numbers demonstrate. I submit. Thank you, Chair, but the manufacturers are here and they'd like to say something.
Yeah, so we'd like to...
Let's hear from the paper manufacturers.
Yeah, so through the Chair, and thank you very much for the opportunity, we have been participating in this activity, public participation, for the last 3 iterations. I think you can remember some of our passionate pleas. Without going much to repeat what has been said, we are at a serious inflection point, Bwana Chair. It is up to you now to decide whether you shall be meeting us again next year or not, because some of us will not be sitting here if this goes through. What you've effectively done is said, shut down manufacturers, move to import. That is what this law says. You are taxing us to ensure that people who produce in other countries, and in this case specifically Sri Lanka, will be able to land their product cheaper into Kenya than we are able to manufacture. And this is no longer speculation. We have already shut down factories in Mombasa, as I passionately explained 2 years ago. Now, with this law, basically those who consolidated to survive will have to shut down. That means all the tea exported from Kenya will no longer be exported from any packaging manufactured in Kenya. Let me also emphasize, as manufacturers, we have installed capacity in Kenya to produce over 70 million tea sacks. The current market is at 12 million, and that includes Rwanda, Burundi, Tanzania, and Uganda. The largest tender that exists for tea sacks in the region comes from KTDA. It was just awarded yesterday. Of the 4.5 million sack award, 1.2 was given to Dune, sitting next to me. 1.2 was given to us at Bags and Balers. 1.2 was given to King Plastic. And 900,000 sacks were awarded to importers. Whilst the 1.2 is nothing compared to what we can produce. Yet we keep open factories, we are employing people, we're paying taxes. So we would like to understand, if the idea is to grow manufacturing, why would you impose this kind of tax?
Sorry to interrupt.
Yeah.
Are you speaking to clause 36?
36.
36 is
amendment to the first schedule of the Act, inclusion of packaging materials for tea and coffee in the exempt category.
But our understanding is that they are moving from vatable to exempt.
That's correct, but it does not assist us, because once they're exempt, we cannot claim back the VAT, and we have to pay the VAT. So the VAT...
So you will prefer to remain vatable than to...
Absolutely, because you see, the people bringing in the finished good, they bring it in exempt. You have allowed them now to bring it exempt, correct? As she's just explained, as a manufacturer, the paper I bring in, which is vatable, if I'm exempt, I have no mechanic to claim it back.
Chair,
yeah.
I don't know whether we are understanding ourselves, because which one is better, double, if we have to do double, standard and exempt?
So there are several issues at play here. First of all, if you look at the table, if you can go back to it, because VAT is just one of the issues. You just go back to the table. What we are saying here is, if you look, there are two columns. One column is imported raw materials for manufacture of T-sacks. We have to import raw materials to manufacture. You see, we are charged 16% VAT, which under exempt is not recoverable, therefore becomes a permanent cost to manufacture. So under exempt, it does not favor us. However, the guy importing, having used Sri Lankans in Sri Lanka, sending money to Sri Lanka, he's exempt. Please stay on that slide. I don't know why you changed it. Whoever is moving the slides around. I know it's to explain, but if you could explain, if you could stay on that slide, please. Thank you. So that's number one, that's VAT. Second, import duty. Import duty, you are hitting us with a whopping to 35% import duty on the paper.
Plus 10.
Plus another 10 export promotion levy. I don't know, it doesn't make sense. You can't call that an export promotion levy. That is an export demotion levy, okay? Then your RDL has gone up from 1.5 to 2. IDF has gone up from 2 to 2.5. So the total tax on my inputs as a manufacturer is 65%. Then you turn around and tell the guy from Sri Lanka, lakini lete yako free. Who are we helping?
Actually, I know, my friend, you are very passionate. I remember last time I saw you, you came with a lot of packaging materials in the presentation room. But actually, your point is noted. This analysis is very good. You know, at times, when you are doing a presentation, we need information like this. So based on this one, we can make a decision.
Yeah,
so I don't want you to be emotional. I know you are already emotional because you are likely to close.
Because our factories are shutting down whilst we are taking time. This is the third time you presented this. The third time, eh?
Yes, but
the same information.
But now this presentation makes a lot of sense. You know,
the other thing I'd like to just point out, we did a national verification exercise on paper.
Yeah.
Treasury was involved. Their signatures are here. Finance was involved. KEPSA was involved. Industry was involved. You've all signed off on this. This is a government position now, but you're not respecting the same document. So the passion is because in between the iterations of this public participation, we are closing factories and we're not being listened to. So I will rest there because I'm being urged to allow others to speak. But anyways, be that as it may, in case we don't see each other next year, fare thee well.
No, we will see you. We will definitely going to see you.
Chair, I think you need to call upon the witness to withdraw that statement. In our traditions and our African culture, the moment you bid buy, it implies bad omen, so you don't bid buy. You'd rather use another software to explain the stress in the sector, but not to bid buy. It sounds like you will be going the other side, you know?
No, apologies, but whilst it's a discussion here, actually lives are being ruined. Between the last time I submitted and this time, we have had to let go so many people. The economy is struggling. It seems we are talking to a wall. So anyways, I will not say goodbye.
Actually, Chair, I don't think he means what he is meaning that he's not going to come for presentation in this kind of forum because they will have closed down. I think that's what my understanding.
No, it's only my absence that I'm saying.
Yeah, but Chair, I think this is a very important point, and I think if we can bring in the sector and KRA and Treasury to understand the repercussions of what they are proposing, because these are not our proposals. These are proposals from government, from national treasury, right, and KRA. So, but I think this makes a lot of sense to me.
So, honourable members, we do not need any more engagement with KRA or National Treasury. It is our decision to make. Okay. And the decision that we make is what will be law. So the manufacturer is right in place to say that he's speaking to the right people, and no other meeting is needed. Proceed with the presentation.
Thank you, Chair. So, Chair, the proposal and the justification that has been given is for clause 36(O). And the proposal after the presentations that we've made to explain, our proposal is to amend this clause 36O to introduce VAT exemption on inputs for the manufacture of packaging bags rather than the finished products. So what should be exempted is the inputs, as opposed to what is being proposed, that the exemption is for packaging materials for tea and coffee, so that we can support in local investments in the country, as opposed to making imports cheaper. So that is on 36CO. So Chair, we'll go back to item 10 under clause M, which is on the issue to do with imports and raw materials used in the manufacture of passenger motor vehicles. The proposal is for removal from zero rate to the exempt schedule, and our proposal is to retain inputs and raw materials used in the manufacture of passenger motor vehicles under the zero rate, or exempt the inputs and raw materials used in the manufacture of passenger motor vehicles.
Proceed, sorry.
Okay.
There is a letter that was written to us by the Ministry of Agriculture on the 26th of May, proposing further amendments, and I realize packaging materials are here. And considering that you don't seem to be speaking with this on the same page with the policy makers, I thought it's important that you go through them so that you give us your views on them as we finish, so that we don't catch you by surprise again by thinking that that is whatever the Minister of Agriculture is recommending is the right thing, only to realize, like what you are saying to us, the impact of it is the opposite of what it's intended to do. Proceed.
Okay.
Thank you, Chair. I think, yes, they'll circulate the copy. And Chair, I think the Ministry of Agriculture is looking at the best interest, and they're actually speaking to what we are saying, that packaging material in the country for tea and coffee is quite expensive, and it's the justification that we've given there. So they are proposing a reduction, but what, of course, they are not seeing is that they want to help the tea and coffee farmers to export, but if they pass it as it is, they are going to encourage more imports than local manufacturing. So this is what is helping us now to trigger the proposals that industry is making, that we must reduce the cost of packaging in the country so that we benefit as a nation from the jobs, from the investments, and we are able to move on. So the proposal to support what the Ministry of Agriculture is saying is that we exempt the inputs for the manufacture of packaging bags. And that will be able to be a win-win solution for the industry to supply this to the tea and coffee manufacturer, farmers who are exporting. And then now the ones that are coming in will be more expensive, and we get to retain the jobs and investments. So that's under clause 36.0. So I'd given our proposals on 36M. So we are moving to clause 36N. It's on local manufactured motor vehicles, which are now being proposed to be vatable, 16% VAT. Our proposal is to zero rate locally manufactured passenger motor vehicles. The proposal is to remove them from the zero rate, and the request is to retain them based on the analysis that we have done in terms of the impact of moving an item from exempt to, from zero rate to exempt or to 16%. Similarly, we have another proposal under clause 36O. No, I think this is what we have already gone through, so we won't repeat that. No. I think there's one on medicaments. It's on the new paragraph 155, and our proposal is to delete this clause so that we retain medicaments, raw material inputs and raw materials for the manufacture of medicaments under the zero rate status. I'll allow Dr. Rohin to just highlight in a few minutes.
Thank you, Miriam. Chair, what has happened, if we look at clause 37 36A, which is item 20, together with clause 36O, which is item 12. So currently where the pharmaceutical manufacturers are operating under a zero rating regime for inputs and raw materials, whether it's locally procured or imported. And the proposal currently is to then move it from zero rating to exempt. As you're aware, all medicaments is already under the exempt schedule. So what will happen now, if the inputs are moved from zero rating to exempt, if we buy any packaging material from our colleagues, the paper manufacturers or the cartons, what will happen is they will not be able to claim their VAT back by virtue of the fact that they will be supplying us exempt items, and automatically they will increase their cost to us, depending on how much it is, and that will increase the cost of our inputs, which we buy locally. That will lead to an increase in prices from the region of 3 to 7% of local medicaments, which will make us a little bit uncompetitive versus imports. And also remember, we will not be able to claim that. So we will put all that in our costs. And also for exports, we will again lose our competitiveness. As you're aware, there's a lot of investment going in, or you may not be aware, currently in Uganda and Tanzania for local manufacturers, whereas in Kenya, it's not as much, more because of the support being given. And what we want to do, we used to be the big brother. Lately, what's happening is I think we're becoming sort of equal or the younger brother in local manufacturers. So our proposal is to keep it under the zero rating regime, which is the inputs and raw materials for pharmaceutical manufacturers. Chair, there was also something that I picked up while I was sitting here on the glass bottles. Somebody mentioned that they wanted to add, one of the previous presenters mentioned they wanted to add specific duty on glass bottles. All types of glass bottles. Unfortunately, there is no local manufacturer for pharmaceutical bottles. And if you notice that there is no excise duty on pharmaceutical bottles, it's exempted. So please make a note of that. Thank you, Chair.
Thank you, Chair. So we'll move to item 14. We have jumped clause item 13, which is clause 36.0, paragraph 164, because we have already submitted on that. So we move to new paragraph 158. It's on the supply of locally assembled and manufactured mobile phones. The proposal is to move them from the zero rate to exempt. Similarly, Chair, we are proposing that we exempt the items, the inputs. So we either retain it at zero rate or we exempt the inputs. So, Chair, I think one of the things that we have seen is that the Treasury and the Kenya Revenue Authority are trying to move away from zero rate. And we do understand it's because of the refund issues. But we've seen that in some other items, as we have presented, if we move those items from zero rate, we are going to have a situation where it supports importers. So the ones where we see we are going to have a negative impact is where we are proposing to retain them at zero rate, and where we see that we need to retain them at exempt, we are proposing that the inputs are also exempted so that we support the local manufacturing in the country. So this is the same on the locally assembled mobile phones, and this is one of the new investments into the country in terms of assembly of mobile phones, and the request is that we retain them at the zero rate status, and we have given the justification there. The next proposal similarly is on...
Sorry, let me take you back.
Yes.
On the excise duty on imported glass bottles, we have one of the stakeholders earlier today recommending that we propose introducing a specific excise duty of USD 350 per metric ton on imported glass bottles, supplementing the current 5% duty rate. The applicable duty shall be whichever is higher. Would that Will that be what
Chair,
you...
Yeah, Chair, what I'm saying is currently there is no local manufacturer of pharmaceutical glass bottles. So even under the duty regime, under excise duty, there is no excise duty on, there's an exemption for pharmaceutical glass bottles in the current acts.
Do you have any of the bottle manufacturers here?
Sorry?
We don't have the glass manufacturers here, but we do have glass manufacturers in the country. And there's actually an excise on glass currently, but which exempts pharmaceutical items.
Yeah, but if we have glass manufacturers in Kenya, why are they not manufacturing?
This is, Chairman, this should be a sector position.
Hold on, Vice Chair. There's someone who wants to respond.
Yeah, thank you, Chair. So, Chair, what happens is getting a mold for manufacturing all these types of glass bottles becomes very expensive. So I'll give you an example. A member from CAM came up to us. As we all know, avocado oil is becoming a very important product to be exported. So what we do in Kenya today, we export avocado oil in bulk in 1,000-liter bags and export it to New Zealand or Dubai or Europe. They then create the next value addition and pack it in bottles and label them and box them and then sell it on retail counters. Because we don't have the bottles of what they want to pack it in. Okay? So Germany wanted to import from Kenya. We didn't have the bottles they want. So what is then going to happen is, if we import the bottles and pay that excise, then the product is not going to be sellable and it's not going to be competitive. So we need to consider, whatever decision we make, is whatever bottles are made locally, we don't mind having a position as a sector, but whatever bottles are imported, which are not available locally, we need to have a specific structure in place so that we don't make our products more expensive. Thank you, Chair.
Chair, so there's a sector position that pharmaceutical bottles are not available.
Yeah, Chair.
Locally.
Because they're 50 ml, 60 ml, and 100 and 200 ml. Those are not available locally.
Chairman, there is already excise on bottles, so I don't know what they are talking of another excise. There is already 35%, 25%.
The issue is, there are two ways of applying a rate. You have a percentage of the value or based on weight. And I think probably from whatever they're coming from, we have seen this with tiles and ceramics, where because they're very weighty products, there is the declaration on the import, on the value of the product is under-declared, so that they minimize on the, whether it's the import duty or the excise duty. So for those bulky products, for those high weight products, then it becomes easier, it becomes better to charge them on weight and not on value, because otherwise then someone brings a whole container of glass and they say it's worth 1 million shillings when it's at 10 million. But when it's on weight, you have to measure the weight of those particular products.
But Chairman, agreed.
Yeah.
But they have to prove with workings that if it is 35% duty, the equivalent specific. In KEM, we bring this proposal, all the metal sector has it, but we have evidence and we have our team checking the working. What has happened this budget, I saw from the treasury, 200 shilling a kilo, every item 200. Justify 200 shilling you are getting how? That is the question Parliament should be asking. And we'll help you.
Yeah. So, Chair,
lastly on this matter of glasses.
Yeah, so it's called specific duty. And at CAM, we have a formula which we use to give and calculate specific duty. We cannot just say charge $1,000 a ton. Okay, whatever duty is implicated, say 25%. What is 25% of duty per ton? That is what the specific duty should be. Okay, and that is what we should all look at. We cannot overprotect, otherwise we will not be doing justice to the other sectors. Thank you, Chair.
Okay, so you proceed.
Yes, and Chair, we are willing to submit a proposal with regard to that.
Can I just say one thing? Chair, and I think it's maybe to set context on a lot of things, is that there are proposals that we heard earlier on which were touching on aluminium, specific rates to be introduced, glass, paper, and the presenter is saying these are new proposals. And we're here discussing a bill in which we've all publicly seen and not had an opportunity then to be able to counter a proposal. I think it's so important that anything that comes new that may touch on manufacturing really needs to be considered as what's the impact of that. So all of these specific duties, as we've learned in the past, when we unpack them, they've either been good or some have been very bad for manufacturing. So I implore that anything new be given or can be given an opportunity to interrogate so that it doesn't become something that becomes of contention later on. Thank you.
That is why the document I've shared with you is a confidential letter. But then when I realized it's touching on manufacturers, I was like, can we hear your side of the story? That's what you're doing. And it's okay, even if you feel you're not ready now to comment on that letter from the Ministry of Agriculture on those particular measures, you can go and have a discussion, and you can invite you for another meeting before you complete our public participation. That's exactly what you're doing. Yeah.
Thank you.
Chair, we appreciate and we're happy to get the feedback. Chair, we can move to the other item. It's clause 36O. It's paragraph 159. It's on motorcycles of tariff heading 87116000, which are being proposed to be removed from the zero rate. The proposal from the industry is that we retain the supply of locally assembled electric motorcycles on the zero rate. And I think it's based on also the previous presentations that had been done. The other proposal is similarly on the same clause, but paragraph 161, supply of solar and lithium batteries. And the proposal is in the finance bill, to move them to the exempt status. The industry proposes that we retain it at the zero rate. The other proposal is on clause 37E, paragraph 31. It's on the electric bicycles. Similarly, they are being proposed to be removed from the zero rates, to move to exempt, and the industry requests that we retain the same at zero rates. Clause 37G, paragraph 33, items to do with electric buses, similarly proposed to be removed from zero rates, and the industry recommends, the industry's proposal is to retain them at zero rates, and to further introduce a 16% VAT on fully built imported electric buses so that we can support local investments in the country. We have a new proposal on zero rating of locally manufactured buses. The proposal will be in line with the proposals that are already there, and it's to provide for zero rating of locally manufactured buses by amending the first schedule to exempt both buses and inputs. Apologies. So the first proposal is to zero rate locally manufactured buses, or we either exempt both the buses and inputs for the manufacture of buses. So yes, so it's similarly, either we are zero rating or we are exempting their inputs for the manufacture of buses so that we make them competitive, but this is a new proposal. Then we move to clause 37A on raw materials for the manufacture of medicaments from the zero rate status. This is similar to what we had indicated earlier. We have another new proposal to introduce provisions to allow for refund of excess tax arising from zero-rated supplies that were assessed before the change of the formula. This is a proposal that we have been putting forward, that a number of manufacturers were unable to claim their refunds because of the changes that were made to the formula for VAT input-output adjustments. So the request is for extension of that period to allow the manufacturers who are unable to claim at that time to be able to receive their refunds prior to that period. The other new proposal is on promotion of locally manufactured textile products. We are proposing that we revert back the fabrics of heading 5407 back to 16% VAT. What had happened in the Tax Laws Amendment Act is that there was a proposal that exempted goods of Chapter 5407 and Chapter 6309 as raw materials for manufacture of textile products in the country. So when we looked at these raw materials, we confirmed from the industry that these products are locally produced and they shouldn't have been moved to the zero rate status. So the proposal is to move it to 16%. I think the chair of the sector.
Thank you.
Comment, yes.
Chair, we had an introduction of a legislation in December, which actually was on 5407 and 6309. The 6309 is basically import of second-hand materials or second-hand clothing, which was going to be treated as raw material for making new garments or changing the garments. Now, this seems a very far-fetched reality on the ground. We hardly see any products which are actually in this particular category, and we import so much second-hand clothing, which we have now become the largest importer of second-hand clothing in Africa in 2023. So this is one of the areas where we see that this is not a reality, and we need to remove what we have given as benefits of IDF, RDL, and even for wet exemptions. Those need to be removed from this particular tariff. On the 5407, similar things. We are making fabrics. I have some fabrics here which are made locally, which come and fall under the 25407. These are locally manufactured products, and they have been exempt from RDL, IDL. And we have the capacity to feed the local requirements through our local industry, which is Sunflag, Thika Cloth Mills, Rivertex, which are currently running at around between 40 to 50% of their capacities. And we are allowing more cheap imports to come into the country, which is creating a problem for the local industry at the moment. So these need to be rectified and taken them back to applying the IDF, RDL, and VAT exemptions which have been given on these particular items. On the whole, the sector is on a downward trend. If you look at the local manufacturing year on year, if you look at the tax returns given to the KRA are coming down over the last 3-4 years. Every year they've been dropping. And this is also to say that the sector is in dire straits and literally limping at the moment. So we really need support on various levels from the government to revive and to reboot this sector. Although we understand or we know that the textile cotton sector is doing a lot more in terms of growing the cotton, taking it down to the ginneries, the spinning, making it into fabric, and taking it forward to garmenting. If we do have this type of incentive given to imports, then we are also restraining our cotton mills to move forward, and also that will affect the agriculture sector. The cotton growing sector will also be an issue going forward. So these are some of the issues that we need to really rectify. Coming back to the textile sector, there is a lot of opportunity to grow, and as the government has also identified as one of the sectors with leather to be given importance so that it grows and really creates the employment which it can and has the potential to do that. So this is one of the things that we really need to understand. Now, if you look at the slide there, on Mitumba we have goods coming in which are also like new. If you look at the two pictures, this bottom one is like dresses just like new, which are coming in as imported in Mitumba. And if you go to some of the vendors which are selling second-hand clothing, you can also find shirts of the same type with 4 or 5 different colors. If that is the case, then are we saying this is really second-hand? And there has to be some change in the way that we need to bring about how do we actually control this to really make our potential of the textile industry to grow. And one of the things which I would like to suggest is, although it's not in the document because this is something of an idea which came about, if the government can put in place, all second-hand clothing coming in has to be graded so that we don't allow non-reusable garments coming in, and that way we will also identify what is the new clothing coming in. At the same time, what is happening in the Dandora site of dumping, where we find a lot of clothing which are landing up in dump site, which are totally non-reusable. So those are the factors also on the environment side, which is creating an havoc. So with this submission, I would say that the parliamentary committee looks at that and try to bring in more policy matters and justification for this textile sector to grow. Thank you.
The second-hand clothes, they now have a name for it. They are called thrifts.
They called?
Thrift.
Thrift.
Yes. The amendment to this on this Mitumba, the example of this textile, and maybe as practitioners in the sector, you may advise this committee, was a thinking that, or presentation from stakeholders that there are manufacturers of pillows and mattresses, and now what they use to make those pillows and mattresses is from those, so they buy the quote-unquote mitumba in bulk, and then they do something on them, convert that into foam, and that makes mattresses and pillows. And now the thinking then was that then that becomes a raw material that is being used to make pillows and mattresses. So maybe you could tell us whether that is the correct. You are the practitioners in that sector. You seem to have an.
So thank you, Chair. On that one, there is a certain amount which can be done that way. And for the blanket manufacturers in Kenya, we've been doing this time immemorial. In the 60s, we were doing it. So that's not new to us in that sense. But if you look at the volumes that are coming in, it doesn't match any of what we are talking about. If you look at the quantum of things which are made, mattresses and pillows, where are they? Who is doing them? Where is the plant? Can somebody go and see it? It's happening. How much of it is happening? Let's validate everything that is there on ground to understand what. And then why do we need to exempt everything? Just give it to the manufacturer, exempt. That will save the rest of it. So it should be specific to a manufacturer.
But it is specific to manufacturing. It says taxable goods of Chapter 5407 and Chapter 309 imported as raw materials for manufacture of textile products in Kenya upon recommendation by the Cabinet Secretary responsible for investments, trade and industry.
Yeah, so that is true, but we need to have validation of the amounts and things that will help the Commissioner to also understand what he needs to exempt and how much.
Lastly on that, and we move progress.
Thank you, Chair. I think the sector chair has stated that probably we would want to understand or to know how many companies have been set up to do that shredding and are actually making the garments that are coming in or the articles that are coming in under second-hand clothing. Secondly, it's important to note that this has been zero-rated. This has been zero-rated, yet we do not have the industry running as yet. Now, if we look at the trend of second-hand clothing into Kenya, it's on an upward trend. And the industries we are talking about do not exist yet. So it's important that even as we want to do it, and at the same time, on the other hand, we are saying we want to grow the textile sector, we want to look at the two items together at the same time, just so that we are not killing the legit industry for this imaginary industry. And like the chair has said, in the early 60s, we were using it to make blankets. If you look at the blanket industry today, it has reduced. The number of companies producing as compared to the time using this particular raw material has reduced, if we have any at all. So ours is, let us, in fact, restrict it. Take it to a position where it is restricted and controlled if it is to continue. But otherwise, the zero rate that has been given there is for products of Chapter 63 or 6309, which means all second-hand clothing can come in under that particular zero rate. So our prayer is that even if we are going to do that, let it be done, but let it be done where we have legit business. If we don't, it's important that we protect the existing industries. Thank you.
So it is your admission that there is none of your members that is using textiles.
There's none.
Second-hand textile to manufacture mattresses and pillows. I proceed.
Chair, just to add on that is that we have an interesting case where the Ministry of Environment and NEMA are now requiring companies to collect used materials in the country. So we would have preferred whoever it is who's proposing these proposals can actually start with what is in the country that they're saying is waste materials. But it's, as the sector is saying, this is just a conduit to import more of used materials. And you can see from what the sector is saying that we've reduced the textile industries in Kenya, and we have about 30 remaining from the 80 that we had in the country. So this will be one of the loopholes that we are bringing in more second-hand. Chair, will move to the other proposal, which is a new proposal. It's a proposal to exempt inputs for local manufacturing of denatured bioethanol for cooking. The proposal is to have inputs and raw materials locally purchased or imported for the manufacture of denatured bioethanol for cooking, exempted. And we've given the justification. So, Chair, those are the proposals under the VAT Act that we have proposed. We'll move now to the Excise Act. The first proposal is on float glass. There's a proposal under the Finance Bill to amend the first schedule to introduce the items imported float glass. We propose to amend the unit of measure to align with the East African Common External Tariff Book to read as follows: excise duty rate of 35% of Kenya shillings 300 per square meter, or whichever is higher. What is indicated here is Kenya shillings 200 per kg. So the proposal is to revert back to what is provided for under the common external tariff, which is square meters as opposed to kgs. The other proposal is to exempt glass processors sourcing float glass to produce toughened and laminated glass from the excise duty. Tanzania and Uganda, from what we have seen, have also done a similar exemption since there is no local producer for such items. Chair, this is one of the proposals that was introduced under the recent Excise Duty Amendment Act of 2025. Chair, one of the things that we saw in this proposal was also the issue to do with backdating of taxes.
Repeat that. Repeat it.
I think it's, yes.
Backdating. Chairman, backdating of taxes.
So, Chair, the other third proposal that we are making on this issue of float glass is to delete the date in the Excise Amendment Act 2025 that introduced this float glass.
The documents you have and what you have are two different documents. So
This
you have
is the
to go
memorandum.
through different.
Sorry.
Let them find otherwise, chairman will not hear and our proposal will stay in the air.
Yes.
So we are on the same page now.
Okay. So, Chair, we are on the clause 42A3, which is on float glass. This proposal was initially introduced under the recent Excise Duty Amendment Act of 2025. So the proposal and the finance bill has now introduced the value, the exercisable value. But, Chair, we have additional amendments and proposals to this proposal. The first one is to amend the unit of measure to align to the East African Common External Tariff alignment in terms of from kgs to square meters. What is indicated in the finance bill is kgs, but if you look at the import duty common external tariff, it is actually in square meters. And Chair, what the industry tells us is that this has a huge impact in terms of cost if we don't correct some of these small issues that are being included here. The other proposal is for exemption of glass processors sourcing float glass to produce toughened and laminated glass from the excise duty. Kenya has a thriving industry producing toughened and laminated glass. So their exemption would be quite useful so that they are not affected. And this was already proposed in the previous Tax Laws Amendment Act. And the Excise Amendment Act now came in to remove this. Then the third proposal is to delete the date in the Excise Duty Amendment Act of 2025 that backdated the tax to December. And yet the act came into place in last month. Chair, in terms of the issue to do with backdating, this matter was litigated in courts. And in fact, this the National Assembly actually has a bill that seeks to now clean up and make sure that the issue to do with backdating of taxes is not doesn't occur because it was declared unconstitutional. And we've been able to put the High Court case. You can see the judgment around backdating. And also, of course, supporting that it is actually unfair. When the Excise Duty Amendment Act was passed last month, industries were being forced to pay taxes back to December, and which was quite unfair. So we request that that is also corrected under the Excise Duty Amendment Act so that we don't have, of course, challenges in court over such items. What was previously there was the Provision Collection of Taxes and Duties Act, which was declared unconstitutional. And there is now a bill in the National Assembly which seeks to amend this.
This amendment was done in which law?
Under the Excise Duty Amendment Act of 2025, there were two proposals. It was signed last month. The one on transformers, and another one that was there was this issue of float glass. Yeah. Just two items. Just two items that were Excise Act, clause 42A3. So clause 42A3 is on float glass.
Again, you're saying in the parent act of Excise Act, you said which section of?
So you're saying in the excess duty amendment bill that we did the other day?
Yes.
It was backdating?
Yes, the tax to December.
Oh, so the with effective date was?
December 2024. And yet the law was passed last month. So, and we are saying that the backdating was already outlawed.
The bill in Parliament. I think, Chair, what we are saying is retrospective application or drawing laws to serve what had passed would be a bad trend. And it's difficult for business to then collect that money to pay for what was that isn't. Thank you.
Chair, we've just confirmed that the bill that is currently in the National Assembly is the Provision, Collection of Taxes and Duties Repeal Bill that is pending to be passed based on the decision of the court that the Constitution does not allow backdating of taxes. So that is also a proposal that the industry seeks to get amended so that we don't leave it on as part of the Act, and then also to move back to square meters as opposed to the kgs that is proposed under this proposal, and to exempt the float, the glass processors, sourcing float glass to produce toughened and laminated glass. And Chair, this is one of the reprieves that we had gotten under the Tax Laws Amendment Act, where we were able to see that we have capacity in the country to produce toughened and laminated glass, and we were able to protect them. The only challenge was that the description and the tariff number were conflicting, and that was the only correction that was needed. But of course, out of that, what came out from the Excise Duty Amendment Act was totally different provision that was now charging float gas at a higher rate and even backdating it. Chair. Okay. You want to say something?
Yeah, so Chair, I represent the glass subsector chair. Now, through this backdating issue that had happened, we had close to 100 containers coming in, and just because before Easter's break, we find out when operations started right after Easter's, we find that the excise duty was imposed and 200 shillings per kg. This means a container that is worth 1.8 million shillings, you have to pay a duty of 6 million shillings. The repercussions are so bad. Till date, we have the glass processors without the raw material. As is mentioned here, 7005 is a core raw material. We have processors right now who have invested close to 120 million shillings or 130 million shillings in their plant. They're left without any float glass right now. So the repercussions for the backdating or whatever this Ms. Miriam has mentioned, the repercussions have been really diabolical.
And Chair, just to add that we don't have a local float glass manufacturer in the country. What we have are toughened and laminated glass processors in the country who contribute to revenue. So Chair, we'll move to
Chairman,
yes.
Unfortunately, as a Kenyan, we were supporting Tanzanian company, and they never support Kenyans. Though that person must be in Kenya, but I think if it's a Tanzania company, we look at it differently. We must look about our country. So this was a very ambushed thing that happened. And you know, that's a predict the unpredictable and expect the unexpected. That is what we are seeing, which we need to get out from.
Thank you, Chair. Chair, we can move to the next proposal, which is on clause 42A 6. It's on spirits of undenatured extra neutral alcohol. The proposal is to reduce that to 250, but Chair, we are aware that the ABAC Association had presented similar proposals and which we have been able to align on clause item 25, clause 42A 6, also on
Miriam, I can take this one.
Yeah, Miriam.
Yes.
I can take this. Yeah.
On the next one, yes. So, Chair, all the proposals on alcohol, we've aligned with the ABAC Association, and whatever they had presented is actually here, so we can have them on record, but we will not go through them today because they've already been presented, so that we move to the next proposal, which is in item 26, clause 42A, 6. It's on introduction of excise duty on polymers of the tariffs that have been given. Our proposal is to delete this excise duty,
let me take this one.
and then I will allow Hitesh to give the justification.
Chair, this proposal we'd brought to you twice, I think now. What happened is that excise duty has been introduced on several tariff lines within the plastic sector, more around sheet plastics and different kinds of forms of plastics. Chair, what was not done at the time was to understand what is the cross-sector impact of that decision. And the furniture manufacturers' inputs for the last, I think it's 2 or 3 years, have been subjected to excise. There's 2 specific inputs that we use. One is PVC edge banding for closing the edges of furniture. And another one is PVC laminates when we actually laminate and make kitchen and wardrobe doors. Now, what we've done is, first of all, Chair, none of these 2 particular products are actually made in the EAC. In fact, I don't even know of a producer in Africa. So I don't know who we're seeking to protect. That is what I was completely baffled about. The second thing, Chair, is we've actually demonstrated over here that, and this is specifically to the input on 3920, 4390, is that should the bill pass as it is at 200 shillings per kilo, the effective rate of excise on PVC edge banding will be 50%, and the effective rate on laminated PVC or PVC laminates would be 65%. This is in addition to the 25% duty that already exists. So technically, post-finance bill, the total tax on importation of PVC edge banding will be 75%, and on PVC laminates will be 90%. Now, Chair, I've bought some products here for demonstration, which I wanted to show you.
Chair, what he is saying, specific duty is just got a number from air and put it without any scientific basis.
Chair, further to that, yeah, so Chair, what you're holding is, there's that in your hand right now, that one, the round one, yeah? That's a PVC edge banding. Now, the furniture sector has, let's say, about 70 to 80 different wood grain finishes on timber, laminated timber. So we need 70 to 80 different kinds of those PVC profiles to be made so that we can seal off the ends of furniture. It's an extremely complex process, and there's no manufacturer. The other one you're holding, Chair, right now in your hand is laminates. And yeah, those laminates, there's another, I gave you a little door, that a little wooden door there. Yeah, that one. Now, what's on that door? It's a miniature door. That laminate which you have in your right, that hand is laminated onto that piece of wood, okay? Now, we used to export these laminated doors, or what we call wrap doors, into Uganda. We no longer export them for the last 2 years because the impact on our cost of production on that door is 25% increase in our cost of production. So since we've had a 25% increase in cost of production, we've seen exports drop. So Chair, what we're saying is that, again, this was done without an impact analysis on cross-sector. Our request is that furniture manufacturers either be exempt from this excise duty on their inputs, specifically on 3920, 4390. But again, the 200 shillings that is being proposed across all of these plastic products ought to be subjected to an impact analysis, please.
In your case, what would it be?
Sorry?
In your case, what would it be?
In our case, we're saying in terms of taxes, it comes to 90% total taxes paid on imports on that. So, Chair, yeah, I submit, and I also see that this is also impacting other manufacturers who have actually raised situations around labels for bottles, food containers, cosmetics. So it's actually going beyond even the furniture sector. It's touching on several different sectors. And yeah, so Chair, we'd request either the removal or an exemption of this excise.
Chair, let us support manufacturing.
Thank you.
Thank you, Chair. We'll move to the next proposal. It's a new proposal to exempt industrial and medical gas cylinders of the tariff numbers we've indicated, 73110090. This is based on the item imported glass cylinders that is currently under the Excise Act. So we are proposing that we exempt industrial and medical gas cylinders from the current excise duty on imported gas cylinders generally. And the justification is that the industrial and medical gas cylinders used for storing, transporting industrial gases. And maybe just to highlight that one of the sectors that really supported the country during the COVID-19 pandemic was actually the medical gas industries. So the proposal is to exempt them from this so that they are not affected from the general gas cylinders that are LPG cylinders that are used in the country. The next proposal is item 28. It's on imported printing ink. Okay. We are proposing to amend the Excise Duty Act to exempt and remove excise duty on inks of the tariff numbers 321511, 321519. Chair, we do have manufacturers who produce the inks, but we had consensus with them that there are items that they are unable to produce, and they are these particular tariff numbers, and we've been able to hand over to you a signed proposal and agreement and a position between the industry on the items that they are unable to produce. So the exemption is for these two particular tariff numbers, which are used to prepare offset printing ink, solvent inks. We've listed the items over there, but we have tariff numbers, so we are able to exempt what is not locally produced. But this is one of the proposals that we appreciate the support of the committee to protect the industries who are producing this. The next proposal is item 29. It's a new proposal on introducing excise duty on safety glass. It's related to the item that we had talked about earlier, and it's for protection of this safety glass of 7007-19 and 7007-29 at the rate of 35% of Kenya shillings per square meter, or whichever is higher. The product is made locally from float glass, and we already have 7 glass processors in the country. So the proposal is introduce excise duty to protect the industry. We've given the justification and also the competitiveness to support this request to continue supporting the industry. We move to item 30. It's on acrylic polymers. It's also a new proposal that we're proposing to be considered under the Finance Bill to amend Excise Duty Act to remove excise on acrylic polymers of HS code 39069000. Chair, there is excise duty on a number of resins materials, but similarly, we have items that are not locally produced. And for this, we conducted a joint verification mission between the industries to go and verify what capacities we have in the country. We are calling it the Resins Verification Report of 2023. Also together with the Ministry of Industrialization, the National Treasury, KRA, Kenya Bureau of Standards, and we were able to outline what we produce locally and what we don't produce locally. So this particular item is not produced locally, and you can see it also is used to produce inks, and it's still part of the proposal that we were making. And this Resins Verification Report is signed off by the government agencies and ourselves. Chair, one of the things that we noted this year is that we need to include the National Assembly and especially this committee as part of these verification reports, because we seem to be working with the executive, but when it comes to tabling some of these reports where we have gone across the country, we have verified company by company their capacities, the committee still is unaware of some of these commitments. So as an undertaking at CAM and together with the Ministry of Industrialization, we've agreed that we will ensure that the National Assembly is part of such verification so that you can also own some of these reports. But the report, we can hand it over to the committee for purposes of your records. The other item is 31. It's a new proposal on imported unsaturated polyester. Our proposal is to remove excise duty on this particular item. It's just one HS code 39079100. Similarly, it's not produced in the country, and it's just this specific item that we are proposing to be removed. The next proposal is 32. It's on similarly on imported saturated polyester. The tariff number is 39079900. The proposal is to remove the same, which is used for the manufacture of biodegradable or compostable inks. So this is similar to, still related to the verification that was done on the items which we are unable to produce here in Kenya. But for the others where we are able to produce, we are still retaining the excise duty on those items. The next proposal is on item 33, first schedule of the Excise Duty Act. We are proposing to amend the Act to exempt ink and automotive paint manufacturers from the excise duty of those particular tariff numbers. Again, this is similar, just based on the raisins verification reports, where we don't have capacity to produce. We have indicated the ones that are still being retained are where we have capacity as industry. So that we don't increase the cost of some of these items, and yet we are not producing locally. The next proposal is item 34, articles of plastic. Our proposal is removal of excise duty of 10% on articles of plastics on the local manufacturers. The proposal is general and includes both imported items and locally manufactured. And what we've seen is that it has created a cost advantage to the importers as opposed to the local manufacturers. And the local manufacturers already are paying a lot of regulatory charges in the country. And we are proposing that they are exempted from this tax and we retain it on imports so that we can grow the industry, which supplies a lot of their packaging to the manufacturing sector. The next proposal is on the item 35. This is a new proposal to amend the Excise Duty Act to provide for allowance for spirits and processing and transit losses. This is from the alcohol sector. Yes, and they inform us that unless this is amended in the main act, they are actually charged taxes, and yet they get a lot of losses on transit for some of their spirits. Chair, we are also proposing to introduce proposals on the issues to do with flow meters and mass flow meters, and this is the proposal that was presented earlier by the company that was here. Chair, when we had the engagements that they talked about between ourselves and KRA, we realized that the flow meters that had been proposed under the Excise Act and the regulations were not favorable to micro and small enterprises. And we had reached an agreement that KRA would amend the law to facilitate micro and small enterprises to be allowed to use flow meters that are not costly and which will allow them to still be accountable. And we actually saw that the cost of the flow meters have been assessed, or they have been, the cost of it is quite high for micro and small enterprises. So we are proposing to amend the Excise Act so that we exempt micro and small companies from such requirements of the flow meters. And it's what the company that was here was recommending. Yes. Okay, so we move to the next proposal, 36. It's for removal of excise duty on imported paints, varnishes and lacquers of heading 3210, 3208. We've written the 3 tariff codes there. The reason for this is that these items are used for processing finished leather. Yes. So Dr. Rao can give the justification.
Yeah, good evening, Mr. Chair. First of all, I would like to thank on behalf of the leather sector, putting leather industry as a priority by the government. We really appreciate, and I think leather is taking very strong steps in investing into footwear, leather goods, and tanneries. And today we are very happy as a CAM because you as a parliamentary committee have saved us in the past. So I hope you will save us again. And the uniqueness of leather industry is we have raw materials, we have a manpower, and also we have a market in East Africa and also overseas. Our demand for the leather is increasing, and we have the 3rd largest livestock in Africa. So I think that is our wealth, and which other industries doesn't have. So, dear Chair, we have a challenge on achieving our targets. The government has put us that we should achieve 100,000 people employment, and also to reach a $1 billion, as a leather sector, which is easily achievable. But we have certain challenges. But, Chair, raw exports, I think, country is losing. I want you to look at it as a parliamentary finance committee. On the raw exports, we are losing huge amount. Like, for example, 2023, 2024, we have exported 10 billion shillings. We are supposed to collect 50% duty. But what we have collected is only 800 million instead of, 5 billion. So I think I want you to look at that very seriously. So today, if you see that the new proposal we are asking on excise duty on chemicals, we are now producing dyed and finished leather, both for domestic market and export. So leather industry in Kenya today is doing 50% exports and 50% domestic. So 1.5 years back, we have been introduced this excise duty on chemicals under this, clause number 36, which are raw material and nobody is making in this country. Our neighbors like Egypt and Ethiopia are all getting duty-free chemicals, and they are trying to export finished leather into Kenya. So we really want you to consider to achieve our goal of 100,000 people in the footwear, leather goods, and tanneries, and also, to have a revenue of 1 billion for East and Central Africa. Mr. Chair, you know that in the leather industry in Kenya is supplying complete footwear to the Ministry of Interior and also Defense. The industry is saving 750 million shillings per year, what they used to import 5 years back and what they are buying locally. So I think this is a very, very crucial and important, Mr. Chair, to consider and remove these excise duties. And, you must know that, Karioko alone is producing 2 million pairs of shoes by 7,000 people. We can increase that if we reduce our cost of chemicals. So please help us out, and I hope this is considered done. Thank you.
Maybe to take you a little back, I see Koruram there, and I think I missed the presentation on Koruram. Was the issue of your flow meter sorted? Did you start manufacturing? That's why we are asking for this amendment to the Excise Duty Act. Yes. So if we do this amendment, then she will not be required now to have a flow meter, right? Yes. Okay. We promised to... Okay. We promised to visit your factory, I think, last year. But again, a lot of work caught up with us. But now that we are doing public participation around that region, we will organize our secretariat to pay you a visit and make sure that we fix this. You cannot set up a plant and 3 years later, just because of a plant. Even after I introduce them to KRA people, it seems it never worked. Any, proceed.
Thank you, Chair. Chair, what we've just presented from the leather sector, we of course came to the committee to request for protection on resins issues, the resin materials and inputs. But when we realized that there were sectors, there were items that we were not producing and they were impacting other sectors, the leather sector was one of them. And we were able to now do the verification mission and confirm what capacities we have, and we ask for retention of that. But where we don't have capacity is where we are indicating that we need to remove the excise. The next item is a new proposal to be considered under the finance bill. It's for exemption of inputs and raw materials from excise used for exports, destined for exports. Chair, the proposal on this is that when we are able to exempt some of the inputs and raw materials for exports, we are able to grow our exports. We've seen that we've become quite uncompetitive, and the presentation that we had made earlier through the chief executive had showed now the data in terms of what we need to do to support more exports out of the country so that we manage the trade deficit we have of more imports in the country. The other proposal is...
Chairman, I think, you know, we are now having excise left, right, and center. Fair enough. But what about exports? VAT is zero rated. And, you know, we are losing export market. And once you lose export market, you can never get it back. And we do the tax, yes, but every country's policy is export is their number one priority. And I think this is, Chairman, we would like you to, because there are many things coming you've seen in between. So this one, at least first we sort out excise before we go to other items, then later. Please, Chair, thank you.
Chair, the next proposal is item 38. It's excise duty on coal. We are proposing the removal of excise duty on coal so that we can allow the sectors utilizing this to be competitive, especially the cement industry. We've given the data and the information to show that the cost of final products produced here locally, like cement, have gone up, and it's because of the excise duty on coal, and that we are quite uncompetitive even at the EAC in terms of utilization of coal. Chair, the next proposal is on cosmetics and beauty products. We are proposing to remove excise duty on cosmetic products for that particular headings that we've indicated, 3304, 5, 6, and also 3307. This is to support the industry. In our attachment, we had actually put a slide-up presentation for cosmetics. No, we have for sugar. We also have for cosmetics. It's one of the sectors where we have a lot of capacity. Yes, Chair, you can see the enclosure that we have provided in terms of increase in terms of our exports, and we are trying to support the cosmetics industry in the country. But there's an excise on cosmetics and beauty products, and we request for exemption of local manufacturers so that it is retained on imports so that we can see the sector grow and increase. And this is one of the sectors where we have a lot of the micro, small enterprises in the country who are supported, incubated by some of the government agencies such as KIRDI, and this is a proposal that will support them. So retain on the imports, but exempt the local manufacturers from the excise. The other proposal we have is on industrial sugar. Chair, we will share the specific provisions on industrial sugar, but our proposal is to exempt manufacturers from industrial sugar excise. The slide. Again, we had enclosed an analysis of...
What is your ask on cosmetics?
To exempt local manufacturers from the excise duty.
Imported, let it be there.
Yes, of 50, there's a 15. Yes. It will not apply to
Chairman,
the
we'll
local
have choice of
manufacturers.
more beautiful ladies. Keep that in mind.
Be very careful. There was an interesting discussion we had earlier. I forget which entity it was on petroleum, on milking jelly, and the differentiation between when you import, when you use that petroleum jelly for agricultural use and for cosmetic use. I thought it would come up, but we had a very interesting conversation about that in the course of the proceeding.
Thank you, Chair. Chair, the new proposal that we have is on industrial sugar, which we commit to submit our proposal, but we had enclosed in our submissions an analysis of the cost impact of the costs that are already there on industrial sugar. If you look at the proposal that we have made, in 2023, excise duty of 5 shillings per kg was introduced. Then we moved to 2024. We had excise duty proposed under the Tax Laws Amendment Act of 2023. It was increased to from 5% to, to 7.5 shillings per kg. And then also IDF was also increased because this is a product that we don't produce locally here in the country. And then when we moved to 2024, the Sugar Directorate has proposed to increase a levy of 4%.
It has been effected now.
Yes, has introduced a 4% sugar development levy. And then recently, just almost 3 months ago, another authority known as Biosafety Authority has introduced another charge on industrial sugar. So any proposal to increase the excise duty is going to affect the industry, and yet we still don't have production of industrial sugar in the country, and it is used widely in different sectors. So we'll submit the specific amendment, but we've been able to enclose this impact analysis.
Chairman, for
and I'm sure you had the new presentation, the new proposal that we got yesterday. Yes.
Again, this levy has come. Now, our exports are going to, as it is dwindling, now will dwindle double. So, we need export policy, and Parliament is the main body which can create all these levies and whatever they are coming, they should be exempted for export. We have to get together, create it, and create, we know the scheme was EPPO, which worked very well. So, Chairman, so please, otherwise, we'll be coming, talking every time, and nothing is happening, and the costs are going up because some additional levies are there, and that is what is really bringing us down. We are losing motivation to work, Chairman, and entrepreneurial spirit. Two things we are losing. We need to get it back.
Vice Chairman, I like how you are passionately speaking out. So when you lose motivation, what will happen? Where will you be?
Sorry?
If you lose motivation, what will happen? Where will you be next?
See, and Madam CEO, Chair, you're out of order. Madam CEO, please help us update the same document, because we are having trouble cross-checking which document you are referring to. So please, I think we can remove all the 4 documents you have in the report apart from the CEO's introduction, and give us one document that we can refer to. Yeah, because we're finding it trouble to.
Thank you, Chair. As guided, we will submit the same. So, Chair, we move to the Tax Procedures Act. We have a number of proposals under Clause 47 MV. There's an amendment that seeks to restrict the Commissioner from issuing a notice where the taxpayer has appealed a decision. We propose deletion of this. The justification is that if passed, this will give the Commissioner powers to issue an agency notice after a tribunal or court decision without granting taxpayers time to appeal. The law already provides for the 30 days to appeal, and if this is adopted, it will affect the administration of justice. The next proposal is item 41, clause 50A, which seeks to remove VAT, input VAT, as one of the taxes that can be offset by overpaid tax. We propose deletion of this provision, or in the alternative, we propose to substitute the phrase "an input value added tax" with including VAT payable on imports. This proposal will impact input VAT for the petroleum sector specifically, who have been advocating for the operationalization of offsets of VAT. The alternative proposal seeks to enhance better compliance by the taxpayers by capturing VAT payable on imports. So the proposal is to include VAT payable on imports.
Chair, just to add to that, this will assist KRA reduce their outstanding refunds. So if this is allowed, then it will get us back to that point where we want to be. But if we disallow, it means that KRA is owing and we are borrowing money to pay KRA. Thank you.
Chairman, you had told us to meet KRA and all that. We have met, but the issues are remaining and we'll need Parliament support to have a joint meeting.
Thank you, Chair. So the next proposal is item 42, clause 50B. The proposal is to retain the current period of 90 days. The proposal was to increase the time the Commissioner shall determine an application of offset of overpaid tax from 90 days to 120 days. So the proposal is to retain the 90 days for more effectiveness and efficiencies. Similarly, clause 50C is also to reduce the time taken for where an audit has been undertaken from 120 days to 180. We propose retention of the 120 days. So the justification is that the extended period will affect cash flows for taxpayers, and it will take several months for them to be able to get the offset approvals. And for efficiency, we retain the days that have been proposed. Then item 44, clause 52.
Chairman, it is increasing one side. We then can have VAT we pay after 90 days. That we have no problem. Yeah. Like, no, 90 days, it's a law. A law.
Okay. Chair, we move to item 44, clause 52. We propose deletion of this clause that seeks to remove, that seeks to have data privacy exemptions for personal data and trade secrets. This, of course, is based on the justifications on the right to privacy, the Data Protection Act safeguards. So we propose deletion of this clause. The next item is item 45, clause 54. We propose deletion of section 77(2), which proposes exclusion of weekends and public holidays in computation of days for submission of objection and appeals. The justification is that it shortens the window for filing objections and appeals for the taxpayers. The next proposal is item 46. It's a new proposal. It's a proposal to create a dedicated VAT tax refund fund under the Public Finance Management Act. From the engagements that we've had with the industry and also the government agencies, the challenges we are having with VAT refunds is the issue to do with funding and from the National Treasury to the Kenya Revenue Authority. So the proposal is to ring fence these funds so that when their KRA is remitting funds to the National Treasury, the funds don't go directly to the consolidated fund, but they go to a dedicated fund that will allow refunds to be paid. Chair, we were able to see other jurisdictions in terms of payments of refunds, and if you even see the efficiencies that are there, that Any person who goes to any countries, for instance, South Africa, we hear even Uganda, are quite effective. By the time you're leaving the country, you're at the airport, they actually give you your refunds instantly. And you're able to be paid, but it's because they are able to create such dedicated funds where such funds are able to be provided for and to be used for that basis to ensure there is liquidity in the markets. The next proposal is item 47 for the VAT as special table. We propose an overhaul of the VAT special table to protect compliant companies. Yes. Yes, so that's the proposal. So that's the end of the VAT proposals. We now move to the last one on the miscellaneous.
Wait, let him
okay.
start.
Sorry. Okay. Okay. Thank you, Chair. So we move to the Miscellaneous Fees and Levies Act. The proposal under clause 59A, we propose to reduce the export and investment promotion levy rates on semi-finished products of iron and non-alloy steel to 0%. Yes, please, you can give the justification.
Thank you. Thank you, Honorable Chairman and Honorable Members. Just to give a brief background about the Exports and Investment Promotion Levy. This was enacted in June 2023 through the Finance Act of 2023. And the proposal was, in the bill it was at 10%, but somehow after the Gazette came out, it had been increased to 17.5%. The effects of this levy in the last 2 years since it has been enacted has been that exports from Kenya are totally zero on steel products. I'm not going to comment on other products like cement and paper where it's also applicable, but on steel products, we are no longer exporting, but we have become an importer of finished steel products from Uganda, from Tanzania, and other partner states, including KEPSA, which was never the case in the past. The price of steel has skyrocketed in the country, and I'm sure everybody knows about that. Not only steel, even cement prices used to be at 600 shillings a bag. Today it's over 800 shillings a bag. And the reason for that is just this levy. Affordable housing is no longer affordable. The levy is excuse me. The levy is actually something which goes against the Africa continent free trade area as well as KEPSA, because both the protocols clearly state that there shall be no new charges or taxes levied on products which are manufactured in member states. So in fact, the Ministry of Industry has already received complaints from their counterparts in South Africa and Egypt, stating that this levy is a non-tariff barrier, and they are now looking at reciprocating such on products which are originating from Kenya, including tea, coffee, others. The levy is protecting only one manufacturer, and this manufacturer is using monopolistic practices to put other manufacturers out of business.
Finish quickly.
Sorry?
Yeah, no, just show us what you want because time is not on our side.
Chairman, our ask is that the levy should go to zero. We've had several meetings with the Ministry of Industry, and they have reviewed a lot of our documentation and everything, and I think they are also in support of this. So the 10% which is in the bill should actually be taken to zero on steel products. Thank you.
Chair,
that's actually 48, 49, 50.
correct.
All three.
Yes. Chair, just to add that we had an alignment meeting with the Ministry of Industrialization on 16th of May 2025 with the steel industry and the cement industry, and there seemed to be an agreement around review of this export and investment promotion levy in the steel sector, and also we've also made proposals here. So item 48, 49, and item 50 is on the export and investment levy on the steel industry, and the proposal is to move it to zero. But it would be worthwhile to also engage the Ministry of Industrialization based on the meeting that was held on the 16th of May to confirm the position and what was agreed between the industry and the ministry at that time. The other proposal is on kraft paper. The proposal is also to remove the duty that is already there of 10%, the levy that is of 10% for item 51, and the tariff numbers are indicated there. Interestingly, Chair, the cement industry has recommended that they retain the export levy because they've seen that the impact of it has really supported them to grow and increase their investments, especially in clinker. So the request is on the steel industry and also on the paper industry for the export and investment levy to be removed on all those items that are there.
Chair, let me get it right.
Yeah.
Chair, let me get it right from the CEO.
Yes, CP.
You mean CAM is coming up saying that on export promotion levy, he proposes deletion of the 17.5% to zero only on steel.
And paper, and kraft paper.
And kraft paper.
But for clinker, it should be retained. Okay.
The last proposal is item 52. It's to amend the Miscellaneous Fees and Levies Act to remove the exemptions of IDF and RDL on the second-hand items that we had talked about on excise, the exemptions that were given on VAT for chapter heading 6309 and 5407. There were exemptions that had been provided for these items too. So apart from VAT exemptions, they were also given IDF and RDL, which of course was quite interesting because the industry has been asking for the last, I think, 3-4 years for exemptions of IDF and RDL or a lower rate so that they are competitive against the imports. But that has never happened. But we saw this on, second-hand items. So we propose deletion of this so that we don't have an influx of imported used clothing because we have capacity in the country to produce this country, and we even have waste in the country in the event that whichever investors are proposing to get some support. So, Chair, that's the end of our proposal, and as guided, Chair, we will submit a detailed, longer proposal. We are just separated so that this memorandum is shorter. We also have one proposal on the social housing levy, insurance levy. The proposal was on opt-out, and we will submit the detailed proposal. This is similar to what is happening in the National Social Security. And the proposal is to have a standard rate that is payable to support the social housing, but to allow businesses to be able to opt out, similar to that, for the second amount that is proposed. So we'll propose the similar, we'll send the proposed amendments as soon as tomorrow to the committee for consideration, together with the others that we had indicated.
Chair, just to elaborate a little bit, I think the understanding here is that if we do something similar to what NSSF does and allows us to opt out, the obligation still stays that employees or employers who opt out must still provide medical benefit and care, but through an opt-out through private schemes. So I think that is drawing from the same parallels. Yeah, we're talking about the social health insurance fund here. Yes. Yeah. So NSSF obligations today are 6% deductions, both employer and employee. But the employer can opt out from paying NSSF so long as it pays a nominal amount and the balance is opted out together with the employee's contribution is put into a private pension fund, which is earning then probably better returns. So the idea on the concept was very similar to that, is that it doesn't take away our obligation to provide medical benefit. It becomes mandatory, but it can be provided through the private industry and choice, and probably better cover. For the amount that we're paying, we'd probably get much wider and better cover.
All right, CP.
Chair, I just wanted to hear from CAM, listening keenly on their proposal, especially on the textile and clothing. They become consistent on reinstating taxes for imported second-hand clothing. That is IDF, RDL, and also excise. That is duty. I wanted to know whether they have empirical analysis on the demand of clothing in the country, Kenya, especially the target group, the main consumers of mitumba. You can tell who are those people. The people we were referring them during our campaigns as bottom-up. I don't know whether you have the statistics of the demand, and then compare now, CEO, with your sector, how much you produce the output, and your balance statement. Because the moment we put these taxes, I think from that point of view, is to deter the consumption of this and give leeway to the consumption of local production, which to me I want to support 100% because of employment. But I don't know what is the cost of locally produced clothing for the low people, those who want to dress nicely, the GNC, you know, the GNCs, those young boys and girls in college, the way they want to dress in those. You can imagine how they like to dress up. So do you provide substitute of that from your hand? And if so, what will be the cost of this, the minimum cost that will trade off with this one?
People from the manufacturer from Textile Center.
Yeah.
Textile.
So thank you. On the second-hand clothing, we don't have per se a figure of what is reusable and non-reusable, and that is where we have a bit of an issue in terms of quantifying everything. But if the demand is there for those things to come out at an affordable rate, it is economies of scale that will bring the cost down. Right now, we don't have the economies of scale to work to bring the cost down. And fashion, as it says, is we have very creative fashion designers in the country, but we don't have mass production in that fashion trend. Why? Because we don't have the demand. It has been consumed by the second-hand clothing, the reusable second clothing. And therefore, we are not adding value to the economy through this sector, and we are not also creating the jobs that are required for this sector, or the jobs that the sector has potentially to create. So that is, what is it that the country wants? That is the question that will come.
What about access to raw materials? Do you have access to raw materials? Supposing this committee considers your prayers, and you know the impact of it, you really know how it will come out for Kenyans. In these laws we are making for Kenyans, we are not making for ourselves alone, we are making for Kenyans. Do you have capacity in terms of sourcing of raw materials, the distribution lines, the manufacturing lines that can meet that cap? That's why I wish we had somebody to give us the real statistics of how much we import, how much we consume in terms of second-hand used clothes, which are available, affordable for many Kenyans, and how we are going to pick in terms of scale of economy to immediately substitute within the same limits of demand and affordability for Kenyans. That's what I'm asking, that level of compensation.
Maybe CP, what KEM can do in their revised submission, they can include that data on textiles and footwear. Because I believe if there is a field, if there is a place where we'll have very good strategic advantage and very huge market, and we already have a very huge existing market, is on textiles and footwear. And remember also all the value chains. One of the manufacturers is it's called Bedi. They're based in Nakuru, and they are so huge that if you go to shop in some of these luxurious shops in Oxford or in New York, you are likely to buy a Bedi a shirt made from here. And then you just check the label, it's actually made in Kenya. The last time we had a conversation, we were saying, interestingly, Kenyans would happily buy that shirt in London and not in a store here. But really, our textiles sector has a lot of potential for growth, and they're doing quite a tremendous job. But in summary, respond to what CP was asked.
So to your first question, if we can, as our chair said, if we can make jeans in Kenya and export it to America, and then buy them from America and bring them back and still buy them. So I think it's answered your first question. We have the capacity. Okay? And the moment we have the right infrastructure and the right policy in place, we will even get more investors to try and build mass. But the other question is mitumba, if you look at the amount of money and tax you pay on a mitumba and the amount of a shirt you will buy from mitumba, and you calculate, the person who has imported that mitumba is making a lot of money. And look at the amount of revenue government is losing on the same. Because mitumba is coming as per kilo. And it's coming as a lump sum. Because you're not paying a tax per shirt. It actually comes in as a bundle, as we have presented on one of the slides. So we need to look at that and see how to increase that and look at that. Okay. Thank you.
We call them bales.
Yes, bales, yes. Thank you, Chair.
And also, Chair, you may also need to look at also the new clothes. We call them new ones. The one I see people import from Turkey, the Italy suits, especially the one Turkey, men wears, female wears in our shops. Because I see middle class are going for those ones. But all of them are made from abroad. Question is, why Kenyan market look for foreign clothing, even the middle class?
So just to answer on the middle class is, middle class are also looking for fashion. But what happened in the 90s actually depleted our capacities to produce for fashion. Okay? But now we have an opportunity to build those capacities. But when it is what comes first, the chicken or the egg? And we have to really understand how do we put this as a policy framework that will help textiles to move forward also in the fashion trend as well as the school trend, which most of us are focusing on right now. But we need that shift in terms of doing more fashion products. Okay? My take on what you wanted to understand is we will have to do it in stages. Okay? So there has to be short-term plan, medium-term plan and long-term plan. And that really needs to be having conversations around as to what we can do short term, what we can do medium term, what we can do long term. And that will help us progressively move towards creating the jobs and the industry as a whole. Now, the other question is, we have a lot of incentives for SEZs to come in, okay? But we find that a lot of the SEZs are not taken up by the textiles. So there has to be something that we need to really understand, why is that happening? And we really need to understand. Now, there are local manufacturers are not given the SEZ status. And therefore, they will become totally non-competitive as soon as SEZs come in and start working. So there are a lot of things that we need to really look at and understand what is impacting the other. So those are some of the things that we need to really brainstorm on those aspects. Thank you.
Honourable members, just to give an example, this is a laptop bag from our Director Legal Services. And guess where it's made from? It's locally made. It's made by people called Adelphi, Nairobi. And you can see it's very, very good quality leather. So we actually have the capacity. We just need to find about how do we support our manufacturers. It's possible to manufacture nearly everything that we use on a day-to-day basis. You know, yesterday we had a discussion with East African device assemblers, and they were showing us phones that costs. They sell at like 6,000, 7,000, 8,000 smartphones that, if you look at it, it almost looks as nice as an iPhone, and it's locally made. And why have they progressed that well? The tax incentives we granted them 2-3 years ago, and they've really grown. So I think if we just find a way of really finding a solution to supporting our local manufacturers, then we could consumers, even the microphones that we're using there, could easily be made here, not imported. Thank you. Your closing remarks, Madam CEO?
Chairman, but before he'll do the closing, but just Chairman, you have already said, so what does it mean that if we want everything to be made in Kenya, what is economically possible, that the parliament is the supreme body which has to correct whatever these people are making messes and give us, when we said we will give you we never ask for money anywhere, we want you to put the right policy, the rest we will do. So you have heard, and I think you now know very well. So even if you want to discuss any of the issues which are not clear, please call on us so that it can be sorted out. And after this, I mean, we need to actually now think of a different way of working. Thank you, Chairman, and appreciate all your time. The timekeeper has done a good job to finish. 2 hours is finishing now.
Chairman and members of the committee, I would really like to appreciate you. Chairman, maybe just remind us here, how long have you been presiding over this? 2 years now. So I think, Chairman, you've also become an expert in many ways to understand our challenges as manufacturers, and your committee have listened. And the good thing is you can also look back retrospectively and unpack some of the stuff and the decisions and say what was right and what was wrong. We'd also probably like to acknowledge that there's less sting in this finance bill than what we saw last year. And I think that's coming from an understanding of how do we find a win-win solution around many things. Our ask is that as we go through the rest of the year, is to also be cognizant that some of these impacts don't prop up in other legislation. You know, that we can always look forward to the confidence around this annual cycle, because what happened, Chair, is we don't want the finance bill to become a symbol of uncertainty. Ultimately, this should be a process of confidence, and that we can sit here and present, you listen and you take it back and you make a change. Sometimes for that short-term pain that we might have on revenue, you're going to establish an environment that's conducive with some long-term gain. But for all the assistance and for the time you've taken to listen to us today, we really appreciate. We know you have our back. And once again, thank you on behalf of the board and on behalf of the association. Thank you.
Do the hard work.
Thank you.
Chair, maybe before you react, I want to invite CAM also as we listen and we make together these laws, like Finance Bill 2024. I'm sure you must have studied the report that came from this committee. It really took a lot of input from your contribution. But while the politics were taking this dimension, you went mum, you never even spoke about that. We know what we've made. This is good for Kenyans. You went mute, so you left our chairman alone to be seen by the people that is the one making bad laws, whereas even the content of the report was purely a product of what we came together. So CEO and chairman, when we make laws here together, looked at our reports, we appreciate together, and let's speak to Kenyans together.
You know, CP Ruto, one of the things that that time I was not so happy about these people. We were at a meeting at Hilton Inn during public participation. And my comments at the end of my presentation was that we need to be very careful of the policy decisions we make, because we live within East African protocol, and we risk, if we make bad decisions, having some of these entities moving to a neighboring country and then exporting to Kenya. So what the disinformers then did, they said that I said that if you people are not happy about us, you can go set up in Uganda and now export to Kenya. Even the people that were in that discussion, I was following their Twitter handles, they were happy to tweet what they said in that discussion. None bothered to correct and say that's not the case. So please, sometimes you hand a lot of heat on your behalf. It's only fair that you help inform the country when you need to. Otherwise, if you keep quiet, then we completely lose the conversation, the discussion. These particular proposals will always come every year. And because thinking change, emerging technologies come, the way of doing business, and that's why even in your businesses you have even a department for strategy for keeping changing how you do your work. But then if you allow every type of discussion coming up to have a misinformation and disinformation and unnecessary panic, then we actually lose the conversation. Okay, so I implore on you, please become also ambassadors of this. Is just a process that we are going through, and these are things that we think are correct, even when sometimes they might hide. And I must congratulate you also. We've seen a lot of better. You see, for example, the proposals you're making, sector-based. You're saying we have agreed as this sector. This would be what would be best for government. This is what would be best for us. This is best as consumers. As a sector, you've agreed. Remember the previous finance bills, like I think the one for 2023, it almost became a shouting match between the saying, no, we have capacity, no, we do not have capacity. But I like now that spirit of the Kenya Association of Manufacturers, that you are presenting a front as we are saying this as a sector. So even when you're in competition with each other, we agree on what is best for our sector in our country. And I think that united front will help also us make the right decision. Because now, when you come and you're saying this and the other one is saying this and you're doing the same thing, who do I believe? You know, I conclude, Madam CEO.
Chair, just to come back on that before, Miriam, we've been open. We've always had the situation of discontent members also within, and I think one thing we always come here together is with one common voice. And there'll still be discontent, and we still expect that you'll have errant members coming directly, but that will never change, Chair. You know, all we'll request is that no surprises, no sneak-ins, that what we're debating is on the document. You know, and it really then gives confidence to that process. Then, you know, we believe in it then as well. So thank you.
I think that's why I was even kind enough to share and if there is any new thinking that will come that affect our sector, I'll make sure that I share with you so that we can have this conversation.
And this is very valuable, Chair, because it just allows us to be able to input into that document. Thank you.
Good. Conclude?
Yeah, no, Chair, I think our leaders have spoken, just to appreciate from the technical team and to say also thank you for the lunch that we had. We appreciate. Thank you.
You're very welcome. This marks the end of day 7 of the public participation of our different stakeholders. Tomorrow we have the last meeting in Nairobi for individuals who may want to come and present to us in person. Again, if you have submitted your remarks online, you don't necessarily have to physically come, but if you really feel that an oral presentation will give better clarity, please welcome to the public participation tomorrow. Tuesday next week, we start moving to counties where we have purpose to do 10 different counties. And remember, don't just concentrate on the finance bill. We have another bill that's going to revolutionize our finance sector, and that is the virtual assets providers bill. This bill will probably become the fourth country in Africa to legislate on virtual assets. And virtual assets are things like bitcoins, cryptocurrencies, and all that particular space. And that will really change how we do business and how we do banking in Kenya. So please welcome, give us your views, and we shall make sure that we, to the best of our abilities, consider as most of our views as possible, so that we come up with two important legislative framework that are going to revolutionize our country, develop our economy, and make sure that we become an icon in the region. Thank you. It being 6:51 p.m., the meeting is adjourned until tomorrow, same time, same place. Thank you.